Abdul Shabazz. This is Some Real Change, Stock Options Trading Journey. Thank you for joining us. Called this area out days ago. Finally in it now. I'd like to see a bounce back to the 768. We get a bounce back to that 768 possibly. The higher we can get back to that 768. She's gone as low as 764 already right here. So I anticipated this. So this is me possibly trying to catch it on that 766 area if she can get a bounce back. The higher she bounces back, the better. But there's a decision. It's already been made. 760.55. We can experience a little bit of go ahead and do that. Get these plans together. Just go ahead and get these plans together. Alright, here we go. Say 766. Depending on how we can get 7. 764.6. I like to get in at the lowest possible. And I believe we're going to take that first profit target. It's going to be 760.5. Second profit target 756.5. Yep. So 756.6. And that's what I'm looking at. Now if she gets back above that 768, then of course we'll entertain. But I don't like anything bullish, and I've been saying that for the past couple days all week. I don't like anything bullish this week. Okay, so essentially the only thing that I really need to do is just move my arrows over, because the same way I felt the last time I was on the air is the same way I feel now. And that's why I didn't trade yesterday, because I anticipated yesterday being some noise. Additionally, we have earnings this week, so a lot of companies are, putting out their earnings. We don't care about news at all. We only care about the reaction to the news. And the charts tell us everything that we need to know. So again, this is what I'm looking at coming into today. Looking for a bounce as high as possible. I'd like to take a 766 put. Get in no later than the 764.6. Take it down to the 760.5, possibly the 756. Of course, I'll be referring to the higher time frames, not allowing my emotions to override my clear thinking. Coming up with a plan, sticking with that plan. There you have it. Nice little scalp call yesterday. Beautiful scalp call, that's what it was. And then you could have caught that beautiful scalp put right behind it. Shout out to those of you who did. Yes, sir. Shout out to the team in the building. Dr. J and Retig1. Retig1, who is that, Retig1? I forgot. I forgot your the handle. I know how they do it now as far as putting up, the persons, but I forgot who that is. But shout out to you. Shout out to your fam, teammate, for jumping back in with us. All right, so now I have my plans. Now I'm doing my top-down analysis, starting with the week. And we are red for the week. Looking at a beautiful 3-candle reversal straight out of the playbook. I don't care where it goes down at. It's definitely going down. Man, I just wish I'd have been in this earlier for the week, because that possibility did exist. It did exist all week long. Once we drop below that 776, I will get better. Beautiful 3-candle reversal. I'm glad that I can acknowledge it. So that means I'm keeping that power to myself, not blaming anyone but myself. That means I have the ability to fix it. I will catch that big money move. It's gonna happen. When I catch it, we gonna catch it, because I'm transparent. It should have been one we caught, based upon the setup that was coming into this week. This was a beautiful 3-candle reversal. The goal point was 769. 769 was the goal point. Okay. The only problem with that is that the market was unwilling to give it up yesterday during market open. The market was unwilling to give that area up during market open. Let's go back and look at it real quick here on the 5-minute chart. Here is that 769 highlighted in blue. Typically, it would be white, because you guys know how I feel about white areas. So this really should be white, because that's how critical and serious this area is. Okay? Got beneath it once, got beneath it twice. You understand me? And then bounced all the way back up to 772. So when it did break that 769, the response was a bounce back to 772, then a lower high, worked her way back down and hovered above that 769 until the end of day. Okay? The last 15 minutes is when she broke it. But then right after that, post-market, she bounced right back above it. And now pre-market, we finally get the break that I was looking for. And she drops all of this money we have to watch that we were not able to participate in, simply because it happened during a time we couldn't trade. But we absolutely knew where this area was. We absolutely knew what was going to take place with the break of this area. We just weren't able to get in this trade. It is what it is. So now we're at what is the second best thing. The second best thing is to get a bounce back up as high as possible to the 768. Okay? In doing so with that, okay, that would also put in a lower high. All right? If it fails, that's 768. That will put in a lower high. All right? There is a larger selling algo right here. So this is what I'm looking at currently right now to make my decision upon us staying in this algo, coming back down, and then breaking the algo, going down further to that 760.5 and that 756 that I'm looking at. So my first alarm is going to go here at 764. No, I'm gonna say 764.8. You understand me? But again, the first 5 minutes are very volatile. The first 15 minutes can trick you. We're not going to do anything but hurry up and wait. Be observant. We know the area that we would like to see it. Let's just be patient and see if the market gives it to us. And here we go, team. Here we go. Todd Macon. It's my guy. Yes, sir. That's my guy. Again, able to identify that control, selling algo. So us seeing the market come to this area right now and have a little bit of hesitation is exactly what we expect to see. First 5 minutes, very volatile. First 15 minutes can trick you. Give the market a little bit of time. Okay, control buying algo. Little baby control buying algo right here. Let's go ahead and identify her. Bam, bam. We see you. We see you. We see you. We see you. We got two competing algos out the gate. Again, we'll be referring, Todd. We're taking the same beautiful trades, Todd, but we're referring to the higher time frame, which is making it that much more solid. So essentially, Todd, when we enter a trade, it should be on the quarter or the half, meaning it should be at 9:45, 10 o'clock, 10:15, 10:30, because this is giving us continuation and confirmation on the larger time frame. This makes us make sure that we're in line with the trend. We're not going against it, and we have the power of the larger time frame supporting our move, which gives us the ability to sit in a trade now for 15 minutes or 30 minutes, depending upon, unless we see an immediate reversal signal to get out. But it now gives us the opportunity to maximize our profit because we're looking at the larger scale. The beautiful thing about it is that every day is not going to be a trading day. Now, it does not also guarantee that every trade is going to be a winner, but it does guarantee that every trade we take will be worth it. And that's all you can ask for. You know what I mean? That's all you can ask for. Show up. Do your job, okay? When your job requires for you to do it. Trading is not about winning and losing. Trading is about performing, okay? That is what we do. Our job is to perform. That performance is executing our plan each and every time, regardless of how we feel. That is why we have a plan to remove emotions out of the trade. It's strictly business. We're only looking for three things. We're either looking for a small loss, or we're looking to break even, or we're looking for it to be out of here. No more itty bitty trades, no more itty bitty profits, no more scared profit taking. No sir. Only three outcomes. Only three outcomes. So once you get in a trade and it starts going your way, you eliminate the small loss. The only two options is to break even or it's out of here. And I'm loving it. Some trades we're going to lose. Some trades we're going to stop out at profit targets. Right? Because now once that trade start, going our way, what normally would have been our profit target, we're going to make that our stop out area. So we're going to still give that trade room to run even once it gets to our profit target area. Because now that profit target area, we're going to make that our stop out area and allow that thing to do what it does. It's going to be beautiful. So that means some trades we're going to lose, some trades we're going to stop out at profit target, and some trades will be legendary. You understand me? And that's what we after. Legendary trades. Coming out the gate right now, the bulls are showing the strength. As of now, I'm going to go ahead and fade that controlled selling algo to the background. Still present for now, but more in the background. Thank you guys for tuning in live on Kick, streaming on Kick. We're going to turn up on Kick. Kick is paying. Kick is really paying. And we got a lot going on and a lot coming. And I would love to start showing it behind the scenes. You know what I'm saying? This is what I was looking for. That push back up to that 768 is giving it to me. But we need more time to go by. Okay? Top right corner is the daily chart. And after that beautiful shooting star yesterday, we have gapped down. But even though we have gapped down, the bulls have made a run for it this morning, which is why I highlighted that control buying algo that goes right in line with today's beautiful baby green candle so far. But still keep in mind that overall the bears have control of the week. So any call that you might take, please keep in mind at this point, it's just a scalp, buddy. It's just a scalp. Top right, daily chart. Bottom right, weekly chart. Bottom middle, 30-minute chart. Bottom left, 15-minute chart. Top left, where I get my algos from, 2-minute Heikin-Ashi. In the middle, 5-minute chart. What else do you need? You got the daily, you got the weekly, you got the 30, the 15, the Heikin-Ashi, and the 5-minute. Look for your setup on the larger time frame, the 15 or the 30, and then you look for your entry on the 5. The 2, the Heikin-Ashi shows you the flow. It's just that simple. Let's get it, baby. Let's get it. Continue to give the market some time. Allow it to reveal itself to us. First 5 minutes, very volatile. First 15 minutes can trick us. Let us take our time. Allow the market to show us where the trade is, and then we will pick it apart. Please believe it. That's why we wait until those quarter marks. Again, wait until 9:45. As I stated, the first 15 minutes can trick you, have you thinking the market is going one way and then completely go in another direction, as we can clearly see here on the 15-minute chart. Market made that very strong move up to the 768 and got a rejection there. That is also what I was looking for and hoping for. Now what we want to see, okay, going with the larger trend, we cannot entertain a put unless, or if rather, the two words we use are if and then. If the market gets below 766, then we will entertain a put, because the market will then be red for the day and will have flipped from green on the day to red on the day. And there will be a lot of bulls who need to cover and a lot of bulls who will be in trouble. And that's where we will be. Okay? And that's where we will be. Adam just texted me, Jody. He said, we're out here killing them. But our new schedule is 11 and 5. Gets me 2.5 hours in the rack. Should be headed to the dock sometime Saturday. Well, again, now you talking Saturday, which is another week this week. They're gonna have to do $8 grand or better.
They barely gonna break even.
They're gonna have to do $8 grand or better to impress me. Alrighty. But I'm definitely proud of you. Definitely proud of him. As we are looking like we want to come down, taking our time, this first 30-minute candle is starting to turn into a shooting star. As we come down to the bottom of this controlled buying algo, we get a little bounce here. It is to be expected. I wanted this 768 bounce, team, and I'm thinking about getting in my short here because we're so close to that 768. That's a very small risk. However, I'm an even stronger believer in sticking to my plan and not allowing the movement on the 5-minute chart to draw me into a trade. That is the difference now. I'm not looking to scalp the move. I'm looking to catch the direction the market have chosen to go in today. And until I have confirmation and continuation, I'm sitting on my hands, which brings me to why we only look to get in trades on the quarter. 9:45, 10 o'clock, 10:15, 10:30. 5 more minutes till we get to 10 o'clock. Again, the bounce at the bottom of the control buying algo is to be expected. Can't catch us off guard with that. Not some real change.
Balance sheet's better than made a great disposal of an asset that wasn't really that important then anyway. This may be a way to be able to play both of them, because I know that they're disparate and they're different product lines, except for when it comes to hand tools. That's the play, and I think you got to buy it.
Yeah, I'm looking at Snap-on as well. Down about $30, I guess, since the 4th of the month.
Well, look, a lot of people just are trying to figure out exactly where weakness is. And the one thing that people have been saying is, look, there's not been a lot of new construction. And that's absolutely true. I mean, Toll Brothers had a decent number, but just versus what people thought. But the renovation trade has come back on. The do-it-yourself renovation at Lowe's and the small contractor renovation at Home Depot are powering what I think are great sales for DeWalt for Home Depot and then for regular Black & Decker for Lowe's. So I think the trade works. I really do. May develop into an investment, frankly. It's a good place to be.
Well, we need the renovations after what single-family starts did earlier in the week. That was a tough print.
Oh, it's the only game in town. Only game in town.
What'd you make of Sanjay's comments?
Well, you know, Sanjay is a de facto leader now. Like, so many of our companies gave up on America. Sanjay doubled down on America, and now this way he's actually tripling down. And I think that, look, it's an institution that is making it so that we have great basic research for the next 10, 20, 30 years. That's how far out he's thinking. People are saying, well, the Chinese think further, they're playing the long game. Sanjay Mehrotra is the long game. And the long game for America is right here in Boise.
Jim, we love it when you're in the field, looking great, and we look forward to tonight.
Thank you.
Jim Cramer, Mad Money, 6 p.m. Eastern Time. When we come back, Walmart CFO John David Rainey on earnings, tariffs, with the stock now down a full 9%, session lows. And at 11 a.m., a live interview with the Treasury Secretary exclusively. Stay with us.
Patience, patience, patience. I'm ready to pull the trigger. Patience, patience. What y'all thinking out there? Talk to me, somebody. Let me know what you're thinking, teammates. I'm trying to exercise that patience right now. Cool, you on here? Right back to the bottom of the algo. And that's why we wait. Right back to the bottom of the algo. Hey, dollar bill. Man, I'm so glad you out. Oh, dollar bill. What do you think, man? So right now, I want to take a put, right? We're in this beautiful control buying algo. Right at the bottom of it, we're testing it, but I want to wait and see if we get a break of this 764. I'm trying to hold out for this 10 o'clock candle, because the bulls do understand the assignment before I get in this put. I like to get in below that. I like to get in below the 764, because what that will do will keep up with the trend. We're red for the week. that will then have us red for the day. We'll go from green to red on the day. I'm just trying to keep from being anxious right now to get in right now, because I want to get in at the 764.8 area where I have my alarm. But I cannot ignore the fact that we have this beautiful control buying algo, and we're at the bottom of it right now, and to see the bull step back in right now, okay, would not be unexpected. So I'm kind of glad I didn't. I really wanted to rush out there and get an early position on that put, but I'm glad I did not and held on. What are you looking at, Dollar Bill?
Exchange, including an exclusive interview with Treasury Secretary Scott Bessent as yields turn higher despite the Treasury Department.
All right, there we go. What are you looking at, Dollar Bill? I like puts below 766. I'm with you on that too. I like puts below 766 as well. Very important candle for me right now. I really wanted to get in Dollar Bill earlier, because once we topped out at that 768, I said this would be a great place to enter a put, because I could use the resistance at 768 for my stop. It gives me a very clear and very short risk for a great potential reward. But I just wanted to wait until the 10 o'clock candle. And I'm glad I did. I was absolutely looking for that bounce to the 768 and failure, and we did get that. But the bulls are strong this morning for now. Looking at the overall market is strong right now. Apple's strong, Netflix is green, Nvidia's green, Meta's strong. Tesla's the only one taking a beating right now. That's what I wanted to see. But now we're at like 10:03, and I don't like getting in between candles, Dollar Bill. You know, we as Dan the Man would say, let the candle close. So now I'm more leaning towards 10:15. So then that way I can look at the larger time frame to see if we truly do make a new low for today, which is that 765.8 area. That will complete us going from green to red on the day. I don't want to be early. I want to be sure. So I'm going to sit back, relax to the best of my ability. That's where I'm at with it.
gets a little scary.
120% in 10 years, U.S. debt to GDP ratio. That's what we're looking at, 175% in 30 years. That's according to the Congressional Budget Office. Look, a lot of people have been warning about this for a long time, but you know what? They've been warning about it in Japan for a long time too, and that's been 200% to GDP for a long time, and that hasn't been a crisis. Look at
It hasn't. I do wonder. Most of their Treasury bonds, and correct.
We're now red on the day, but that's dollar bill. Are you in? Have you taken that put yet? What are you thinking? I kind of want to wait now till 10:15. I do. In fact, I am. I will wait until 10:15 because I don't want to be among the early puts that jump in and get used as liquidity. So I'm going to be patient, as hard as it is, but I'm going to sit back, relax, and still refer to the higher time frame. He said the next 2-minute candle. He's looking at the next 2-minute candle. Okay, thank you for that, teammate. I myself am going to wait till 10:15. Let me go ahead and give the mic back to CNBC.
raise interest rates or trim the balance sheet, because that, again, would be going against the administration when it comes to capping these yields.
Yeah. Dollar, about a 3-month low. We talked about gold yesterday, up more than $100, and Bitcoin too, I guess. You can, getting back above the 200-day, up 15 yesterday, up 8 today.
I mean, we'll watch all of that. Stocks are under a little pressure here, but have been resilient to all of this bond market talk. The big stock story of the day is Walmart, though, tumbling despite a beat and raise quarter as the retail giant reports its slowest U.S. sales growth in more than 6 years, thanks in part to pricing pressure in its pharmacy business. Let's talk about all of this. Joining us first on CNBC is Walmart CFO John David Rainey. John David, welcome back. It's good to see you.
It's good to see you, Sarah.
So Wall Street's focused on the U.S. comps, even with the acknowledgement that it looks like a lot of some of the weakness was the pharmacy business, right? Tell us what the story is.
Yeah, well, our business is strong. It was a good quarter for us. We grew the top line over 5% and grew EPS almost 20%, 19%. There's been a lot of focus on the U.S. comp, which came in about 2.5%. But very importantly, as you noted, we have the health and wellness business, which is about 10% of our overall business, and pharmacy is the largest piece of that. Pharmacy has been impacted by two things. Last year, there was a tailwind related to GLP-1 pricing of about 100 basis points to our business. This year, we have a headwind of a similar magnitude related to maximum fair pricing, or MFP legislation. If you normalize for that, our comp was about 3.5%, and we shared some of this in our earnings materials, but if you take that 3.5% comp and you go back and look at the last 10 quarters, it's very much in line and consistent with what we've been doing. In fact, I would say on that adjusted basis, the second quarter was the strongest that it's been in 3 years.
So because of what? Because of strong just consumer spending?
I think it's that our overall value proposition continues to resonate with customers. Consumers have been more pressured relative to the beginning of the year. Somewhat stating the obvious, they've been impacted by higher fuel prices. But we see that our business, and importantly, having a value proposition that stands for low prices and convenience, continues to resonate with customers. Just this quarter, we delivered twice as many units as we did a year ago in under 30 minutes. And 70% of our deliveries right now for e-commerce are same day or better.
Yeah, I mean, the other factor here that is inflating these numbers are the tariff refunds, which were huge in your case, as you paid billions in tariffs. So how much has that been a factor on the numbers and what happens going forward?
Yeah, great question. For the quarter, if you take the net impact of the tariff refunds, it was about 750 basis points of operating margin impact. So on a normalized basis, you take the 17.5% operating income, adjust for that, we would have had operating income of 10%. That's actually one of the best quarters that we've had. And comparing that to the U.S. comp of roughly 2.5%, we're growing the bottom line 4 times the rate of the top line. I think that really speaks to some fundamental differences differences in our business today versus just a few years ago, given the more diversified profit streams we have with things like advertising and membership, that those two alone are contributing to almost half the profit growth in the quarter. And for us, the implications in our financials are the incremental margins in our business are twice as high as the overall margin, which I think shows the core earnings generation power of this business.
Yeah, I mean, does it though raise any concern about the core business when so much of the growth now and the profitability is being fueled by e-commerce and advertising?
Actually, our stores, I would argue, are more important than ever before. In fact, they're doing more volume than they ever have before. Stores are not just a place that people go to shop. They actually serve as delivery nodes for us, and we have 5,000 delivery nodes in the United States that are located within 10 miles of 90% of America. We would not be able to deliver the amount of units that we do within 30 minutes or the same day if we did not have those stores. So we forward deploy inventory to those stores to be able to better serve our customers and members. So I would argue that stores are perhaps one of our greatest assets.
John David, one of the touch points that we keep coming back to, we have all summer long when we hear from corporates, is a comment from you back in June when you said that shoppers were buying fewer than 10 gallons on fill-ups on average for the first time since 22. You said it was an indication of stress. Has that gotten better or worse?
It's marginally increased. It's just above 10 gallons right now, Carl. So we continue to see some stress on the consumer. And if you just take the second quarter as an example and you go month by month, in June we saw gas prices tick up above $4 a gallon, and I think there's some psychological perhaps impact to that. And we certainly saw among our customers and members that they were more choiceful during that period of time, that they're seemingly making trade-offs because their wallets are stretched. It's why it's so important for us, though, to lean into low prices. And we said we've reinvested a lot of these tariff refunds into lower prices. Right now we have 11,000 rollbacks for our customers. And so we want to be there for value for them and also convenience. Importantly, though, Carl, we're gaining market share. Our market share gains in food in the most recent period were some of the strongest that they've been in a long time.
John David, it's David. Back to the pharmacy for a moment. The headwinds you described from the national legislation dealing with drug prices, is that one time in nature, or is it going to extend for a few more quarters until, I guess, you potentially lap those price decreases?
It will extend. There were 10 drugs that were announced this year that were impacted, and there's a bit of a Pareto to this. So the highest volume drugs were some of the first ones that were impacted. David, we've also seen, though, there's been an acceleration in some of the brand to generic conversion in anticipation of what comes next year. I think there's 15 more drugs that will be impacted next year. They're not the same volume of the drugs that we see this year, but we've got to go through this. But here's the thing. I think it would be a mistake to conflate some of these near-term headwinds with a change in the strength of our business overall.
Okay, and what about those who are going to talk about your quarter being a reflection of weakness of the overall consumer? How do you see it?
Yeah, the consumer, as I indicated, we can tell they are more challenged, more pressured than they were at the beginning of the year, but I think that in some ways is kind of stating the obvious with higher gas prices, but they continue to be very resilient. It's amazed me at how consistent that they've been, and while they're making choices, they're still spending. And a good indication for us is back to college and back to school. Right behind me, I have some of our assortment that we're offering to our customers and members. Back to school this year is happening about a week later for much of the country, so it's probably too early to get a read on that. But to be clear, we sell about half of the industry's school supplies, so we're a pretty good indicator of what's going on there. Back to college, however, went exceedingly well for us. Things like dorm decor and areas like that were really strong. So we're encouraged about the next couple weeks and what's going to happen in back to school.
Yeah, Target said the same thing. Although, we started the show, John David, talking about the price of oil. With Brent back to 94 and WTI, it passed $86 a barrel. I know you mentioned the rollbacks and how you're investing the tariff refunds in lower prices, but how sustainable are those lower prices for consumers and your own costs if oil prices stay elevated or march higher?
I think that's every company's and frankly consumers' concern right now. There's a limit to what companies can absorb. For us, we expect this year to absorb about $2 billion of incremental fuel costs. We've done our best to try to handle that within the mechanisms that we have to offset that, but higher prices is likely going to translate into, higher oil prices is likely going to translate into higher prices for the consumer if it sustains at this level.
Just because of the cost inflation is too much when it comes to transportation and everything else?
Exactly. And what we've seen in our business is like...
Okay, I'm thinking about it now, Dollar Bill. I am in the trade. I repeat, I'm in the trade. Also, let me show the controlled selling algo now that I'm a part of. Looking to make my bones with. Okay. Dollar Bill says short trade is on for him as well. Let me get him a phone. Dollar Bill, look at the chat. If you give me a call, Dollar Bill, this way both of us can be on air. Is this charged up? Did it come on? Dollar Bill, what you looking at for take profit? If you don't mind, sir. 760.5. Likewise, been a minute. Dollar Bill, what are you looking at as far as a profit target? As far as the equivalent on the SPY? Jesse Swanson. You know it's not going to be easy. That's not bad. Bouncing back to the top of the algo, that's to be expected. The market never goes directly to your profit target. Jesse said he's looking for an entry on that put also. Now I need to get to the top of the algo. I'm gonna look for a nice rejection. Would be good for you, Jesse. But right now on the larger time frame, we have a flip on the 15-minute chart from red to green, which is really not ideal. But we do have a flip from red to green on the 15, but on the 30-minute chart, she's still holding red, which is why we refer to the larger time frame.
And that certainly does change the composition of the investment grade market. Clearly, the supply coming due also is going to change the composition of how investors react to the AI trade. But at the moment, it's really about that fiscal and monetary interplay.
So what do you think happens next? Do you think yields just continue to march higher?
I think it will ebb and flow. I mean, we've seen this story before over the last couple of years as we have had investors more and less concerned about the fiscal backdrop. It's going to be something that continues to create some volatility at the long end of the curve. And we have said for a long time, there's going to be a floor at the long end of the curve because of all of these different factors when we think about where yields go.
Do you think the dollar, I mean, do you worry about the dollar weakness in all this? I highlighted that as a potential risk and fallout, but also could perpetuate inflation and make it harder.
We did see a sharp move in the dollar yesterday with yields, and yet you're starting to see some of that reverse out a bit. And ultimately, if we think about the dollar longer term, we do still feel like it is slightly overvalued relative to its long-term trajectory. We are in this higher point of the cycle, and you have this competing force where if the Fed does decide to hike rates or keeps making overtures about rate hikes, that can push the dollar higher. And I think that what we've also seen over the last 2 years is that the staying power of people fearing the U.S. and selling America isn't all that sticky. So you've seen the dollar really defy that dynamic in the beginning of the year compared to last year. I think that's going to continue to be at play.
So you're
as well.
not worried about like big weakness here?
Not necessarily, not from that sentiment perspective, but it again adds another element of volatility to not only the treasury market but also the dollar.
There's also the question of whether weaker data would help. Economic surprise index has kind of tumbled and yields have gone the other way. Pretty big divergence there. Would you expect at some point yields to say, wait a minute, negative jobs, weak retail sales, tame CPI, and put some of that together?
You might see that on the 10-year and more in the belly of the curve, but the challenge still is what is the Fed going to do? What are they going to say in terms of what their reaction function is at Jackson Hole? Because ultimately, while the market is still pricing in modest hikes, I'm not quite sure you're going to see that this year for a couple of reasons. You have seen that weaker data that you've alluded to. I also don't know just mechanically if you have the votes. Yes, you have 3 dissents that you got from the last meeting, but a lot of these are regional bank presidents that are going to rotate. So if you have things like the midterms coming up that forestall a hike, if you have some of this reaction function very much hinging on longer term meaty existential questions and task forces, the longer that gets pushed out potentially into next year, you may not have that critical mass to have 3 become the majority.
But then does inflation fall by itself?
It probably doesn't fall by itself in and of itself, because what we see, even when we strip out energy, let's say that zeroes out, we're still seeing 2.5% inflation is probably closer to the resting rate. But if we think about some of the forces next year that could bring us closer to 2%, we still have rental vacancies near a 10-year high, could take some gas out of shelter. Tariffs on average this year a little bit lighter in terms of that overall tariff rate than last year. And the wage growth story is still a big one where it's been moderating. So those can help us. The question is, does that get us to 2% or do we still get stuck at 2.5%?
Right. And we'll talk maybe another time about how equities have reacted to all of this. It's been pretty interesting. Mira, thanks so much. Good to see you. Still to come, California AG Rob Bonta at the center of 2 big cases, including the Meta child safety trial and Paramount's deal to buy a WBD. Later on, CNBC learning new details about OpenAI's IPO plans, what Sarah Friar told employees. And of course, do not miss the Treasury Secretary, his first interview since Treasury announced that intervention aimed at easing pressure on long-dated government debt. Sarah's got that at the top of the hour. Sorry, guys.
Alrighty, team. Still holding on to this put. Came very close to getting stopped out. But in fact, the Bears managed to put in a lower high. Now, the thing that I like about that is with such a very strong push by the Bulls, if it fails, oh my goodness, then every last single one of those Bulls have to now run to the gate and cover. That will absolutely push us below that 764.8 area. And that is a very possible area for me to add at. Again, we're dealing with if and then. Again, still in that put. Market just put in a lower high, waiting for that 1030 candle to come upon us. As we are back red on the 30-minute candle, referring to the larger time frame. Still very close to being stopped out, nonetheless. But give them the market opportunity to do what it does. My job was to set the parameters in which I would trade in, and I've done that.
Stocks pulling back a little bit as Treasury yields and oil prices rise. Time now for CNBC News Update. Leslie Pick.
All right, I also want to show you guys my trading view algo as well. This is what it's looking like on the diagram. This is what it's looking like on the diagram. Looking to see if we could get into this area. That is why I called this 766. But I did get in this way early. But that's cool. 766 put. 764 entry, taking it to the 760.5 for the first profit target. So I did at least stick to that profit target, and I have moved it down to the 760.5 for my profit target. So with me doing that, I'm gonna just leave it as it is. I mean, I'm gonna let it do what it does.
California Attorney General Rob Bonta is taking on two of the biggest names in media and technology. His office leading a coalition of states suing to block Paramount Skydance's acquisition of Warner Brothers Discovery, arguing the deal would reduce competition and raise prices. At the same time, Bonta facing off with Meta. It's a landmark trial over the alleged impact of Facebook and Instagram on young users. Joining us now to discuss these cases, California Attorney General Rob Bonta. Good to have you on CNBC, Attorney General. I've been covering the Paramount deal since it was a glimmer in, or I should say the Warner Brothers deal, since it was a glimmer in David Ellison's eye. You know, love to start there if I can with you. I think it's 68 global regulators have, including our own DOJ, have said they do not see the deal as anti-competitive. You and obviously 11 other attorneys general see that differently. Why are you right and all those other global regulators wrong?
Yeah, well, the foreign regulators that Paramount likes to talk about are looking at this case from the perspective of their countries, their region. They're looking at different laws in a different market, in a different geographic region. None of them have looked at the impact on the American economy, which is what we're looking at. Of course, the US DOJ presumably looked at this case, but we all have seen the stories about the career antitrust division attorneys who wanted to actually recommend that a case be brought here, but were overridden by the Trump White House. And we've seen how the Trump White House has gotten involved improperly, in my humble opinion, with respect to Ticketmaster Live Nation, with a very weak settlement there. We continue to win on to trial and got a jury verdict in the Nexstar Technic case. They wanted that merger to go through. We've already blocked that merger. So we are the ones who've looked at this from a straight up law and facts perspective in the American economy under American law, under Clayton Act Section 7, which applies here, an antitrust law that's been on the books for over a century. And it's just a straight up meat and potatoes, black and white, bread and butter.
Yeah, well, let's go to that. Why do you believe it? Why do you believe it's black and white? I guess I'd ask on two different fronts, which are key to your contentions. One, obviously, dominance in the production of blockbuster movies and distribution of those movies, and the other. We can start there, actually, on cable. I think you've said if these two entertainment titans merge, and I'm quoting here, they'll be a behemoth. They'll own 50 of the most sought-after channels in America, from children's program to late-night programming to sports and news. And you say a structural remedy would be needed here. A suite of cable channels would need to be owned by another owner other than Paramount Warner Brothers.
Right.
Your market definition, Mr. Attorney General, does not include streaming. It doesn't include YouTube. And I wonder how you can do that when only 20% of TV viewing is actually cable.
Dollar Bill says SPY and QQQ is choppy right now at present. Checking in the gold futures. Be back in a little bit. Alrighty. Thank you for stopping by, Dollar Bill. Appreciate your teammate. Dollar Bill. Market is clearly, and this is the larger time frame I'm looking at, the 15-minute chart right now. But
competition for cable.
Yeah, and I was referring to Project El Mary there.
Yes.
Because we do think we will succeed because the court has already said we are likely to win this case when it's all said and done. When the judge issued our temporary restraining order blocking this merger, that's one of the elements that we are likely to succeed. She looked at the three markets. She heard from the very fancy attorneys, many of them from many big firms across the country that Paramount Warner Brothers have, and she rejected their arguments. She rejected this very argument, David, that the streaming market is somehow not being considered, and she sided with us. So yes, we do feel that
Understood, but I mean, a TRO, right? A TRO does not necessarily tell us exactly what's going to happen in court. I would assume your own lawyers are advising you that, listen, this is not the easiest case for you to prove. And to go to movies, for example, I mean, how, when you've got, let's see, AMC, Regal, and Cinemark, roughly 60% of U.S. ticket sales, all on record supporting this deal, who are you protecting by opposing it?
Well, many people, workers who would lose their jobs and have their wages lowered, consumers who would pay satellite and cable bills and go to the movies and would have to pay more just to watch a basic cable channel at home or to go to the movies on a Friday night for a special occasion. Cinema United opposed this merger.
Although they said yesterday that they want to see a settlement, didn't they? I believe they did.
They want us to consider a settlement, and that's not news. We're always open to and willing to, actually prefer to resolve our disputes in the boardroom instead of the courtroom. But they ask for a whole lot of conditions. They do not want the merger approved as is. Just take it as Paramount Warner Brothers are proposing it. They want a whole bunch of protections, and that's not an inappropriate thing to request. And if we ever do get into good faith, sincere settlement discussions, we will consider that. But we're protecting the environment, the economy from being rigged and making sure it's free and fair.
I wanted to get to the idea of settlement. I mean, what's it going to take? You've said on the record many times you would want a structural remedy, not behavioral. You don't believe their claims that they're going to make 30 movies a year, although those exhibitors I just mentioned certainly believe that they will, in fact, produce 30 a year. What's it going to take to get you in a room with Paramount and try to figure this thing out?
Really robust structural remedies that address the markets, the three markets that we have set forth in our complaint. You know, unfortunately, Paramount Warner Brothers have seemingly wanted to talk about everything except for what this case is about. They want to talk about the streaming market, which we don't allege in our complaint. They want to talk about CNN, which is not a focus of our complaint. They want to talk about the foreign regulators. We want to talk about the three markets that we set forth in our complaint where we think there's an antitrust violation. If they really want to engage, propose structural remedies, keeping different corporate entities separate instead of behavioral remedies that have proven historically not to be enforceable. You know, just look at Fox, they're making half the movies that they used to make and cut a bunch of jobs. Then we're open to those conversations and happy to have a...
Speaking of jobs, though, I do wonder, because I can imagine a number of different scenarios. One is that you prevail and that Warner Brothers goes on, and, you know, a lot of that company is cable. It's not... They will argue differently, perhaps, but you could argue it wouldn't be as strong as it would be together with Paramount and Paramount as well. There is a scenario under which, if you are successful, they still are forced to cut jobs. And there's a scenario under which, by the way, even if you aren't, if we were to take Mr. Ellison seriously, or at least some of the threats that we've heard, that they will move out of the state of California. I mean, how are you viewing that as a state regulator, the prospect that you say you're protecting jobs or trying to, but at the same time, conceivably, your opposition could result in a loss of jobs?
Well, LA County just released an economic study yesterday that said that this merger, if it consummates, would cost 4,500 jobs, from that to up to north of 10,000 jobs lost because of the merger. If the merger goes through, and it would result in almost $3 billion in lost economic activity. So the merger is the threat to the economy, and this invented, manufactured attempt to put leverage on us. I called it blackmail. I still call it blackmail, where Mr. Ellison claimed that he would...
Why would it be blackmail?
That's his choice.
I know they're a California company. They're a California company. You're coming after them, and I can understand it. By the way, the key equity holder here is Larry Ellison. He's a pretty tough guy as well. I can understand why they would say, hey, we're being attacked. We're a huge employer in the state of California. We're obviously not at home here. Why is that blackmail?
Because they're saying if you dare to enforce the law against us and make sure that we comply with the law, we're going to pick up our ball a little bit. And they're trying to say, don't sue us. Drop this case. Do what we want. Allow us to merge unlawfully. We're not going to do that. We're never going to do that. Of course, we want them
It
to
doesn't- it just
thrive
doesn't
and
sound-
have
I mean,
jobs in California, but they cannot
Yeah.
break the law. No one can, and the law is good for business. When you can have property rights and contractual rights and go to court to if you've been wronged, that's good for business.
Right. Of course, they would say that the trial date being so far out, the inability to actually bring about the synergies they need to make this a successful combination that would conceivably keep jobs, if not add them, is all being hurt by your opposition. And you say,
I say the trial date is moving at lightning speed. This is all completely predictable. They knew we were investigating them. They knew we might bring a lawsuit. We filed a lawsuit 5 weeks ago, and the trial will end in March. That's 8 months. That's like lightning speed when it comes to litigation. My Meta
Yeah.
case took 3 years to get to court. They're going to get it in a brief 8 months. And they're the ones that chose the ticking fee. They're the ones that chose the breakup fee. They did that to themselves. So they're lying in their own bed. We had nothing to do with it. We didn't ask for those things. So if they feel pressure, it's on them. We just want to bring our straight antitrust case.
and to those who would simply say, Attorney General, that really what you're trying to do here is enhance your own political profile and that no settlement will happen because fighting for you is winning, what is your response?
Yeah, we do antitrust enforcement all the time. We do it when people are looking sometimes, most of the time when they're not looking. We had a Ticketmaster Live Nation case. We have Nexstar, Tegna. We're bringing a case against Amazon. We've done this in the meat packing and the concrete industry when no one's looking and no one cares. We protect the economy all the time. The fact that some people are focused on this is honestly, it's just random. Some people like it. Some people don't like it. I don't care what people think. I care about the law.
You don't sound like a man who's ready to settle to me. I'll say that.
What's that?
You don't sound like a man who's ready to settle to me. Is there any chance that you're a coalition splinters? I know they're trying to peel off some of the other AGs.
No, we're in lockstep. We're working together. All 12 of us have worked together, brought this case. We're going to continue to stick together. That's how we roll. That's how we do it. But I will say that coming to the table has always been on the table. And if Mr. Ellison and Paramount want to come to the table in good faith and talk, we want to talk too. We're happy to have that conversation. Again, we do prefer to resolve cases in the boardroom instead of the courtroom. But for now, we're bringing our case, and I hope they can focus on the actual allegations we make in our complaint instead of the way they seem to politicize it by talking about all sorts of things that don't relate to the case.
All right. Well, speaking of the courtroom, I know my colleague Sarah has a question actually on a case in court right now. Of course, that being
Yeah, you mentioned it. It's on. High stakes child safety trial. I think that we're all watching this one, Mr. Attorney General. They deny that Facebook and Instagram had the intent, of hooking young users and misusing their data. What evidence do you think you have to win this case?
Their own employees saying the opposite. Their own studies acknowledging that they looked at the features that they were creating and knew that they had compulsive, excessive outcomes when it comes to children's use. They deliberately designed and deployed dangerous features that they knew would maximize duration of use, frequency of use for kids, and would lead to mental health harm. And they did it anyway. And it went to the very top. Mr. Zuckerberg himself advanced a beauty filter, which his own team told him he shouldn't deploy because it would hurt the mental health of kids, including girls. And he said, green light, do it anyway. So we had a whistleblower who was in charge of safety in Meta. He was our first witness, and he was devastating for them because he told the opposite of their claims. He said that they knew about the harms, they doubled down on them, they did them anyway, and then they went on to lie to the public, trying to tell the public that these
this is the don't ask, don't tell testimony. So if you win this case, what are you seeking? Because you said it's not necessarily about damages. What changes, concrete changes, will Facebook and Instagram have to make to make it safer for kids and mental health if you prevail?
The chief remedy that we're seeking here and that we seek in most of our cases is a change in business practices, a change in practices so that they're no longer harming kids. Here's what a few of them can be. A limit of 1 hour per day for use for a child, unless and until a parent overrides that 1 hour. Another possible change is blocking use during the hours of midnight to 6 a.m. when kids should be sleeping and preparing for school the next day. It could also be real robust age gating so that kids under 13 that Meta has collected data for and improperly used in violation of federal law are not allowed on the platform. Those are three things that I think would be very appropriate changes. And also just not lying to the world, to the public, about the harm of their products. They wrongly claimed in Congress and other forums that their products are safe when they knew from their own internal studies, their own employees, that they were dangerous.
You know, finally, A.G. Bonnet, it does occur to me that some would say you're protecting big tech on one side and attacking it on another. On Paramount, conceivably, you're doing the favor to Netflix and to Alphabet with YouTube and to Amazon. How do you respond to that?
We're just applying the law and the facts in each case. And when it comes to Paramount and Warner Brothers, we believe they're breaking the law. We've made our case. The judge agrees with us. They're violating antitrust law. When it comes to Meta, they're violating unfair competition law, false advertising law, and COPA, the federal law that protects kids' privacy under 13. These are just straight up black and white cases where we apply the law and the facts. No one can break the law. Following the law is good for business, and we are pro-law and pro-business. We're mostly pro-businesses that follow the law. Meta and Paramount Warner Brothers have both broken the law. We're holding them to account in court.
All right, well, we'll see. Of course, that will be decided in court, but certainly we'll be following it closely and very much appreciate your taking the time. Thank you.
A pleasure. Thanks for having me.
All right, up next, CNBC learning some new details about OpenAI's IPO plans, what CFO Sarah Friar told employees. Plus, coming up next hour, don't miss St. Louis Fed President Alberto Musalem arguing the Fed should have raised rates at its last meeting. We'll debate that.
If market uncertainty has you concerned, options may be the way to go. We'll talk to one portfolio manager who says it could be time to hedge against a sudden market shock. Find out what you need to know to protect your portfolio today on our Market Navigator segment at 2 p.m. Eastern on Power Lunch.
Welcome back. CNBC learning some new details about OpenAI's IPO plans. Kate Rooney helped break that story and joins us this morning. Morning, Kate.
Hey, Carl. Yeah, so from what I've been hearing, OpenAI CFO Sarah Friar did tell employees yesterday that the AI giant will be a public company in 2027 or even sooner, possibly. This was at a company all-hands meeting yesterday afternoon here in San Francisco. I spoke to two sources that were in the room and attended that meeting. Friar did first acknowledge rival Anthropic. She said there is a chance that their biggest competitor does go public. She mentioned September as a possible timeline. Friar saying to employees, that's okay. She said, we're running our own race. The IPO, she described it, not a finish line. She called it a milestone. And another fundraise, also pointed to the $122 billion record fundraise they did back in March, said that gives us, quote, flexibility, and then said we will be a public company, as I mentioned, in 2027. Also added that we may go sooner if our business continues to inflect, but either way, we'll do it on our own timelines. She also shared some new quarter-to-date revenue numbers with employees. Revenue run rate grew about 35% quarter-to-date. Enterprise revenue up about 50% in the current quarter, and then Codex hit 20 million users. That was up about 3.5x. Again, according to sources, the growth here does coincide with OpenAI's latest model that was released this summer. And Friar didn't explicitly mention the Wall Street Journal report that came out earlier in the day yesterday, but the Journal did have some Q2 numbers for OpenAI that did show widening losses, slower revenue growth, at least compared to Anthropic. So that's an important backdrop to that messaging, guys.
Yeah, inflect obviously also being an important word, I guess they use there. Kate, thank you. Kate Rooney. Meantime, we've got some big moves in crypto. Let's get to Oliver Rennick at the CBOE in Chicago. He's got to look at what the options market is signaling. Oliver.
Hey, David, after posting one of its worst years ever versus stocks through this summer, it's looking like the best setup arguably for crypto and Bitcoin in a long time. Bitcoin volatility hit a year-to-date low last Friday, which should add to the appeal of buying crypto-related options right now on top of some positive news flow. Volume in the IBIT ETF is over 5.5 times the 30-day average today, with traders buying more than 4 times as many calls as puts, and 85% of IBIT premium on the call side. The top 14 of 15 trades by volume are all calls, a very rare thing to see, but arguably fits the crypto narrative if you think Bitcoin should be responsive to bond market intervention by the Treasury. Then there was the statement from President Trump yesterday that the SEC is working to make decentralized exchange hyperliquid accessible to U.S. traders. Options trading is also exploding in hyperliquid strategies, ticker PER, up 185% this year. It's the Treasury company that invests in the HYPE token, and it's basically all calls that we're seeing, though some that came early and with a suspicious amount of conviction yesterday. But the biggest dollar amount trades went off yesterday afternoon and continues this morning, guys.
Okay, thank you very much, Oliver Rennick in Chicago. St. Louis Fed President Alberto Musalem is coming up in just a few minutes, arguing the Fed should have hiked rates at its last meeting. Plus, an exclusive with the Treasury Secretary, Scott Bessent, his first interview since intervening in the bond market, announcing more buybacks. That's next when Squawk on the Street comes right back. Good morning again. Welcome back to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla live from Post 9 of the New York Stock Exchange. Today, Treasury Secretary Scott Bessent joins us exclusively in just a moment. His first interview since the Treasury announced new buybacks in the bond market and intervention this week.
Then St. Louis Fed President Alberto Musalem joins us in an exclusive interview. Why he says the Fed probably should have hiked back in July.
Let's start, though, with this bond move. Yields are rebounding today after the Treasury increased its buyback limit on longer-dated securities yesterday. And joining us now in a CNBC exclusive interview to discuss is Treasury Secretary Scott Bessent. Secretary Bessent, welcome back. It's good to see you.
Sarah, good morning. Good to see you.
So talk us through what you were trying to do here by announcing the increased size of the buybacks.
Yeah, we're trying to signal that we think that this is a thinly traded area of the market, that we're in August, and there's been a lot of corporate issuance that's influenced the market, and we believe that there are many underlying factors that the market is not looking at, and we are going to make a market in these. We routinely do buybacks, and we're going to increase the size of the buyback. And Sarah, I would note that it could be more than the $4 billion per issue.
Yeah, I was going to ask how big this could get. If the signal here is that you're not happy with the direction of yields, they've gone back the other way. We've erased most of the Treasury rally that you got yesterday with that big surprise. So how much more are you willing to do?
Well, again, we have a big toolkit, so we'll see. And part of it is signaling here and to show that we believe that the yields don't reflect the underlying fundamentals. This Iran conflict, we will get on the other side of this. We don't know when, and we can talk about the economic measures we're going to be taking against Iran in a minute.
Sure.
We believe that the liquidity, especially in the 30-year point, is very poor. And we are, in the administration, we are announcing probably at the end of this week, beginning of next week, an increased focus on fiscal consolidation. And it's coming from President Trump. Russ Vought and myself will be examining both on the revenue side and the cost side what we can do.
Yeah, because that's where I was going to go and where a lot of the analysis is focused, as you know, Mr. Secretary, which is, strong signal from the administration on the buybacks, but, the fundamentals are ultimately what is going to prevail here in the bond market, and the fundamentals are hard to ignore when it comes to the size of our debt, with public debt increasing to now $40 trillion.
Yeah, I mean, look, Sarah, there's nothing magic about the 40 trillion number, and we can grow our way out of that. So, but what we do want to signal is I think that there's been a lot of misinformation in terms of what's going on with the deficit, what's going on with the deficit to GDP. We actually had a fiscal consolidation for the calendar year 2025. We were at about 5.7% of GDP, and one of the things that's temporary here that's influencing the deficit has been these tariff refunds, and we won't have to do that again. And the Ambassador Greer, through the 301 process, is re-implementing the same level of tariffs, and I would expect that our 2026 tariff income is going to be roughly what it was in 25, and we're going to be able to keep that in terms of the budget consolidation. The other big item in the budget that we're seeing is the hit that we're taking from to revenues for the immediate expensing of factories and of equipment and farm structures. And I think that if people sit back and think that's not government spending, that is actually an investment in the future, and we're increasing the tax base. And that is what measures the wealth of a nation, is the ability to increase after-tax return on capital. So we're pulling back think of it as pulling back the slingshot here. We have a lot of potential energy that will turn into kinetic energy during this year, next year, as these factories come online.
So do you think we've seen peak deficit during this administration?
I think a very, very good chance we have. That we are going to be laser focused, as I said, OMB Director Vought, myself, the President, That combined with the Vice President's fraud task force, where I think we could save several $100 billion.
Yeah. I mean, because the funding needs, I think, are daunting to a lot of folks. The dependence on foreign bondholders, for instance, we saw the intervention in the Japanese yen, and that's erased a lot of the progress there. And so there are kind of all these worries at once about what's going to happen ultimately with these holders of treasuries.
Again, people have bad information. I have asymmetric information. So, I think that the market should think, well, why would we have joined the Japanese in the intervention at this time? Do we know something the market doesn't know? That in terms of being willing to do what I would call a treasury twist here, in terms of the bond market, what do I know that the market doesn't know? So, I think the market's probably gotten a little ahead of itself. A lot of people, not much to do in August.
Well, does it tie Kevin Warsh's hand, your newly instated Fed chairman, who signaled?
Why would it do that?
Well, just if he does need to raise interest rates because inflation is above target, or trim the balance sheet, as he said, that would work against what you guys are trying to do here with long-term rates.
I think that the Treasury and the Fed would work together if there was any change in the balance sheet, and we would adjust to any kind of runoff that they're doing.
Got it. And what about on rates? What if they have to raise interest rates? Wouldn't that be problematic?
That has nothing to do with the decision that I announced this week on the buybacks.
Okay, but inflation, you mentioned oil and Iran, and I do wonder how much, it's hard to fight it. Right now we have Brent back to 94, and that's putting pressure on bonds with yields higher, the inflationary outlook because of oil. I mean, we thought it was going to be temporary, but now we're, almost 6 months out here into this war.
Well, again, this is headline inflation. What we're seeing in core inflation, both in goods and services, is down, and that's what matters. We're seeing the wage increase, especially in a lot of the hospitality sectors, come down. We are seeing that the bottom 25% of Americans get good wage increases, but that's being contrasted by the top earners. So the wage inflation has come down, and the core inflation is down. We had the biggest decrease in pharma prices, I think, in history since we've been measuring the sequence. So, the underlying factors, other than energy, and there is no, we aren't seeing anything that says that the second order effects are spilling over into core inflation. As a matter of fact, in the past weeks, we are seeing the 5-year, and any inflation markers is telling us that inflation is going to be lower in the future.
So that raises the question about what happens next in Iran. And you mentioned the president last night said that there's more economic pressure coming on Iran. I know you're heavily involved in this and executing this. What can we expect here?
Yeah, you're going to expect, I'll be holding a press conference on Monday to talk about exactly what we're going to do. And again, we have asymmetric information, and I'm not sure why oil has popped up on this, because this, for now, and it is at the president's discretion, if we are doing the maximum economic pressure, then that means that likely there will not be a large-scale kinetic restart, but I would emphasize that is for now. And look, we do have control of the strait. You would have seen media reports that large amounts of energy are getting out, and I think that we can continue doing that in the southern lane, and that I think oil markets are misinterpreting what this economic pressure means. The economic pressure means that we are going to all of our allies, and this is going to be the greatest coordinated economic isolation in the history of the world, and we are going to them and saying, you are either with us or against us. You want this murderous regime to end, and if you insist on doing business with them, either transferring money, buying their oil, they're doing seaborne ship transfers, then the U.S. Treasury and the U.S. government they will put its full might and force toward enforcing against you. So it is time for our allies and the rest of the world to make a decision, and we are going to squash the economy of this murderous regime, which that will curtail their ability to project power through their proxies. It will mean that they cannot pay the military, and we have substantial inflation, both food inflation and ordinary inflation in Iran. And what we have seen, I see lots of reports that said, oh, well, this has never worked. It does work because we have a combination. It is a 1-2 punch. We have the blockade, and we are going to have the toughest sanctions in history. And I will tell you, this will work. It worked in Venezuela once we put up the blockade. It is working in Cuba right now, and it is going to work in Iran, and we are going to collapse this regime.
Does it include China? Because that's the primary economic partner of Iran.
Again, many conversations are best to have in private, and we are confident that everyone wants the Strait reopened and for energy prices to come back down. And Sarah, keep in mind that the Chinese get 50%, 50, the other energy from the Gulf. So it would do them a big service to get with the program.
I just wanted to get your read on the economy as we see oil prices marching higher again. We have seen tremendous resilience, as you noted, from the consumer, but there are signs that the job market may be cracking a little bit. Got a weak job report last month. I'm curious about your assessment as to how much we can handle all of this.
I think the jobs numbers are quite noisy, and again, Sarah, the other thing that's important too is like the jobs that we're seeing are going to Americans. After the deportations that we've seen during President Trump's administration and the closing of the border, that this unfettered migration, we don't need to produce as many jobs. And what's really important here is we are seeing a manufacturing renaissance. And that is shown. We're seeing construction jobs pick up, and that is morphing into manufacturing jobs. Some of these numbers, the manufacturing construction numbers, are the highest they've been in 15 years, and that is a combination of the president's trade policy, tax policy, and energy policy.
Yeah, I mean, I think also just to follow up on what you were teasing in terms of an announcement with OMB about the debt. I mean, that seems like it could be a very big deal. Is there anything more you can tell us about what OMB's role would be here and the signal that you're trying to send for the markets?
Well, Sarah, what I can tell you is that Director Vogt, who had the same position in the president's first term, knows more about the intricacies of the budget, where we can cut back, where a lot of these programs that are being given to the states and the money's being frittered away, where we can cut. And I think it's going to be a very exciting couple of weeks, a couple of months as we put this together.
The dollar's weakening also. I wanted to ask you about this. We've talked about the dollar together in the past, and it weakened sharply yesterday as well. And I wonder if you see that as a risk here also in making it harder to sort of control the long end of yields. I mean, if that could be inflationary, could be problematic.
No, Sarah, it's not really. The U.S. is a big service economy. We don't respond to the trade-weighted dollar. The dollar's been very, very stable. Our largest trading partners are Canada and Mexico. And again, the dollar had a big run. Now it's going back to where it was a couple months ago. But in terms of the inflation expectations, they actually went down.
Got it. So not concerned about that. Finally,
no, again, we continue to have a strong dollar policy, and the strong dollar policy is that the U.S. economy is pulling away from the rest of the world. When I look, we have 6.5% nominal growth, and the composition of that growth as the headline inflation comes down, and the Atlanta GDP now number is 4% for this quarter. That's a very noisy number, so don't quote me on that. But everything we're seeing in terms of revenue growth at companies up about 12%. So the underlying economy, I think, is very strong, and the only inflationary impulses that we're seeing are coming from the energy, which is temporary.
I'm so glad you mentioned growth because I know that that's on the top of your agenda. You're hosting G20 finance ministers and central bankers the week after next. I'll be there because I think this is a very big deal. The emphasis on economic growth. I'm curious if you can give us a little teaser about what we can expect and what your agenda is, because it feels different than I was looking at some of the agendas back in 2025. Climate was right up there. Back in 2024, financial inclusion was up there. It feels like it has a different vibe this year.
Well, we do, and I'll tell you that I didn't attend any of the G20 in South Africa because it did seem kind of a bit off message, and we want to bring the G20 back to its core mission, and that core mission is talking about what can countries do, economies do, how can we band together to have better global growth, and our message to our allies, our trading partners, is that global growth is the way to take care of this mountain of debt. As the U.S. growth has picked up, over time we will be well above the CBO trend average. Then we are encouraging the rest of the world to do this too. I'm pulling for Europe, but they need to follow the Draghi report. They have. They're mired in regulation and kind of intra-European. It's almost the equivalent of this burden that they put on themselves. And we think the rest of the world should kind of unshackle themselves, both on the energy side, on the regulatory side. A huge amount is on the regulatory side. And we want the world to grow. We think the biggest threat to financial stability with this mound of debt that was piled up during the COVID era is a lack of growth. So we are really pushing an American growth agenda for the rest of the world. We want the rest of the world to come along with us. It's going to be in a beautiful spot, Asheville, North Carolina, the Blue Ridge Mountains. Asheville's the comeback city after the terrible Hurricane Helene 2 years ago.
Yeah, I mean, growth solves a lot of problems, Secretary Bessent. And finally, the big headline is going to be, of course, on the big bond announcement. So you indicated at the top of the interview that you were willing to go bigger and do more if the market doesn't cooperate. How far are you willing to go?
Well, again, it's not if the market cooperates. It's, we'll see what the conditions are, and we will analyze them then. But I am confident that once the market sees through and looks at the fundamentals, all we're trying to do is get people to focus on the fundamentals and not trade the headlines during a quiet period in a thin market. So we are trying to keep the market in equilibrium, and we are also seeing big corporate issuance, and a lot of that corporate issuance, I would say, is almost yield agnostic, because the build out for AI, the returns on that, the companies believe they're going to be so high, they don't really care what they're paying. I actually think it's interesting that they're issuing such long-term debt. If I were sitting in the chief financial officer's seat, I would think about issuing more what's called the belly debt, kind of 5-year debt, because look, if we're going to see this incredible productivity growth from AI, that will naturally disinflate rates. So the thing that they are building is going to cause disinflation. It is causing a short-term competition for capital, but it is going to, we're going to see real productivity growth. We've been, I think the CBO projections, which are always wrong, are in the ones. Post-World War II has been about 2.1, and I don't see why our productivity growth couldn't be 2.5 or 3%, and that is what will create the economic growth and the disinflation.
Well, Secretary Bessent, we certainly appreciate the opportunity to ask some of these questions that we know that investors are asking and wondering about. So thank you for coming on and clarifying.
Good, Sarah. Thank you. Good to be with you.
Yeah, good to have you as always. That is the Treasury Secretary, Scott Bessent, joining us from outside the White House with a lot of information there, I thought, and a lot of news. First of all, I think the big signal that he gave on the bond market buybacks is they're willing to go further and do more, and he outlined the why, which is summer liquidity issues. They want to make sure that yields are matching up with fundamentals, and I think clearly he doesn't think that that is necessarily happening. He also said that he doesn't think that the market is interpreting oil-Iran developments and the economic pressure that they're about to turn on. Told us he's going to give a news conference on Monday about this, outlining sort of the full force of the U.S. government in terms of isolating anybody when it comes to doing business with Iran and isolating Iran, and he thinks that ultimately that will bring oil prices down while they have this, this 1-2 strategy of controlling the Strait of Hormuz. Also teased an announcement with the OMB when it comes to fighting debt. That's going to be on the agenda, and that he said we've seen peak deficits.
I think markets definitely wants to hear more about how you're going to save, as you said, several $100 billion. I will say, though, I mean, 10-year yield did drop right as your discussion began, and he did say they could go more than 4. But essentially, the yields are a little bit higher now than when you started talking to him 10 minutes ago.
Look, I mean, it's a big, widely traded market. I think that, something that we talked about a lot were the fundamentals. And, there's this narrative out there that, the fundamentals are going to make it hard for yields to come down because of the debt and deficits and because of the inflationary. And he really went deep on the fact that, from their point of view, the inflation is temporary and it's headline driven and it's supply driven, and it's driven by the war in Iran, and that they think that AI is going to be disinflationary and that the underlying trends are coming back down. And so he, I think, made it very clear that he thinks the market has it wrong, and he does have added credibility here because he's been there. He's been on the other side.
The one issue I had is when he was talking about asymmetric information, because 2 weeks ago he came on Squawk Box and said we were going to have an Iran deal the next day. It's been 2 weeks.
I think that it's reflective more of the partner that they're dealing with and that they're negotiating with Iran, which has been completely, stubborn and difficult when it comes to negotiation. But, the president has said as much, too, that they were close to a deal. And I think that they're just dealing with a very difficult and, as to quote the Treasury Secretary, murderous regime that is very difficult to make a deal with.
Whose political calculus is not like ours.
Correct.
Regarding their population. Fascinating discussion. We'll watch the market response when we come back. St. Louis Fed President Moussalm's with us exclusively. We'll talk about that interview, inflation, his outlook for the Fed.
Plus, Morgan Stanley's head of global real estate assets will join us. We're going to discuss 3 key mega trends driving real estate and infrastructure right now and where the investment opportunities are. We're back in a moment.
we believe that there are many underlying factors that the market is not looking at, and we are going to make a market in these. We routinely do buybacks, and we're going to increase the size of the buyback. And Sarah, I would note that it could be more than the $4 billion per issue.
The key words from Treasury Secretary Scott Bessent just moments ago, joining us exclusively, explaining the big decision that had a big impact on the markets yesterday to increase the size of bond buybacks at the long end of the curve. Said he was responding to liquidity issues in the summer months and trying to signal that they want sort of yields to, my words, behave or cooperate more. He didn't like the word cooperate. Joining us now to talk more about the bond market and the economic outlook and inflation. Another exclusive. We've got St. Louis Fed President Alberto Musalem here at Post 9. Also joining us is Steve Leisman, who covers the Fed for us. President Musalem, it's great to have you. Welcome.
Good morning. Thanks for having me.
How do you interpret what's going on in the bond market right now?
We monitor the bond market all the time, like any other variable. My sense is nominal growth is pretty strong. It's around 6% now. My sense is there's a competition for capital happening from government financing, gross government financing, plus the AI build-out, which is being financed in the U.S. and globally now. And I think those two things are moving the bond market. Interestingly, inflation expectations are anchored. Fed credibility is not in question. And so I observe that it's mostly term premium rising, real term premium.
If the Treasury is doing this kind of intervention in the bond market, does it make it harder for you guys to talk about raising interest rates and going against what they're trying to do?
No, we focus very simply on the labor market and on inflation. We independently set monetary policy independent of debt management or fiscal policy.
Okay, I knew you were going to say that, but I had to ask anyway. So you don't have a vote during this term, but you would have voted for a rate hike at the last meeting?
Yeah, my sense is that real interest rates or monetary policy is neutral or accommodative here. When I look at the real policy rate, it is below where the committee believes the neutral long-run rate ought to be. Our policy rate is also in real terms below market real interest rates, which, as you said, are rising for the reasons we just discussed. And when I look at financial conditions, whether you look at prices or quantities of financing, financial conditions are pretty accommodative here.
So inflation is the problem.
So when I go around my district and I talk to households, businesses, and governments, the number one concern they have right now is inflation. We see that real incomes, real disposable incomes, that is, of households, are not growing very robustly, in part because of inflation. We see households dipping into their savings rates is coming down. We see households dipping into HELOCs and into wealth effects to finance consumption. Businesses are facing high input costs, non-labor input costs, and occasionally we hear of a local government that's having to contract with suppliers with shortening contracts, sometimes with inflation indexation keys in there. So inflation, is above target. Everybody can see that.
Yeah.
But there are other dynamics that are important to be aware of.
I guess my thing is that you don't want to raise interest rates, raise mortgage rates, and raise auto loans and everything like that if the inflationary problem is mainly tariffs and energy and oil prices, right? Because you can't do anything about those two things, and they very well could be temporary.
So my sense is that inflation is high for two reasons. We've had a sequence of supply shocks. We might have another supply shock in the fall with a super El Nino coming. And in addition to that, we have very persistent demand forces in the economy. The AI build directly into CapEx and investment, and indirectly through equity prices and wealth effects onto consumers. And we see sticky consumer price inflation. Going back to the last meeting, what I perceived is that with real rates below our long-run neutral, the probability that inflation would come back to target in 18 months, I'm looking at 18 months in the future, was lower than the probability that inflation would stay above target. So that was one reason why I supported the decision to raise rates. And the other reason is that I believe that earlier more gradual interest rate increases are preferable, better, less disruptive than later, potentially larger, potentially more abrupt increases.
Alberto, it sounds like you're making a really interesting argument. Like, forget inflation, because you look at the market pricing of inflation, the tip spreads, under control, expectations. But it's the higher growth rate, the higher term premium. In that world, and we know you have a long history in finance, so you know about this stuff better than certainly I do. In that world with higher term premium, higher growth, does the Fed need to respond with higher rates just for that reason, even apart from inflation?
I'd like to simplify it even further. Inflation, underlying inflation, once you strip out the supply shocks, so my team has done that work, is running between 2.5% and 3%, which is too high. We need to bring inflation back down to 2% over the next 18 months. So a level and a time frame. And that's as simple as it is without looking at term premia or growth calculations.
Well, you know where I'm going with this, because I want to make this more complicated. I want to talk about R-star, which is the idea that the neutral rate, because of what's going on, and it is crazy what's going on. We have never lived through $700 billion of AI investment, right? So that whole world, in that world, R-star is higher, and maybe the Fed funds rate, again, inflation being a given, and I understand what you're saying about that, maybe that needs to be higher.
So when you have a productivity increase, which we're having a productivity renaissance, not yet, excuse me, a productivity recovery, not yet a renaissance, so that should push R-star higher. And we have a very meaningful competition for capital, for sure. All that is putting upward pressure on real rates, and we're seeing that in markets. I guess your question was one of growth. And let me say this, the best thing we can do for growth at the Fed is to bring inflation back down to 2%. If we do that, we'll keep inflation expectations anchored. We'll support the real incomes of households and families, and we will keep the borrowing costs of households, businesses, and governments from rising.
I thought it was fascinating to hear the Secretary talk about corporate issuance and the AI-related debt and say it was basically yield agnostic. But he seemed to endorse the view that there is some crowding out on government treasuries. Others argue you look at some corporate spreads and it's not exactly true. They just might be happening at the same time. Do you come down on one side or the other?
I think there are some parts of the economy that may be crowded out by the competition for capital between governments and hyperscalers, the housing market, for example, and mortgages. Some small SME, small businesses. So there could be crowding out, not necessarily between the government and the hyperscalers, but of other sectors because of higher yields. That's a possibility, yes.
Did the jobs report in July change anything for you? Because that was weak.
So, the data so far, let me say this. I look at the hard data, I look at the soft data, I look at a lot of surveys that we do. We do a lot of outreach, so I meet with dozens of people before each meeting.
You
CEOs.
have all the data at the St. Louis Fed, Fred.
Well,
we use it every day.
All the Feds are data Feds. My point to you is that we really need to look at the mosaic of everything, put it together. It's not one data point that's going to change my view. The labor market data was a little weaker than expected. The revisions were a little lower. On the positive side, the unit labor costs, the employment cost indices suggest there's no inflation pressure coming from the labor market. So on the inflation side, we had some encouraging data. On the labor market side, we had weaker data, but there's a lot of seasonality there from state and local government, teacher employment, depending on which month it falls, that could distort the numbers.
I mean, you seem to still believe in forward guidance because you're here talking about your views on where rates should be. How do you think this is going to go down, the fact that this new chairman does not do forward guidance?
So I talked about the past, the last meeting. I didn't talk about the coming meeting.
Okay, you think we should raise it in September?
We can get to that in a minute. So I think forward guidance is useful when interest rates are at zero. We're not at zero right now. We're in a normal state of affairs where the federal funds rate is our primary tool. So I'm open-minded and okay with putting forward guidance aside. That said, there's a big difference between what forward guidance is, which is a commitment to a policy path, and actually communicating your framework. Your framework is about what your objectives are, what time frame you're going to achieve them in, and what are you going to do to get there. And it's well known that communicating the framework leads to better inflation outcomes, lower inflation outcomes, better transmission of policy. and it's good for democratic
So what is
accountability.
your framework for September?
So the way I'm seeing it is, well, I'll tell you my framework, which is different to a forward guidance,
Okay,
as
I
I just
can't
said.
keep track of.
Okay.
Okay.
My framework is 2% is our target. PC inflation is the index that we're targeting. When you have supply shocks, you have to look at core inflation. I want inflation to be back down to 2% within 18 months. The primary tool is the federal funds rate. The balance sheet is an auxiliary complementary tool. I have two scenarios for inflation. There are many scenarios, but I'll boil them down to two. One is that inflation comes down back to target, and one is that it stays elevated. As I said at the beginning, I think the probability that it stays elevated is higher right now than it comes back to target. So two scenarios, two probabilities, and therefore my policy recommendation and action was to raise the rate at last time, yeah. And I'll see how I'm going to revise that into the next meeting.
Feels like that's where you're going again.
Well, it depends. You know, we gather all this data I talked about at the beginning. We form a view. I form a view right into the meeting. Sometimes in the meeting, I learn tremendous amounts from my colleagues about arguments and positions and data and perspectives on the economy. And I never want to prejudge. I want to maintain open mind into every meeting.
Well, it's good to get a little window into how you're thinking about it. Thank you.
Thank you very much for having me.
It's good to see you here
Thank you.
in New York. And that is Alberto Musalem, the St. Louis Fed president.
When we come back, thanks, Steve. When we come back, Morgan Stanley's head of global real estate assets will join us. Why she says real estate is entering an upcycle right now. 10-year 471, that's a session high or awfully close. Stay with us. Welcome back. Major averages slightly lower this morning. Walmart is leading this move lower in the Dow. That's for the company's earnings guidance for the third quarter and the full year did miss estimates. Comp sales missing for the first time, we think, in more than 5 years. We talked to Walmart CFO John David Rainey last hour. This is what he said about the consumer.
We can tell they are more challenged, more pressured than they were at the beginning of the year. But I think that in some ways is kind of stating the obvious with higher gas prices. But they continue to be very resilient. It's amazed me at how consistent that they've been. And while they're making choices, they're still spending.
Down to almost 10% today. This will be the worst day, I think, going back to 22, and hasn't been below 100 since November, with a few bucks to spare.
But my takeaway from that interview is, despite some of the caution around the consumer, he said that first of all, the U.S. comp number was heavily influenced by the health and wellness. That's the pharmacy business, which is 10% of their business, which is influenced by the policy changes at the White House, part of the Inflation Reduction Act, lower prices for drugs. And if you take that out, he said the comp would have been over 3%. And
3.4.
Yeah, 3.4%. So they actually had a very strong quarter. Also, if you take out some of the impact of the tariff refunds, the profitability was way up as well. And so, I mean, it seemed like a little bit of a one-offs that he clarified. So it is interesting that it looks like the stock, I don't know, maybe they were looking for an excuse to pull back. It's been a big
we've
winner.
talked a long time about it, how it's been richly priced.
Yeah.
It also comes on the heels of Tapestry, Birkenstock, On Holdings, Advance Auto Parts today, some additional signs of a weakening consumer.
Yeah, I guess so. Although, some of these results have been good, but tough market. When it comes to investing in real estate, our next guest says we're entering an upcycle and sees an attractive entry point forming, telling investors to focus on 3 key megatrends: supply chains, AI, and aging demographics. Joining us here at Post 9 is Morgan Stanley's Global Head of Real Assets, Lauren Hochfelder. It's great to have you, Lauren.
So great to be with you.
Welcome. So talk about, when you say right now we're at an attractive entry point, what do you mean?
Well, we're sitting here at the New York Stock Exchange and looking at equities at all-time highs. In contrast, real estate's been in a recession for the longest time in 30 years. It's 4+ years in. Prices down 20+%, trading well below replacement cost for the first time really since the great financial crisis. So prices are cheap, but importantly, we see green shoots. We see supply coming down for the first time, really dramatically, down by 2/3. So supply down, cost of capital coming down, and capital flows coming up. Those are leading indicators.
And when you say real estate, you're speaking broadly? Are you speaking commercial, residential?
Yeah, you definitely need to bifurcate. So our highest conviction sectors are industrial, senior living, spaces tied to long-term structural megatrends.
And so Morgan Stanley's deploying money right now in those areas?
Yeah, across real assets. So we have a global real assets business that invests in real estate, infrastructure, equity, credit on a global basis. So we're very active, of course, here in the U.S., all across Asia and Europe as well.
What does the AI revolution have to do with real estate? Because some people think it's bearish because more AI, fewer white-collar jobs, fewer need for office buildings.
Yeah, isn't it
narrative.
ironic that the more digital we get, the more need for physical assets we have? Look, here's the reality is AI needs AI, a lot of infrastructure, and data centers are really just the tip of that iceberg. We are building power plants to help hyperscalers bring their own power, BYOP. We're fiber connecting to data centers. Frankly, the most interesting, probably the least understood or underappreciated is industrial. Industrial real estate is a side doorway into AI. Let me just tell you quickly, it is the R&D facilities with those robotics and drones. Silicon Valley industrial rents up almost 50% the last few years. It's e-commerce. You're talking about retail sales. AI is a major accelerant to e-commerce, which drives industrial leasing. And lastly, just these data center clusters. It's like when you put an airport somewhere, a lot comes around it. You put a data center somewhere, you need a lot of warehouses to store all those picks and shovels.
On residential, we've been talking a lot about cities where you're seeing a lot of price cuts, like Dallas or Seattle or Denver. And then this print on starts earlier in the week on single-family starts. We've only had a couple prints worse since COVID. I wonder, do you think that'll be a source of new supply?
Well, look, I think the interesting thing is, look, rates obviously are a headwind to supply. What do you see? You see inflation high, construction costs are really elevated, and immigration curbs, supply chain disruptions. You have a lot of things that have really driven up the cost of construction, which brings supply down. What do we know? When supply is down, price goes up.
Does your forecast hold if we continue? I mean, there's a move in bond yields higher, and we know that real estate is priced off of rates. So how big of a headwind is that?
Well, I think there's a misperception that real estate underperforms in high rate environments. Real estate underperforms when rates are going up. But guess what? They are already up. I mean, just look at Japan. Rates have increased 200 basis points over the last few years, while real estate values over the same period are up 15 to 20%. Why is that? It's because you have the growth. So when you have rates high in a high growth environment, you can actually get real estate appreciation. The other part of it is, again, when rates are high and growth is high, supply, comes to a screeching halt. And at the end of the day, what ultimately ends every real estate cycle, certainly here in the U.S., is new supply. So it's the law of supply and demand. When supply is down and demand is strong, values grow.
Where is supply? Where's supply coming down the most?
We see supply down nearly 2/3 in industrial real estate. We see supply way down in senior housing, which is one of our highest conviction sectors. So, and then it depends on the markets. Like I'll tell you, you're asking about residential. What's so interesting, if you look across what residential markets are performing well, it all comes down to supply. So Austin, one of the hottest markets on the planet from a demand standpoint. Chicago, one of the worst. Everyone's moving out. But guess which of those two markets we're seeing better rent growth in? Chicago is massively outpacing. Austin rents way down.
There's
Chicago
no new
rents
buildings?
up. It's just supply.
I was going to ask if politics play a role here, because we're just seeing such divergent views from states. It feels like, the biggest that we've seen in a while in terms of things like wealth taxes and pro-business legislation. I mean, we were just talking last hour about how Paramount's threatening to leave California. So, I mean, do you follow? Does the money in real estate, which you have to think long term, follow the politics like that?
Absolutely. It follows the local politics when it comes to, people can just get up and move, certainly here in the U.S. where there's more fluidity. But it also goes broader than that. Like the geopolitical lens is driving a lot in real estate. We are in the middle of a massive rebuild or reorganization of the global supply chains, largely driven around the geopolitical fragmentation we're seeing, as well as this increased frequency and severity of event-driven supply shocks. Today it's the Strait of Hormuz, but it goes back to COVID and the Red Sea and the Baltimore Bridge. These have taught countries and companies they need resilient supply chains. And when you have that alignment of policy-driven demand and market forces, that creates really durable demand for those real assets that power those supply chains.
Who's attractive right now, given that?
Yeah, so industrial real estate, again, is an enormous beneficiary.
But geographically, like, are there a country or states that you favor?
Yeah, so the U.S. and Japan are our two most active markets for very different reasons. But in terms of the markets we like, it's those that are seeing onshoring of manufacturing, advanced manufacturing. So I referenced Silicon Valley. It's also the port markets. So as trade diversifies, as manufacturing diversifies away from China, that is hitting the West Coast port markets in the U.S., the Inland Empire getting hurt. But the East Coast port markets become major beneficiaries because goods coming out of India or elsewhere are coming into the East Coast markets. So there are real winners and losers.
Oh, that's interesting.
Lauren, it was great to talk to you. Thank you for joining us and giving us a little window into your world of $80 billion of capital and overseeing where all this money goes around the world. Thank you.
Thank you so much.
Lauren Hochfelder from Morgan Stanley. She's the global head of real assets.
Still ahead, Micron, you might know, founded in Boise, Idaho a few decades ago, and it's turned in hometown into a boom town. We're going to take a closer look at that with Jim out there with Sanjay Mehrotra today. S&P 76.73. We took out Monday's low back to the lowest since the 4th of the month. Stay with us.
You know, Micron started right here in Boise nearly 50 years ago. You know, we are the innovators. We have 62,000 plus patents today. And of course, we have believed in the vision for memory. We say memory, our vision is, will accelerate intelligence to enrich life for all.
That was Micron's Sanjay Mehrotra earlier this morning talking to Jim about Micron's memory vision, noting the company was founded in Boise nearly 50 years ago. Katie Tarasov joins us with more on Micron's impact to Boise. Katie, I'm curious to get your reflections on his comments and what it's meant to the city and the state.
Yeah, that's right, Carl. I mean, Micron is spending $50 billion to build 2 new memory factories in Boise that it says is going to create 17,000 new jobs. That's a lot of jobs. 3,500 of those are going to directly be with Micron. That's a lot of new employees, some with stock awards that could make them fast millionaires. CNBC Dodd and I talked to people in Boise to get a feel for how this $50 billion spend is changing the region, including one wealth manager who now works almost entirely with Micron employees.
We actually had one gentleman who was very blessed with the amount of stock that he had, mostly Micron. And when he came back in after 8 days, and we said, "What has changed in your life since we met last time?" And he said, "I'm $1 million richer." In 8 trading days. Whenever you see a company exploding like Micron, it's so exciting, but what you don't realize is it's equally stressful when you have a stock that goes from $100 a share to well over $1,000 a share, and you have people concerned, how long is that going to last? Well, you don't know when that window is going to close.
Yeah, I mean, the memory industry is usually a boom and bust cycle. And so with giant memory fabs also coming online from SK Hynix and Samsung, which we've been talking about recently, the market could really see a glut. Idaho already has the fastest population growth in the nation. There's been a 4.5% rise in homes sold above listing price since last year, which tops national averages. Residents told us they're worried about traffic and the amount of water and power that these fabs need. Chips take a lot of resources to make. But the local utility, Idaho Power, says the power bills won't go up for residents, and Micron says it plans to recycle as much water as it can. Micron is also committing $75 million to help with things like housing and roads. Back to you guys.
It's always difficult when communities, especially small ones, grow at such a high pace. Keeping up with the infrastructure, the schools, the housing is usually problematic. Now, Micron's not the only one building massive memory factories right now. Does that create any risk for residents enjoying the current boom?
Yeah, I mean, it definitely creates a risk for the market having this glut, like I mentioned. So I'm actually just back from South Korea, where I got to see SK Hynix has this huge memory build out happening there. They're spending $720 billion. So, you know, Micron's spending $250 billion in the US, but, you know, 3 times that happening in South Korea, as well as a memory packaging fab coming to Indiana from SK Hynix. And SK Hynix is the biggest maker of high bandwidth memory. This is the kind that's most in demand for AI. And, you know, Samsung, the other big player in the space, also building out. So if this creates a glut in the market, then these fast millionaires may no longer have those benefits of that wealth. And, you know, who knows what that does to the plans in Boise. I guess it depends how long this boom lasts, Katie. Thank you very much for joining us and highlighting, I think, another positive aspect, honestly, of this whole AI build out, which is important because there's a lot of negativity around it as well. But the boom in places like Boise. By the way, don't miss more of Jim Cramer's interview with the CEO of Micron tonight, 6 p.m. Eastern on Mad Money. Carl, stocks are under a little pressure. I do think we got a lot of signals on this show today from some key policymakers that we should mention. So we kicked off the hour with Scott Bessent, the Treasury Secretary, after his decision to increase the buybacks. He explained why he was doing that with bonds, and he said because to deal with some of the liquidity and sort of the August trading momentum that's going on, he didn't think that yields were reflecting fundamentals properly. And he, I think most importantly, gave the signal to our viewers and to investors on the show that he is prepared to do more and go bigger, which is even more of a signal here when it comes to the Treasury Secretary and the administration getting more involved to to basically intervene in the markets. It's something we haven't seen.
Now, activist Treasury issuance. Myron used to write papers about this, and Myron's complaint back then was that once one administration starts to do it, ahead of midterms in this case, then you raise the risk of multiple administrations trying to manage the curve in advance of political moments.
I mean, there were those criticisms around Treasury Secretary Yellen in the last administration.
By Secretary Bessent.
By Bessent. I mean, so maybe we have seen it before. You know, she was managing, buying in the short term when it comes to funding debt, and that was ahead of the election as well. So there were, that's always going to be out there. I would also just say St. Louis Fed President Moussalem doesn't get a vote this year, but also openly signaling and advocating for a rate hike, saying inflation is the concern, not as much others, which was also sort of an important and related moment, because look, if the Fed has to raise rates, that just makes the Treasury's job harder.
Yeah, especially at the short end. That would be expensive. By the way, 10-year didn't really budge in the wake of the Secretary's jawboning, but if he's right about it being thin markets, maybe we can't really judge until we get past Labor Day. We'll see.
Yeah, and he also thinks the market's wrong about oil, and it should be going lower on this increased economic pressure. More to come, he said, on that on Monday.
Yeah, that's not happening. Diesel $5.55 a gallon is going to impact the economy somewhat. You back tomorrow?
Back tomorrow.
Nice, finally. Let's get to the judge.
Carl, thanks. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, the state of the markets, with one of the biggest investors on Wall Street declaring the environment one of the most exciting, most fun ever. We'll discuss and debate whether, in fact, it is with the investment committee. We'll document a new move from Josh Brown as well, so you don't want to miss that. Joining me for the hour today, along with Josh, Jim Lebenthal, Rob Sechin. We'll go to the markets here. We do have an issue today. We are red, and it's largely because yields are back up, oil's back up, threats are back up from the White House and the president regarding Iran. Markets obviously don't love that. Still, as I said in the open, many big investors say the environment's bullish. BlackRock's Rick Rieder, he told me on Closing Bell we could get another 5 to 10% out of this market this year, and that there's so much going on, it is almost overwhelming.
I will say, Scott, this is the best, most exciting, most fun investment environment. And then I go home at night and and I fall asleep immediately. It is exhausting.
Wow.
There's so many. I mean, like today alone, like you said at the open, the cross currents. We spent a bunch of time today on healthcare. This Moderna news is significant. So we started looking at the tools businesses. We looked at different parts of healthcare. Like, boy, every day there's a new menu to look at. I will say one thing. I've never in my career felt like every day I come in and I feel like I'm prepared, and I go home and I feel like I'm behind. And it's an incredibly exciting time, but it's stressful because we're learning so much every day.
Well, we thought that was a great jumping off point for us today to have a really robust discussion. We'll start it off with you, Josh. When you hear that from the gentleman at the world's largest asset manager, who is the CIO of not only global fixed income, but heads their global allocation team. He's as plugged into the bond market and the stock market as you'll find anywhere on Wall Street, and that's what he had to say. Rick Rieder, what do you think?
Exciting's not always great, I guess I totally agree with everything he said. Especially in fixed income. I don't think most people are allocating the fixed income portion of their portfolio hoping for excitement. I think you guys would probably agree. I think we get enough excitement from the equity side. But to his point, longer yields are back up today. So we did a little bit of jawboning exercise, a little messaging, let's call it, from the Treasury. Yesterday, now we're back up 6 basis points, which is the biggest mover of all durations. The big picture here is this is not Trump specific or Bessent specific or U.S. Fed specific. What we're seeing at the long end of the bond market is happening literally all over the world, everywhere except for Switzerland. Why not Switzerland? Very disciplined with their debt. Everybody else, it's been a free-for-all, especially since COVID accelerated what's been going on for 15 years. No political party in any developed country around the world wants to make any tough decisions. And so in the absence of any kind of fiscal discipline, what we essentially have is deficits growing. Now you couple that with political dysfunction, and you see this happening in the Japanese bond market. You see it happening here. It's happening in France, the UK. This is a global phenomenon. And I don't mean to scare people, because the good news is, yes, We are now approaching 1-to-1 on debt to the size of the economy. It's a little bit scary. However, who owns the debt? In the case of the United States, we're paying interest to ourselves. Investors own most of the debt. And so long as that equilibrium is in place, we can keep kicking the can. We can do this into another administration and then maybe even another one after that. So the stock market has been able to hold in. The excitement that Reader is talking about, absolutely, that's going on the bond side of people's portfolios. But I don't think
he's talking about on the stock side too. Let's not just judge him by his title. He's not talking about, oh, there's so much excitement on the credit side. Forget about what's happening on the stock side. He's using the Moderna Merck news yesterday to say this environment is incredible. Look at what's happening in AI. Look at what's happening in healthcare. Look at what the beneficiaries are going to be in XYZ areas, and it's so hard to keep up that it's almost overwhelming.
And who could disagree? Right.
Yeah, I mean, what do you think?
I mean, there's no question that there is so much going on right now. There's genuine enthusiasm. There is enthusiasm because of the GDP trajectory. There's enthusiasm because of the earnings trajectory. One of the challenges that we see is in the very short run, it's gotten a little lopsided with sentiment. It's definitely.
You mean people are too bullish?
There's definitely a start. We're entering a seasonally weak stretch. Mid-October, mid-August through mid-October are historically seasonally choppy, maybe not weak periods in the market. And ultimately, though, I think if we do get some type of re-rating on this scare, that you have to be a buyer of this. I would also say
on what scare? The backup in yield?
Yeah, the backup in yield, which I think's you're fighting policy, the White House, the Fed, Treasury, maybe the Fed. We'll see next week. But the reality of it is that has been the worst bet to make in markets since the new administration took place. Is every time there's an issue, making a bet against that, extrapolating. Look at what happened when Yellen did this, Scott. She, again, did Operation Twist, right? Issued short end to buy long end, and yields fell 100 basis points over the following 12 months. I'm not saying you're going to see that because I think we're entering a systematically higher yield environment, but it's well supported by what's happening economically. And that's what Rick is citing. And by the way, earnings are not just terrific.
Rick is not suggesting that the economy's booming. In fact, it's the alternative. It's good, but it's not great. And then if I layer on to you that maybe the biggest reason that yields have backed up is because, and I don't even know if it's a maybe, because I think people are in agreement, and even the Treasury Secretary himself said it on the air this morning, the amount of issuance that you have had enter the market because of the AI build out is having, he used the word asymmetric in terms of the kind of information that he thinks he has versus what the markets have. But it has had, some say, an asymmetric impact on the move in yields, maybe more so than anything else.
Well, it's also had an impact on equity valuations as well. We entered at 23.5 times, and we're at 19 times right now. So,
well, thank you, earnings.
Well, of course, but you could have maintained that pace of play and could be up even more just because earnings have been so powerful. I get your point, but there's another point in that we've had some multiple compression, and some of that is due to rates. You can't ignore that. It's not just due to pure earnings power.
No, but you're suggesting that, and he said, the Treasury Secretary did, of course, we can do more if we have to, we want to. But the point is, just like the Fed, by moving interest rates, can't really deal with oil-induced inflation or tariff-induced inflation. Can the Treasury really do anything by intervening in a market that is being asymmetrically driven by the tremendous amount of issuance that's coming on the market related to AI? I think it's a fair conversation to have, fair question to ask.
Totally a fair question to ask, but I think when you get yields at these levels and you see the issuance, yes, you've got a hyperscaler issuing at 10 to 15 basis points more expensive. Big deal when you have that type of growth coming out of this area. I do not care Honestly, I do.
No, I know
do,
you don't care, but the long end of the Treasury market
The
cares.
long end is caring until there's clarity, more clarity around how they're going to do it. And the first shot across the bow was yesterday that we want to control long-term rates because that's prudent. We don't want it to become unhinged.
I thought you were talking about more clarity from the Fed, because even President Mussolini, who was just here, said, you know, you can still not give forward guidance if you don't want to. He's not I don't think, you know, most people at this point are not great fans of forward guidance, but that doesn't mean you give no idea of what your framework is to get to the target that you suggest that you darn right will get to. Like, you need to communicate that to some level.
And I agree with you, and we might have forced that communication, and that's why, you know, Jackson Hole becomes so important. But I can tell you from a portfolio standpoint, when I hear the amount of banter on how fearful people are about higher rates right now, you know what it makes me want to do? Buy duration. Always works. Maybe not today. Maybe we get a little more extended.
How much duration?
But
How much?
the
10-year, not the 30-year.
Yeah, I mean,
Okay. I was going to say.
Yeah, no, but
here's the portfolio benefit. One more thing, Josh, you know this.
I'll buy a 5%. I'll buy a 5% 10-year.
Exactly.
So for the first time in a long time, fixed income now can actually hedge if we become unhinged, because there will be demand for that price.
So I agree. I agree. And to your point, there are like no iron laws in finance. Almost nothing really works all the time, every time. The closest we have to an iron law in investing, asset allocation, is that the starting yield on a treasury, if you hold for that period of time, is what you and then you dial back and say, what was my return, my total return, very important, not just the yield. The starting yield is almost perfect. So hypothetically, if they get the 10-year up to 5%, and everyone on the network's freaking out, and clients are calling, what do we do? What does it mean? If you buy that 10-year and you take that 5%, print, and you hold it for 10 years, you're going to get 5%. Like within 95% range of probability. You can't say that about anything else you can do in a portfolio. You can't say it about PE ratios. You can't say it about really anything. But if that's where they're going to take the 10-year, I'm going to go to 5. I'm a buyer too. I think Rob's exactly right.
Josh, I'm so glad you brought in asset allocation, because the three of us do that for our clients, and we all know that if we went back 5 years ago, it wasn't 4.7%. It was like 1.5%. And what we were telling our clients was, put these bonds in because it will stabilize your overall portfolio.
And that's all you're getting.
And that's all you're getting.
Right.
We actually, I mean, I'll speak for you guys, we actually like this because we can give volatility dampening in our clients' portfolio through bonds while still giving them a real after inflation return. Now, of course, this means that somebody who is buying a 4.7% treasury or a 5% 10-year or 5-year corporate bond might be taking that money from equities. But to Rob's point, we have a strong economy. We've got good profit growth, and people who are thinking about selling their equities in order to go into fixed income are considering, do I really want to give up on this market?
I don't think that's where the debate, people aren't thinking about selling their equities and going into fixed income. I think if there's $9 trillion in money markets sitting out there, people are wondering, should I take the cash and what asset class should I put that to work in? And it's not necessarily, there's been articles written lately about fixed incomes being as a hard, if not impossible, sell by what you guys are trying to do for your clients. There's no interest.
That's because of the last 10 years.
It depends on look, it depends on each individual and their risk tolerance. I happen to be an equity portfolio manager at heart, so given the choice between, let's say, a 5% 10-year bond and the equity markets right now at 2019 times earnings, which is a corresponding 5% earnings yield, I'll take equities all day long. Not because those numbers are equal, but because I've got that growth rate in earnings that I feel very confident about seeing the earnings reports coming in.
Okay, debate number 2, which I thought was really interesting from this morning as well. So we're all thinking about and talking about probably, you know, endlessly the momentum trade. It's being closely watched every day. It has not traded all that great lately. Now, FactSet today mentioned some talk of disappointment around the recent numbers we got from annual recurring revenues from both Anthropic and OpenAI, that some of the expectations around those numbers were a bit higher than we got, especially for Anthropic, as amazing as they seem to be on paper. They also mentioned the data center backlash. Is that starting to have an impact in this area, on this trade in any way? You know it's only going to get louder as the midterms get closer and then the 28 election starts to creep on us as well. So semis today are looking to snap a 2-day losing streak. Memory names, as we've seen, are higher. Micron is, SK Hynix is, at least they were. Let's take a look at those. So Micron's CEO, Sanjay Mehrotra, was on Squawk on the Street earlier this morning and said this.
Memory is no longer a component in a system. Memory is the strategic infrastructure for AI. It's no longer a commodity, it is a high value. This is enabling value for our customers. Without memory, you cannot make AI smarter. You cannot make AI faster. You cannot scale up AI. You know, AI is advancing, a lot of context is getting generated. All of that context has to be stored, has to be processed through memory.
Okay, the line that jumped out to me the most. It's no longer a commodity, it is a high value. Is that gentleman right there suggesting that what has always been viewed as a cyclical trade should not be anymore? That it's now secular because of how valuable chips will be in the continued build out? Because then you need to have a valuation conversation about things that were traditionally seen as priced here, which have now been priced here. And maybe the here is where it's supposed to be, given what he just said.
Let me start by saying I'm long Micron. I would add to it here with new money, so I think it's a buy. That said, I'm going to sort of tamper what he was saying a little bit. Right now, we're in a position where demand is exceeding supply by a lot. I still think this is a cyclical area, a cyclical sector, a commodity. But this cycle is very drawn out because of the artificial intelligence build-out, which is measured in trillions and going on for years.
So then he says, the guy who's running Micron says it's no longer a commodity, and you're...
I can't believe he said that.
Exactly.
I mean,
exactly.
okay, so fine, he's talking his book.
Let's just say he's not being disingenuous. That's not what I'm saying. What I'm saying is this is a cycle. It's elongated.
The cycle
it's
could be much longer
right
than
now.
historical.
Yeah, and when that happens, of course, it feels like, hey, this is specialty. You know, I remember when there were specialty chemicals. It's nothing special about it. All right, it's supply versus demand. Right now, we've got limited supply. It takes a long time for supply to come on. You've got demand not just for the artificial intelligence build out, but think about Apple, who's waiting to get chips wherever it can, or even more pedestrian things like
he's
washing
suggesting
machines
that
or
the
cars.
long-term demand equation has been completely reset.
And it has. He's 100% right. Here's why. Data centers have been around for a long time. I happened to spend the weekend in Carmel with two executives, CEOs of data center companies that'll be unnamed. They said we are in the first inning of these build-outs, the first inning. And when you did a data center years ago, it required basically 1/12 of what is required in the current data center. So not only are you building more, they're 12 times as big, and it's going to be a longer cycle. And by the time you get to the end of the cycle, you're rebuilding at the beginning. It is core infrastructure, full stop, period.
Let's look at Micron's current forward PE, guys, please, if you can put that up while Rob is talking. Thanks. Go ahead.
No, I just think I was shocked to hear that we are in the first inning in some of these data center builders' eyes. Okay, it's just unreal demand that they're seeing, and it's visible demand. In some of these cases, they're building out 12 units on these campuses, and they're done with one. It's remarkable.
So we own all these stocks in our Momentum portfolio, Porterhouse. But I think to move the conversation to so let's say you agree with Rob, or you agree with Jim, or you think the truth is somewhere in between, which is kind of where I am. What do you do? So the problem with the way that people have historically played momentum, they buy MTUM, for example, which is up 8% from its low on 7/29. We had that momentum washout in July, and then everyone went back to the game like it never happened. The problem is that's 48% technology. So you're not just betting on momentum and market leadership, you're making a de facto memory chip bet with that portion of your portfolio. The top 5 holdings, MU, AMD, Broadcom, Intel, Caterpillar, they're all AI bets. And so that's half the fund. Even the non-tech stocks tend to be AI bets. I think there are so many other stories in the market that are not AI related that do have momentum. And I thought I'd share a couple because I don't think we talk about them enough. J.B. Hunt is a market leader, not AI, really in any way, shape, or form. Marathon Petroleum, which we've talked about a million times, INCY is part of this biotech rally. Expeditors International, these are not AI plays. Valero is working. East West Bancorp is working. Now, you could make the argument there's like this indirect thing where, yes, they're in another sector, but they're doing business with AI companies. Okay, fine. I'll spot you some of that. I just don't think you need to have this portion of your portfolio.
I'll drill down on that.
50% AI.
I want to drill down on what you said because I think it's really important. The businesses are fundamentally sound, right? But price doesn't always fund the business. Price doesn't always mirror the business. And what's happened is a lot of these momentum names have moved so fast, they've attracted fast money. And if that fast money sees another place to put their fast money, you could get a price re-rating without a business re-rating.
We just had one.
Exactly. And that's the challenge.
But Rob, in a lot of these sectors, if we're talking about energy or healthcare, which you didn't mention, you know, when you're talking about price re-rating, these are not expensive areas to begin with.
No, I'm talking about Microns, SK Hynixes, those type. That's what I was.
The Bears argument is whether it's cheap or expensive.
Well, that's the point. The Bears want to look at the Bears want to point to momentum as a theme, which is leading the market, and they want to say it's 1999. The problem with that is the forward-weighted average PE for MTUM is 19 times. It's really, really difficult to make that case. We just so happen to have these gigantic companies that used to be priced like cyclicals. They started out at very depressed PE multiples. They've gotten some multiple expansion, but they're not selling at 1999 levels.
Josh, since you brought it up, the 1999 levels, what's the big distinction here? Is in 1999, 2 things were going to happen. 2000 was going to come, Y2K hits, the tech spending goes down immediately. The other thing is all that fiber optic spending was speculative. There was no revenue associated with that. That is a 180-degree difference to say Andrew Jassy, CEO of Amazon, talking about recouping the investment in a data center today in less than 3 years. Those data centers that are being built are profitable. The demand is there and spoken for. Okay. Key difference.
Let's run through, I think, some stocks that we need to get to. SpaceX, another lockup expiration today. Could get as many as 300 and almost 320 million more shares hitting the market, 7% of the total amount. You own the name. How are you navigating yourself?
We do privately, but we're getting stock off in lockups. Our recommendation has been to trim. The way they've designed the lockups is really intelligently because they're staged lockups, expirations, so you can manage the flow onto the market.
You guys holding or selling?
We are mostly selling, but we do have client. Remember, we don't own this in a portfolio. We own this directly in a private. Each client owns.
So if if the IPO is 135, you are saying trim at 131, or trim on rallies
because they're getting 6% of their total exposure out. Right. It's or 15%. So you're keeping much because you have to, a bunch because you have to, and so we're recommending trimming the balance. Kind of taking your basis out, Scott. If you can think about it like that, you're taking the win.
Okay. CrowdStrike, CTO's leaving to start an AI cybersecurity fund. Stock down a bit on that. What did you take, Josh?
So I'm long the name, and I don't typically react to things like this. I don't think it's existential. The jockey that's riding this horse is George Kurtz, and in George we trust. This is one of the best performing software stocks of the era. I really don't see that changing.
Walmart down after what some are calling a messy quarter. Ex-fuel comps missed. Seems to be a lot of focus in that area today, which is probably the principal reason the stock's down 9 1/3%. They did raise their guide. TJX got downgraded from a buy. So how are they? By the way, the analyst who did that cites a quote-unquote execution misstep are we thinking about these?
Well, here's how we're not thinking about it, at least from my perspective. I don't think the consumer is in trouble. I know there's a narrative out there people want to believe and have wanted to believe for 5 years that the consumer is going to fall out of bed sometime soon. That's not what it is. If I look at Walmart, I simply see a stock that was priced for perfection, even after a recent slide, and a slight miss here or a slight execution issue. Same with TJX, by the way, causes the stock to go down. And as a proof on the other side, look at what Target's been doing, where they've been executing well, and it's been a cheap stock in the sector. My point being is, in retail, be selective with your stocks, pay attention to valuation, but don't throw in the towel and think that the consumer is giving in after 5 years of hanging in there through everything, whether it's COVID, whether it's pandemic spending, whether it's student loans starting up. The consumer is just fine.
The street wanted 3.7% same-store sales. They did 2.6%. That's a great quarter for Walmart. I'm sorry, off the size base that this company has, they beat on earnings, they beat on revenue. It's just slower growth than what they had been doing in previous quarters. It seems like an overreaction. I think this is a top 5 worst single day for Walmart ever. I don't know. You probably buy it before you sell it.
All right, let's just do a quick checkup on, pardon the pun, on Moderna and Merck, because obviously it was such an extraordinary day yesterday with that announcement of the positive phase 3 on a skin cancer treatment. Moderna was up just tremendously yesterday, so it's given a little bit back today, 23% back. Again, take the context fully, though, it was up like 140-something% yesterday. Merck, a couple of calls on today, upgraded to overweight at Morgan Stanley. They're looking at the cancer pipeline, so that's important. Downgraded, though, at RBC. They look at the momentum continuing, but say the valuation is now full. They go to 150 on the target from 142. We're back with a trade alert from Josh Brown. Just added a name. We will discuss next. All right, welcome back. Let's talk about this new move from Josh Brown today.
Making moves. What's up?
Buying Spotify.
Yeah, listen, I think this is maybe the best media business on the planet. It's hundreds of millions of paying users, and music is like elemental to the human race. For as long as there have been people, there's been an interest in music. It's extremely powerful, and Spotify is the best business within the space, like by far, way better than anything Apple is doing on Apple Music. All of their other competitors are knocked out of the box. There's no more really. XM Sirius, nobody talks about it. Pandora is gone. It's really Spotify's race to win. Very similar to Netflix, and I own both of these names. Stock is 31% below its highs, has not made a new high since June of 2025. It bottomed at about $4.19 in May. I think that's probably where you'd want to set your stop on a trade. I'm in the stock at about $5.20 as of earlier this week, and quite frankly, I think we may have seen this tradable bottom, and I like the way it's acting off that low. It's very gradual, slow and steady. Looks like it wants to break out here of recent resistance. I'm going to hang on to it, watch this trade develop. I'll be moving my stops up accordingly.
Okay, thank you very much for that. Speaking of tradable bottoms, let's discuss Netflix for a moment, if we could. Let's see the stock, guys, please. Thank you. So we're flat today. Now, TradingView has a question. Time to buy Netflix? Netflix shares have corrected by more than 50% since reaching their all-time high in June of 2025. Since the end of last July, the stock's been attempting to stabilize after rebounding from its 200-week moving average. Can we conclude that a major bottom is currently being formed? They ask. They answer. The combination of a major long-term technical support level and a much more attractive valuation creates a significantly more favorable environment for long-term investors like this guy.
Yeah, I bought the sell-off in the high 60s, low 70s. Here's the bottom line. I understand we don't have to spend 10 minutes talking about competition. Everybody understands there are other streamers. The reality is Netflix is expecting 42% earnings growth for this year, 6% growth next year. It's trading 21 times earnings with a 0.9 price to earnings growth ratio. I know I got your attention with that. You are not paying up. You are not paying a premium for their leadership position. They're now in live events. They're in sports. They're doing great. They're getting into podcasting and other things that make the service even stickier. And quite frankly, I think the stock was cheap at 90. So down here at 80, I still like it, and I'm going to stay long and see how this recent rally develops.
By the way, we're looking at 5 weeks in a row for this name, which you haven't been able to say that in a while. That's the best streak since October of 24.
And we have Bill Ackman in it, and you absolutely know he's calling management like every 24 hours, just blowing up their phones.
100%.
So I think more good things can happen than bad things from these levels. This was a $140 stock not that long ago. The wild card is if they make a run at Universal, which absolutely is a thing that could happen. I expect the stock would halt. I don't know if the street takes it positively or negatively, but that's like the wild card out there.
All right, so Alibaba's spending a lot, as you know, on cloud infrastructure, just like seemingly everybody else is. Street not that happy about that. 75% drop in net income. You own the name. What do you think?
No kidding. They're not that forgiving to anybody that spends money. But as you know, it's an arms race. And, you know, this company has a fast-growing cloud business, solid AI models, a dominant e-commerce business, and reasonable valuation and a double-digit growth rate. I still think it's a pretty attractive bet, and we remain long the stock.
Let's talk about some Marriott. The target gets cut today. Not by a lot, $395 from $412. UBS, they're neutral on it. They did issue a weaker than expected profit guide. You've had it a couple times, I think, on best stocks, most recently at the end of July.
Yeah.
How do you think about it today?
I like it. I own it. It's a trade. I do have a stop in here. We're not anywhere near it. I like most of the large travel stocks. They've all been doing really well. We've talked about best stocks in the market. We've talked about Hilton, Expedia, Marriott. We talked about the airlines. This is the strongest part of consumer spending. I just don't see that changing between now and the end of the year. I like the stock here. I bought it on this dip. I think it's got some pretty decent support, and I'm going to stay long for now.
You know, I'll just point out, if you want to throw up a chart of Disney, because I remember, Scott, you and I were talking about Disney just before earnings, and we were comparing its lackluster performance to a great performance from Marriott. And it seems, if you look there at the end in the month of July, like we're getting a little recovery here. I don't know why these two stocks should be negatively correlated. Frankly, I think they should move together. But I'm taking some comfort from the fact that Disney has a little bit of a bid here. And I could easily see myself giving up on Disney if it doesn't continue, and maybe getting into your Netflix or maybe even a Marriott.
Wow. All right, you'll let us know. So let's get your take, because we didn't have you yesterday or the day prior. Lowe's and Home Depot, okay? So they both had earnings. The Home Depot CFO talked about the housing market being frozen. Their word, not mine. Targets today cut for Lowe's, pretty much across the board. From 267 to 260 at Citi, down to 191 at BNP. 240 at Gordon Haskett, 270 at Goldman, 260 at Jefferies. So a lot of numbers in the same sort of ballpark. What do you think about both these stocks here?
I mean, I don't think they're going to move anytime soon. I mean, you're a hostage to rates and the implications for the consumer and the housing market. So we've owned them for a long time. We have no intent of changing that. Because we do think there will be a day when the sun shines again. However, that time is not now.
Okay, let's go to Frank Holland, who has a CNBC News update. Frankie, how are you?
Hey, good afternoon, Scott. The FBI reportedly raided former Congressman Eric Swalwell's California home as part of an investigation into sexual assault allegations. That's according to CNN. Swalwell resigned from Congress in April after multiple women accused him of misconduct. He denies those allegations. No charges have been announced. The Drug Enforcement Administration has joined the investigation into actress Hayden Panettiere's death, according to sources that are familiar with the matter. The 36-year-old was found unresponsive Sunday in Greenville, South Carolina. An autopsy found no contributing trauma, but authorities have not determined a cause of death. Toxicology results are pending. And three of the biggest bodies in world soccer are reportedly considering a no-confidence vote aimed at removing FIFA president Gianni Infantino. That's according to Reuters. The groups are discussing the unprecedented move after Infantino's failed plan to sell private investors a stake in World Cup profits. FIFA so far has not commented. Scott, back over to you.
All right, Frank, appreciate that. Thank you. That's Frank Holland. Coming up, Josh Brown. He's back. Best stocks in the market. A new name on the list. It's up big this year. I'll tell you what it is next. hottest stocks in the market time. Josh Brown, spotlight today's on what?
We're going to do the Shark Ninja?
Okay.
Well, might as well.
Let's
All
do
right.
it.
True story. I'm walking across Glen Cove Road. I'm on my way to yogurt and such. They mix the sprinkles into the yogurt, into the middle.
All right.
So it's not just on the top.
Got it.
Anyway, this guy yells at me from a car. He says, "Hey, I heard you on CNBC talking about Shark Ninja." I said, "All right, what do you want from me?" He said, "That's the family business. My brother runs a company. It's been on my radar ever since. I have traded the stock before. This has been an absolute home run since it was spun out back onto the New York Stock Exchange in 2023, added to the best stocks in the market list on August 5th. Q2, Shark Ninja posted its fastest quarter of top-line growth since 2 years ago. It's sort of re-accelerating. It looks very different from other companies that sell into the housing ecosystem. But it's vacuum cleaners, it's blenders, it's appliances. They've just cracked the code on making the consumer happy with what they bought and maintaining that loyalty. And the stock reflects it. At 182, it's now 28 times the midpoint of the adjusted earnings per share guidance that they've given out. That's like 22 to 24% EBITDA growth, and that is very rare in this space. The company is taking share. It's gone international. It's a huge home run. The problem is we've missed a lot of the run in the stock. So what we did at CNBC Pro for the column is we gave people the levels at which they might want to wait. I think the most obvious level here is 155, which is that rising 50-day. This stock could consolidate to that level at any time. That's where you want to initiate a new position. But I want people to know the story. So we went a little bit deep on the fundamentals. You can read it at the website. And put this stock on your monitor because these guys are doing a lot of the hard things very well.
Long Island-based company?
Needham, Massachusetts. And actually spent a stint being based in China before coming back public here in New York. But the workforce is in New England.
How is the yogurt?
It's yogurt and such, so you know it's the bomb.
What flavor?
I do this thing, banana and peanut butter swirled. So, yeah.
What kind of sprinkles?
I mean, this is like a little bit personal.
I mean, you mentioned it.
They do rainbow sprinkles with chocolate crunchies.
So yogurt mixed with sprinkles.
Yeah. No, it's like low-fat yogurt.
Oh,
but
but then you gotta balance it out.
Of it. Yes. Yes. I mean, we have to make it edible, is all I'm saying.
All right, Sid Toley's next with his midday word. senior markets commentator and overtime co-anchor Mike Santoli is here for his midday word. Is this about yields, or what do you think? Oil, what do you think's happening?
Well, I think it's about all of it. I'm not going to make too much of, down 1/3% on the S&P 500, but I do think we are a little bit on edge in terms of what enabled the market to stay near the highs in the absence of semis being able to do the work, and that had been banks, that had been industrials. Both of them are down 3%. Week to date. So I think it's just kind of the rotation, a little bit of slippage there. Yields, I don't think there's any kind of hard trigger threshold that we're threatening, or somehow the fiscal thing spills into being irretrievable, or valuation math gets onerous, but it is nagging. And I do think if you're talking about 3% very long-term real yields, that's supposed to be a restraint on capital on some level. Maybe it's supposed to be a restraint on growth. So I don't know that it's something that today the market's reacting to the fact that we could not keep yields suppressed, but it is definitely going to stay on our minds for a while.
It's also a thin market, as the Treasury Secretary was talking about today. It's like from the last whatever significant moment there was, we're on this long flight towards NVIDIA's numbers next week, and we've been hit with a little turbulence along the way by the rising yields and rising oil prices, but I feel like we start to descend into that moment next week, and maybe we have a little wait and see for that.
I mean, it could be another little moment of, spin forward the high conviction that the whole spending story remains. But, NVIDIA hasn't been a market mover for like 3 or 4 quarters at least. It's been just kind of, we know the story gets confirmed. I think Walmart's numbers today really kind of marks the, informal end of earnings season. We think we know what we got. Earnings did all they could do, and I think it's fine. Look, the market's not doing anything besides digesting the gains that we had, up 6% in 12 trading days coming into this week.
I think it's surprising that the yield-sensitive sectors in the stock market have not reacted as negatively as you would have expected them when we're talking about 30. We almost never talk about the 30-year bond in the stock market. So once that talk starts, typically you'd see them whack the dividend names, and they didn't really do it.
Not the dividend names. I mean, yesterday, like home builders flew, and they haven't given it all back or anything like that. I mean, spreads are so tight. Corporate spreads are tight. If you even look at the index for investment-grade debt, the yield is not at the highs. It's not going back to the highs of 2023 and 4 because the spreads were so wide then. So I feel like there's not really an emergency on that front, and it's not suggesting that the economy is going to hit a wall. But you're definitely restrained.
And just to buttress the point, the 10-year is still in the range of the last 3 years. 4% on the low end, 5% at the upper end. I don't like it at 4.70, but I'm not freaking out. I don't think we need to.
We spent over those 3 years 10 weeks above 4.6 total. So in other words,
not freaking out. You're
you
still
have
not
to maybe
me.
have to register a little bit of a higher range, but that's fine.
We'll see you on closing bell.
Yeah.
All right, good stuff. Look forward to that. That's Mike Santoli. We'll talk to Oliver Rennick next. Play some options action. He's following what's been going on in Bitcoin. He'll give us the trade next. we're going to play some options action now. Oliver Rennick joins us live from the Cboe Global Markets in Chicago. Are we talking Bitcoin specifically?
Yeah, Scott, and hyper liquid. Bitcoin bulls are getting some relief this week after a tough year with BTC up 15%. The big question is if Bitcoin's up on a Treasury intervention that missed the mark or President Trump's push for the SEC to create a path to compliance and legalization for decentralized exchange Hyperliquid, whose token HYPE is up almost 200% this year and owned in part by publicly traded PURR, P-U-R-R. Right now, options traders are buying up calls across the board in a hurry, 5 times the 30-day average in IBIT. But look at PURR, where options trading is 16 times normal. That looks more like a structural, perhaps permanent shift in this stock's options market. 15 of the top 20 trades by dollar amount in PURR were neutral to bullish today, with traders thinking it will get back and stay above $10 by Friday's expiry, and some others buying the 15 strike calls expiring mid-October, looking for another 50% move in the stock over the next 8 weeks, Scott.
Interesting, Oliver. Thanks. I'll see you at 3. That's Oliver Rennick from the Cboe. What do you think about what Bitcoin hasn't done and then where it has maybe woken up to?
Yeah, look, it's like the type of asset where there doesn't actually have to be a reason. Sometimes it just rips 30% higher out of nowhere, and then we look back at the recent headlines and we say, oh, this is why. And it works, unfortunately, for bulls in reverse. It can do the exact same thing.
Yesterday there was a catalyst, though, and that's the Treasury trying to suppress the long end. It rallied right then.
Right.
I mean, you had some,
sure, I'll take it.
No,
I wouldn't argue.
I wouldn't argue. No question. The other
yields are
thing,
right back to where they were the day before
no
yesterday.
question, but there's another thing happening, and it's the speculators may have pivoted back.
From what? From AI?
No, from the chip, the hyper-moving AI, the real momentum stuff. For a little bit. I mean, we've been in this kind of trend. You know, I think the fast money moves quickly.
Yeah. Well, it's also a cheap PE ratio, and I know that's why you like it.
Josh, I'm with you on
they
this.
Report Bitcoin reports earnings next week after NVIDIA. I'm very excited.
It's a random number generator.
All right, finals are next. All right, 3 o'clock. Chris Harvey, Gabriela Santos, Brian Levitt, Dan Ives, Mike Ozani, and Mark Newton. Got a good crew at 3.
Nice lineup. I like it.
Okay.
I'm in.
Thank you very much. Okay, final trades. Rob Sechin.
Service now. You can't say why. There's only like 10.
Well, you could have, but since
Well
there
done.
was multitudes of dead air, you blew it. Jim.
Vertex Pharmaceutical quietly putting up a nice year.
Okay, Josh.
Don't tell anyone, but Uber's Apollo Go with Baidu went live in Dubai. Driverless cars on the Uber app in Dubai, soon coming to the rest of the world.
The exchanges now.
Thank you very much, Scott. We've got Walmart down, bond yields and oil up, and we're heading back towards session lows this hour. I'm Kelly Evans, and welcome to The Exchange. We have Steve Leisman and Eamon Javers standing by to run through today's big moves, including fresh headlines from Treasury Secretary Scott Bessent. And we'll talk to Neil Hennessy of Hennessy Funds, who has been warning we are overdue for a correction. Plus, Mitch Daniels, the former OMB director, is also here to weigh in on the Treasury's maneuvers. And we'll dig into why Walmart is down 9% today, plus the significance of Stripe's deal for OpenRouter. All of that coming up. But let's begin with this backup in bonds, which has put yields back to where they were before the Treasury's surprise announcement yesterday that it would double its repurchases of longer-term debt. Treasury Secretary Scott Bessent commenting on that and going beyond that announcement just 2 hours ago on CNBC. Steve Leisman is here with more. Steve?
You got that right, Kelly. Treasury Secretary Scott Bessent in an exclusive CNBC interview this morning, putting the market on notice that the controversial bond market intervention yesterday may end up being above the bottom end of the $4 billion minimum that the Treasury announced.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
The Treasury Secretary's unprompted comment suggested he may not have been satisfied with the market's reaction this morning, which has seen the 10-year now trading around 470 undo the benefits from yesterday's surprise action, calling it a Treasury twist in which the Treasury buys long-dated bonds that it funds with short-term bills. Bessent defended the action. He said it would address illiquidity in parts of the bond market, especially around summertime. Bond market is not reflecting, he said, underlying fundamentals. And the Trump administration will announce a focus on deficit reduction maybe by the end of this week or maybe beginning next week. The bond market surprised by the action, and that creates some longer-term concerns. Lou Crandall from Wrights and ICAP tells me the long end was already having to contend with increased risk premiums in the wake of Chairman Warsh's July 29th press conference, creating additional uncertainty about the Treasury's commitment to a regular and predictable financing strategy is not helpful in the long run. The big change might be this, Kelly. What was once don't fight the Fed may now become don't fight the Treasury, except the Fed's arsenal is much bigger than the Treasury's.
And the irony is that Bessent it's the Bank of England, right? Back in the early 90s. Successfully, right? Wasn't he part of that Druckenmiller team?
I don't know that, but he has successfully been involved in essentially gaming the other side of this as a hedge fund manager and a hedge fund asset manager. He's done that, and now he's on the other side. And the question becomes, Kelly, this idea of regular and predictable. And a lot of the talk was not what they did. I just want to be clear about that, because there's been talk about the need to do this for a very long time, come in and increase these buybacks of these off-the-run securities. Off-the-run, of course, being a 30-year Treasury. 7 years later is now a 23-year Treasury, and there's a lot of illiquidity in that, and it pays for the Treasury to do that. But doing that 2 weeks after the refunding announcement, doing that before the $20 billion auction, that's not a way to treat your customers in a nice way.
It's also the day after the 30-year hit 533, which was a couple-decade high. Steve, thanks. We'll talk more about it in a moment. Steve Leisman. A key driver of those higher yields has been rising oil prices. Very important. The 10-year yield, as Rick always points out, was below 4% before the Iran attacks broke out. And we saw West Texas benchmark crude back at almost $90 a barrel this morning after the president warned of even more severe economic pressure to come on Iran. Eamon Javers has the latest on that in Washington. Eamon?
Yeah, Kelly, that's right. And you're talking about Treasury Secretary Scott Bessent. He told CNBC just a couple of hours ago that the president's declaration of economic war against Iran last night does include China's trade with Iran, although he said some conversations are best had, he said, in private. Here's how he described it.
Many conversations are best to have in private, and we are confident that everyone wants the strait reopened. and for energy prices to come back down. And Sarah, keep in mind that the Chinese get 50%, 50, the other energy from the Gulf. So it would do them a big service to get with the program.
So the Treasury Secretary telling the Chinese to get with the program. Those comments to CNBC's Sarah Eisen come after President Trump declared economic warfare on Iran last night, vowing to wage a financial campaign against the Islamic Republic as he seeks to break that country's efforts to control the Strait of Hormuz. The president wrote on social media today, "I am also announcing that any country that allows its financial institutions, businesses, airports, or government entities to provide any type of lifeline to Iran will itself face tremendous economic consequences. Oil smuggling, swap lines, cash transfers, exchange houses, ship registries, front companies, it all needs to stop now." Now, Iran's foreign minister, for his part, responding overnight on social media himself, saying the so-called economic D-Day is a diversion from America's own crisis, unprecedented debt and surging interest costs. Doubling down on failed policies will only bring further defeat and enmity of Iranians. U.S. economic terrorism threatens global economy and sovereignty worldwide. So something else to watch here, Kelly. The Treasury Secretary also teased ahead to this, some kind of announcement to come on fiscal consolidation with OMB Director Russ Vought. But he didn't say exactly what federal spending they're going to target there. So that's something to watch. If the U.S. can sort of rein in the fiscal picture, maybe the bond issue that you were talking about with Steve Leisman starts to get a little bit prettier.
Yeah, well, it sounds like more is to come early next week on that front. Eamon, thanks very much, Eamon Javers. Let's get to our next guest now, who has been warning that a correction is imminent. Neil Hennessy is the chief market strategist at Hennessy Funds. Neil, I think everybody feels like they've been, it's kind of like the better it does, the more we all go, all right, well, we're a bit overdue here. I don't have the Krinsky numbers in front of me, but we're well past how long we typically go without seeing a bigger correction. So I don't know, maybe it's the headlines today, maybe it's a little bit of that reset. How would you describe the market here?
Well, let me first start, Kelly, is that I don't think the market's overvalued. I think.
All right, team, I am back looking again now at the SPY. This time I'm going to stick to my original trading plans and possibly allow this thing to get below the 675. That's what I need. Yeah, should get the cracking. It's another lower high she's putting in right now. What time is it? Maybe I might look at 115 for the next trade. 115. get another opportunity to trade according to my original plans this morning.
The AI trade?
Pardon me?
Do you think the data center pushback is a risk to the markets, to the AI trade?
I think it's a risk because now you have speculation going into data centers on top of it. Forget about local politics and state politics, but you have companies that are building spec data centers. And I'm no genius when it comes to technology, but I do remember that I think the first computer IBM built was the size of a football field. And now you can look at it on your watch. So I'm not sure how this is all going to come together in the future, but I'm sure there's going to be a shakeout. Things are going to become smaller. You're going to have excess inventories. So building these data centers is speculative, to say the least.
And finally, as you mentioned, you do like the idea of selling to the people who are going to be, doing all this activity, no matter how it ends for them, industrials, infrastructure. So when you look through the market, are you okay betting on AI spending, or are you trying to get away from this topic altogether?
Well, I think, I'm not really sure how the AI spending going, because now the spending was going on and it's sort of, they're announcing it and they're spending it, but they're talking, $100 billion used to be a lot of money. Now it's $500 billion. Oh, we're going to do $1 trillion. Well, you can't afford that. So now what we're going to do is we're going to finance you to buy our chips, but we're going to buy your chips because you financed somebody else's. So it's right now it's a wild, wild west out there. And how they're going to figure it out, I have no idea. What I try and do is look from 30,000 feet and say, okay, there will be a correction. No reason to get nervous. No reason to sell. Artificial intelligence in our business has been around for a while. It was called algorithms. And once those sell programs come in, they start to sell, and another program comes in. It can happen just like that, Kelly. And then the retail investor that's retired and saw their savings go down by 20%. I know I don't want any more. I'm out. And next thing you know, she hit rock bottom and you just come all the way back.
Let me ask you and take it full circle to where we started the discussion this hour, which is about this kind of sell-off in bond yields in the 10-year and the 30-year. Some big headlines earlier this week, Treasury interfering now. Because you can take the long view, take us back to the 1600s again if you wish. How do you predict that this will end? Do you think it's wise? What does it mean for you as an investor?
Personally, I haven't seen any evidence that higher rates have done anything to help or hurt companies out there. We gauge it on a day-to-day basis. Steve is really smart. I've known him for years, Gleason, but I mean, we're talking day-to-day here. When you look out and you're looking at a 6.5% mortgage or 6.5, that's not bad. Comparatively speaking, if you want to go back when I bought my first house and my interest rate was 14.5% plus PMI insurance and everything else. But those days, we weren't making the money either that people are making today. So I don't see corporations higher interest rates, and they're not going to go much higher because inflation's not going to go too much higher. If anything, it's stagnant. It's just that we're getting these interruptions with oil. And hopefully we'll get this the Strait opened, and we'll get back to business as usual.
Quickly, Neil, I actually kind of agree with you exactly how you laid this out. No one in the market was really freaking out about the 10-year being at 470. Yes, there's a lot of headlines about the 30-year. Everyone would be happy for it to be lower, but I think that's why, in a way, the Treasury's intervention and the doubling down today makes people wonder, well, should we be going and laying our bets further here and pressing the bet and testing the Treasury and testing this commitment? Where is it going to actually make it harder for the self-correcting mechanism to kick in? And by the way, stocks are basically all-time highs. So it seems that the Treasury's move has added urgency to the situation that wasn't really needed. But maybe they know something I don't. I don't know.
I think you put the word correctly, bet. And that's essentially what's happened. People were betting one way on small moves one way or another, which percentage-wise looks like a huge move, but they're very small moves. When you're really trying to invest, you got to look past the headlines, and you got to look and say, okay, what are we dealing with, and what could we deal with, and what the worst could happen, what would happen after the worst had happened? And that's what I'm saying with the correction, interest rates, the whole 9 yards. It's not scientific research we're doing here. This is history tends to make the same mistakes over and over. The average investor, including the professionals, sometimes make the same situation worse by compounding what they've done in the past.
All right. Well, if past is prologue, I'm not actually sure where that leaves us. I guess it depends on which country's precedent you pick. Neil, really appreciate it. Thanks today. Good to see you again.
Thanks, Kelly.
Neil Hennessy from Hennessy Funds. Coming up, OpenAI CFO Sarah Friar says the firm will be a public company in 2027 or sooner. We'll look at what it'll take to get there amid some fresh new revenue numbers. Plus, former Indiana governor and White House budget director Mitch Daniels will join us with his take on how to tackle the national debt, which now tops $40 trillion. The Exchange is back after this.
This is The Exchange on CNBC.
I'm in the trade. I repeat, I'm in the trade. I'm in the trade. I repeat, I'm in the trade. And I'm in a winning position in the trade. $5,760. There it is.
Welcome back. After a tough Q2, OpenAI's revenue growth is reportedly accelerating again. Kate Rooney has more on that and how it may affect the company's IPO plans in today's Tech Check. Hi, Kate.
Hi, Kelly. So CFO of that company, Sarah Friar, told OpenAI employees that the company's growth has been inflecting.
Is anybody else in this trade with me?
Some new details
Anybody
on
else in this trade with
IPO
me?
timing. From what I'm hearing, Sarah Friar, as I mentioned, told employees yesterday the AI giant will be a public company in 2027 or possibly sooner. This was at a company all-hands meeting in San Francisco. I did speak to two sources who were in the room and attended that meeting. Friar did acknowledge rival Anthropic as well. She said there is a chance that their competitor goes public in September. Friar telling employees that's okay. She said, we are running our own race. From what I'm hearing, she said the IPO, not a finish line. She called it a milestone and another fundraise, and then pointed to the $122 billion that they raised back in March, said that that gives them some flexibility. She said, again, we will be a public company in 2027, and then added, we may go sooner if our business continues to, quote, inflect. But either way, we'll do it on our own timeline. She also shared some new quarter-to-date revenue numbers. Revenue run rate, she said, is up about 35%. Enterprise revenue grew roughly 50% quarter to date. And then Codex, that is the coding side of the business within enterprise, hit 20 million That's up 3.5x or so in the quarter. The growth does also coincide with OpenAI's latest model that launched earlier this summer.
There we
Fryer
go.
did not
That's what I was waiting on.
explicitly
There we go.
mention this Wall Street Journal report yesterday, but it did come out earlier in the day. The Journal did have some details about Q2.
Let's take it to the
That
bank.
quarter, it did show widening losses for the AI giant and slowing revenue growth, at least compared to Anthropic, Kelly.
And now is that the other
take
way
it to the
around?
bank.
Are they overtaking Anthropic, or we're not quite there yet?
It's interesting. Ramp just put out
Take
some
it to the
data.
bank.
They tend to track AI spending pretty well, and they suggest that at least in the near term, OpenAI in the last month or so has been growing quicker. They did the headline for Ramp. They say OpenAI is growing faster than Anthropic, at least this quarter, although Anthropic is right now dominating enterprise and coding. OpenAI still has to catch up in terms of the growth rate. They appear to be growing faster. This data just came out. And so it is sort of, it's whack-a-mole though. They go back and forth. They go from first to second every couple of weeks, it seems. So they are very much battling in and out right now.
All right, Kate, thank you. Kate Rooney, appreciate it. We bring in our next guest for
It's a
his
rolling,
thoughts
not a
here. Dan
stopwatch.
Primack is the
It's not a
business
stop.
editor at Axios. Dan, it's great to have you here. How are you reading all of this in terms of their IPOs, which we're here? Kate said Anthropic could be October. Our guest this morning said Anthropic could be the end of September. What do you think?
Yeah, I'm hearing similar to what Kate is. I think Anthropic goes first. Again, unless something changes. And I don't think what that something is who's overtaken who on revenue. But yeah, everyone seems to think Anthropic's going to be flipping its S1 sooner than OpenAI will. They just seem more ready to go.
But, okay, why don't you think the revenue growth is the key thing here?
Because as Kate said, that 1 month it's one company's ahead, the next month the other company's ahead. Ultimately, if you're the public markets, IPO buyers, big hedge funds, mutual funds, et cetera, you're probably going to feel you have to buy both of them, because it's right now it feels very difficult to say we're betting Anthropic's going to win this, we're betting OpenAI is going to win this, when neither one has really shown sustained momentum in being able to do that.
Well, the SpaceX, I guess, is the analogy, because these are so big that everyone has to worry about they go in the index and then you have to own them. But again, that traded highly volatile after its debut.
I mean, SpaceX has been highly volatile. Part of it, relatively low float. Obviously, the first lockup expired. And SpaceX has not been a very good, well-performing IPO post-IPO, right? The IPO itself was gangbusters, was a lot more than anybody thought, but the shares are trading below the IPO price. They're trading well below the first trades. So really almost anyone who bought it in the public markets or on day one is underwater on that. That could weigh on both Anthropic and OpenAI from a multiples perspective. But again, when it comes to but ultimately they should both be able to get out when they want to. OpenAI has the secondary issue, which isn't the financials. It's the C-suite turnover, right? They've had a lot of changes in management. Anthropic's had a lot more stability, which probably lets them go a little bit earlier.
We are putting the question on the screen there. Will OpenAI ever go public? Does the answer have to be yes? I mean, would you rule out some kind of deal in the future?
I mean, look, obviously, if OpenAI was to collapse, and you could have some sort of weird fire sale. But yeah, it needs to go public. It's brought in so much money. Now, could it continue to raise money in the private markets? And is there a lot of private market liquidity? Yeah, there is. And this plays into a little bit kind of one of the big M&A stories yesterday, which was Stripe, which did a big acquisition. And from speaking, and it was mostly in stock. And I would speak to investors saying, why do you want stock in Stripe? They're never going public. And the answer from them was, we think there's enough liquidity in the secondary private markets that if we want cash, we can get cash. The same thing is true about OpenAI, but the numbers are so much larger. It can't kick that can forever. And unlike, say, Stripe, it has huge losses. It does need more actual primary capital.
It's funny you bring up Stripe, because just yesterday on this show, Sam Lessin was on. He was talking about OpenRouter. In fact, he was the one saying, don't get carried away about who's in the lead on this revenue thing because of OpenRouter. They're the next big thing, he was saying. At literally almost the exact same time, Stripe announced this deal. The deal for OpenRouter makes sense, a hot part of the market. Stripe doing it, I'm still trying to understand.
Yeah, so I've heard kind of two arguments on this, but the one that I found most interesting is from one of the seed investors who did this deal at Andreessen Horowitz. His argument on this, and he's got a blog post about it, is that this is less about the marketplace, although the marketplace matters, right? Stripe wants to be part of the token economy. To be part of the token economy, OpenRouter makes sense because it's kind of the back-end Expedia of AI. But what he was arguing was a company like OpenRouter has this huge data set, security data set. It kind of knows when agents are kind of going rogue. And if you think about Stripe right now, it's all I buy something or you buy something or a company buys something. Going forward, a lot of that's going to be agents making autonomous purchasing decisions, and Stripe's going to process those. OpenRouter has a very good data set when it comes to what agents are doing and when you can identify when an agent's doing something wrong as opposed to a human doing something wrong.
See, that answer captivates me with the idea of where this is all going. I mean, they were talking about the singularity. You're at least helping me understand and try to wrap my head around it. It's really a sign of where we might be headed next. Dan, thanks. Fun to watch the art behind you always get better and better. Good to see you again, Dan Primack of Axios. Coming up, I bet you didn't know that Boise, Idaho is the birthplace of one of the world's biggest and most significant chip makers. Up next, we'll look at how that company is reshaping the economy and minting millionaires in the Mountain West with the stock up 8-fold in a year. Welcome back as we're keeping an eye on the Dow, now down 500 points today. It's kind of the barometer. It's down 1%. The S&P is down 0.5%. NASDAQ down 1%. Russell down 1.3%. Here are some of the movers. Deere in the spotlight. Here's a positive one after posting its first quarterly profit in 3 years. A profit increase, I should say. They're also raising the low end of their net income forecast, saying 2026 will mark the end of the ag equipment cycle. Jim Cramer this morning said he believes them, and the shares are having their best day since February, up 7%. Bitcoin also showing some signs of life after President Trump renewed his call for Congress to pass the Clarity Act. We heard Brian Armstrong weigh in on that this morning positively. It's boosting crypto-related stocks like Mara Holdings, Strategy, Circle, and Coinbase. And Moderna having its worst day ever, but come on, it just had its best day ever. It's down 25% today after rising 176% yesterday. Not only was that Moderna's best day on record, it was the biggest single-day gain for any stock in the S&P 500 in a quarter century. That's according to Nick Wells and Dow Jones market data. Let's get to Contessa Brewer now for a CNBC News update. Hi, Contessa.
Hi there, Kelly. At least 16 people were killed and dozens more injured in Kiev after Russian missiles struck the Ukrainian capital early this morning. Ukrainian officials said the deadly barrage hit food warehouses and Red Cross facilities. The city's mayor wrote on social media that buildings in several districts were damaged. The pilot of a small plane was killed in a collision with the Pennsylvania State Police helicopter west of Harrisburg. Authorities say the Cessna veered into the helicopter as it approached the runway. Both troopers aboard the helicopter were initially trapped but escaped, and their conditions are stable. The FAA and the NTSB are now investigating. The U.S. Open will give $108 million to winners of this year's Grand Slam tournament. The 2026 prize pool is 20% higher than last year's $85 million, and now the largest purse in tennis history. Singles champions will receive a record $5.5 million, and doubles and mixed doubles winners will bring home $1 million per team.
People are already complaining about the cost of what do they call it, the grounds pass? Then don't go. Then don't go. I don't know why.
I mean, when you go, it's so much fun. It makes there's a return on the investment. So
well, if there is, then spend the money and go. I don't know. Here's what I'm saying. We can brace ourselves for a month of stories about how expensive the U.S. Open is. Contessa, thanks very much. Contessa Brewer. Coming up, tackling the national debt with someone who spent a lot of time at both the White House and the Indiana State House. Former Governor Mitch Daniels joins us next.
As our country celebrates its 250th anniversary, CNBC spotlights the leaders driving business and the nation forward.
When I think about America, I think it's always been the dream to make your own success. I think if you show up, work hard, you got a chance no matter what you choose to do. I'm John Tyson. I'm the chairman of Tyson Foods. My family company is 90 years old, and my granddad left Kansas City during the Depression, headed to Arkansas with a truck, just trying to pay the bills. And he started trading fruits and vegetables. So basically, we were traders for about the first 10 or 15 years. Today, we are a large global food company. Tyson Foods is a domestic-based U.S. company, but we do have a footprint around the world. I think food in America started out as a small farm-type operation. I would say the farmers in America were the backbone that got this country started. I would say they're still the backbone in America, and without the American farmer, we don't have a chance to do all the great things this country does. The one word that to me describes America is perseverance, the perseverance to make a difference. And that allows us to have the fortitude, the will, and the wherewithal, no matter what is being presented. We figure it out, we make decisions, and that's what makes our country great, and I think that's what makes our country succeed.
Welcome back. President Trump came to office hoping to cut government spending, but his DOGE efforts got off to a rocky start. Then the Supreme Court struck down his tariff collections, and his big, beautiful bill has decreased corporate tax revenues, all of which means the deficit could now be actually worse this fiscal year than last year. Our next guest had direct experience with these budget fights 20 years ago, when it probably seemed unimaginable that we'd quickly amass $40 trillion in government debt. Mitch Daniels is the former OMB director, former governor of Indiana, and current interim president of Purdue University. It's great to have you back. Thanks so much.
Hi, Kelly.
Can you solve this for, I mean, if you kept Purdue tuition low. I don't think you're giving kids, non-grades yet at this. Can you solve this for us?
Well, it's pretty nearly insoluble at this point. We've waited far too long as a country. There were times when we could have solved it without some serious disruption. We're going to now, procrastination by both parties, has to be said, has put us in a position where arithmetically, I think we're going to have some difficult days ahead. But it's still a good idea to get started. I think the idea of a commission, we've had them before, that would begin by addressing where the real problem is. The real problem's in the so-called entitlements programs, which consume over 2/3 of our budget now. And, we've got to get serious about right-sizing those, helping the people who need them the most, and sparing to the extent we can taxpayers from really ruinous tax increases.
I don't see any. I mean, I give up. I give up. We've seen both parties, Democrats try to raise revenue. Maybe they need to do more so. The Republicans say they're going to decrease spending. It seems like nothing. There is slight improvement. I don't want to overstate it. I mean, if you squint, you can see slight improvement in kind of the deficit over the past couple of years, to be sure. Do you think it's appropriate for Treasury to be taking the measures it's taking to try to keep those longer-term yields down?
You must have better eyesight than I do if you can see any real improvement here. I don't, unless by contrast with the latest really egregious move, which was the so-called Inflation Reduction Act, one of the great misnomers of recent public policy. I think the move on the bond buyback is, as someone said, looks like panic. Maybe it is. It won't make much real difference. Maybe trying to buy a little time ahead of the election.
So the fiscal deficit, this is Mike Darda, he follows this closely, was 8% of GDP in 2023, coming out of the worst of the COVID spending, to just over 7% in early 25, to 5.9% currently. Because we have to remember GDP is growing even while we're running these numbers. So it is, 2 points of correction in the past couple of years is a help. And that's why, again, this is kind of a confusing time. It's getting better, but then we get these kind of emergency intervention measures. Anyway, is there any last comment that you'd make about, is there any low-hanging fruit left on either piece of the equation, revenues, spending, at this point? Because we're coming up to the midterms, and the calculus is going to change all over again.
There's low fruit. The federal government's doing a lot of things that it shouldn't be doing at all. Others it is doing, which might be worthwhile, but it's doing them poorly. There are some ways, clearly ways, that would not be growth inhibiting, that we could raise greater revenues. Tariffs, in my opinion, is not one of them, by the way. But we have waited far too long to do this in a way that protects either the economy or the most vulnerable among us from some disruption. We're just, it's really, I'm afraid to say, an indictment of our maturity as a democracy, that we've had leadership who refuse to face up to this fundamental responsibility to take good care of the dollars we confiscate from free citizens. And as a people, we've not demanded that of our leadership. So we're going to go through a fairly wrenching time. They'll probably try to inflate away part of the problem. Maybe continue what's called repression by artificially lowering interest rates, which hurts savers and others. But the time when we could have done this with modest dislocation for people, I'm afraid, is past now.
Yeah, it seems to me there's two very different views of what to do. On the one hand would say, raise revenues, raise taxes, fix it that way. The other hand would say, cut spending, cut entitlements, do it that way. And the standoff means we're going to have, repression, like you said, in the meantime, trying to kind of just paper over what's really happening, which is kind of dangerous in both sides. Can we talk about something a little more lighthearted? It's not at all, but University of Michigan. Liberal arts college, okay, not the whole thing, says that it's going to replace letter grades with a pass-fail to kind of help kids ease into college with the adjustment. And I did want your point of view on this. Give me as serious as you can the case for why colleges should do this, or why we shouldn't all just throw our hands up and worry that the system that was supposed to prepare kids for college has failed. Now colleges themselves are doubling down on the error, and it all just feels like a waste of all these years.
Well, Michigan, which is a great university, is dealing with a real issue, which is that for reasons which sociologists and psychologists have been itemizing for us, a lot of young people are showing up very fragile, very unprepared emotionally. They may or may not be prepared academically, but they tend to crumble at the first sign of difficulty. What they've done there is not entirely unprecedented. Others have tried it. Some, like Johns Hopkins, tried dropping first-year grades and found it a mistake. So we'll see what happens at Michigan. But, at Purdue, we have a different view of approaching a very real problem. Our view is that we need to press young people, challenge them, and try to help them improve that way, and learn to deal with rigor in the classroom. Our grades are harder to come by. We've tried to resist the grade inflation phenomenon, which is so prevalent.
Sure.
And as I said to our incoming freshmen the other night, our goal really is to help them grow and stretch and be as good as they can be and as accomplished, and to leave ready for lives of leadership. And leadership in any realm involves difficulty. That's right. The defining characteristic. And we think it's better to try to foster what we usually call grit in our students, resilience. We have all sorts of systems for supporting them, trying to help them with that, but not shield them from it. And but again, it's a good thing in this country that we have a complete variety of schools. All are different. And that's the way it should be.
Well, it's incentives. The incentive for most colleges is to have a high rate of students getting jobs, and you can do that through better grades. And the incentive for high schools is to get kids into colleges. You can do that through better grades. So I think someone also has to be courageous in saying that, lower grades for taking a risk can also be rewarded with better outcomes. And I think that will help change things. But Mitch,
Kelly, if I may, yeah. Purdue was recently found to be the first or second most valuable school in the country, specifically by comparing the success of our graduates to the cost they paid for the education. And believe me, from talking to employers, they know the difference between a school like ours, where grades have to be earned and are not easy to come by, and those where the average GPA, astonishingly, is closer to 4 than 3.
Right, exactly. Well, we appreciate you taking some time out. I know you were just addressing the freshmen to address us as well. Really good to check in with you. Mitch Daniels, governor, former OMB director, interim president at Purdue. Coming up, Micron is now committed to investing $260 billion in domestic research and development. While much of that will be over the next few years, the company is already changing the lives of residents in its home city of Boise, Idaho. How the newly minted Micron millionaires are investing next.
Micron has what it takes to build out this large infrastructure, large fabs. Over time, 40% of Micron's leading edge memory will be produced here in America. Yes, today it is 0%, but it is through all of this amazing team that Micron has today, and over time, we will be hiring. Micron itself, right here, will be adding 3,500 technicians, operators, engineers. And by the way, half of those jobs do not require college degrees. Over time, Micron's $250 billion investment here in America will create 90,000 plus jobs.
That was Micron CEO Sanjay Mehrotra speaking to Mad Money's Jim Cramer in the company's home city of Boise, Idaho earlier. Micron announcing they'll spend $10 billion on a new research lab, which will create thousands of new jobs. Paired with the company's new chip plants, Boise is becoming something of a boomtown. CNBC's Katie Tarasov joins us now with more on that story. Katie?
Yeah, that's right, Kelly. So in addition to this research facility, Micron is spending $50 billion to build 2 new memory factories in Boise. You saw them behind Cramer there. It says these are going to create 17,000 of those new jobs. And like you just heard Sanjay say, 3,500 of those are going to be directly with Micron. And that's a lot of new employees, some of them with stock awards that could make them fast millionaires. CNBC's CJ Haddad and I talked to people in Boise, residents, and got a feel for just how this $50 billion is going to change the region. We also talked to one wealth manager who now works almost entirely with Micron employees.
We actually had one gentleman who was very blessed with the amount of stock that he had, mostly Micron. And when he came back in after 8 days, he said, "I'm $1 million richer." In 8 trading days. When you have a stock that goes from $100 a share to well over $1,000 a share, and you have people concerned how long is that going to last.
So the memory industry is usually boom and bust. It's like a cyclical type industry. And with giant memory fabs also coming online from SK Hynix and Samsung in South Korea, the market could really see a glut. So that's one of the risks here. Idaho already has the fastest population growth in the nation, and there's been a 4.5% rise in homes sold above listing price since last year, topping national averages. Residents told us their biggest worries are about traffic, water, and power, but the local utility, Idaho Power, says bills won't go up, and Micron says it's going to recycle its water. Back to you guys.
Spent some time there reporting trips 15 plus years ago. So it's incredible to see what's happened with the city in the meantime. Katie, thanks very much. And don't miss Jim Cramer's full interview with Micron CEO tonight on Mad Money at 6 p.m. Eastern. Coming up, our 5-star fund manager says while real assets like gold may become more relevant, now's not the time to get bearish on stocks. It's time to get broader. Where he's putting money to work next. Welcome back. Our next guest warns that the biggest shift of the 2020s has been the emergence of fiscal risk in the world's reserve currency. In other words, in the U.S. dollar. That said, he also says don't get bearish, get broader. Matt McClennan is head of the global value team at First Eagle Investments. Matt, it's good to see you. And you're kind of speaking to people's concerns about all of these headlines and even the events of this week. And what would you say the impact is going to be across stocks and other asset classes?
Well, number one, it's great to be on and great to see you again. And I think that the key thing that we've been focused on the last couple of years in terms of the emerging risk profile in the world has been the fiscal shift, not just in the United States, but globally. And investors need to assess what that means for their portfolios, because we see this trend towards rising real interest rates. And we've seen more inflation the last few years. And I think investors have, in a very concentrated way, tried to buy a slice of the future through their AI-related investments. But I think one of the things that investors may be missing that's an opportunity in the current market backdrop is what we refer to as the ability to invest in assets that embody deep time. Now, what do I mean by that? Think of gold, for example. It's endured well before us and it will endure well after us. And civilizations keep coming back to it. It's a store of real value. But there are businesses that have the same underlying participation in deep time. And one example I would just throw out there is a company like Weyerhaeuser, which is a timber company. And Friedrich Weyerhaeuser said, this is not for us, not for our children, but for our grandchildren. You have this perpetual land optionality and the ability to replant over time and optionality on carbon credits and the like. And there are other businesses around the world that I would say investors should focus on outside of the AI narrative that control brands that have been around in deep time. Think of LVMH, its key brands, Louis Vuitton or Moët Hennessy, been around for over a century, or Heineken, where Heineken and Amstel have been around for over a century. So I think in a moment where investors are very focused on the here and now, it's a time to step back and think about what persists through time, because these are scarce assets, and scarce assets tend to do well when there's fiscal trouble.
And what you're saying, in other words, is it's land, it's gold. Gold bullion's like 9% of your portfolio. Things with great brand quality that kind of can survive, era to era. And yet, I will say, in spite of all of that, I mean, we're talking about the stock market. It itself seems to be a decent thing to hold during times like this. The stock market, in some ways, is a real asset, too.
In some ways, the stock market's an aggregation of different businesses. There are a number of businesses in the stock market that are much younger in duration. That they could be exciting call options on the future, but they're not necessarily what I would refer to as participants in deep time. And so the stock market's an aggregation. There are a range of financial companies, for example, that are more nominal than real assets in nature. So I think you have to be a little bit discriminating and look beneath the surface of the market and identify the kinds of assets that embody scarcity and look at the subset of those that are available with a margin of safety and price. And we refer to that mindset as one of scarcity value. But I think just owning the market as a whole exposes you to what is popular today. And there's a great deal of concentration in markets today relative to history. Markets are incredibly sensitive to the AI narrative. Now, I think many of us would agree that AI can be a transforming technology, but it's not going to be linear. And the market already embodies very high expectations in general about future profit margins. And so I think taking a step back from what is the dominant narrative at the moment and broadening the horizon and intentionally curating a portfolio that has scarcity and value is important.
Matt, few can get into something so deep in such a short period of time. We'll bring you back soon. Thanks so much, Matt McClennan with First Eagle Investments. That's it for us. Power Lunch with Brian Sullivan is up next.
Stocks are sinking, yields are jumping, and the bond market apparently not buying what the Treasury is selling. Welcome to Power Lunch, everybody. With Kelly, I'm Brian. The bond sell-off reigniting, even as Secretary Bessent defending bigger buybacks right on our air. Robinhood's Stephanie Guild, SMBC's Joe Lavorgna, former White House insider, and PIMCO's Jerome Schneider, all here to weigh in on what's going on.
Plus, crypto comeback, Bitcoin back above 70,000, crypto stocks surging, and Trump giving the Clarity Act a fresh push. We'll debate where crypto goes from here with VanEck's head of digital assets. And retail earnings are in full swing. Jeff Kilberg is shopping for upside, not getting it in Walmart today. His list of best buys right now.
Yeah, so we've got a lot to do today, but let us start right here in the bond market because yields, they're rising again, reversing yesterday's decline. This despite the U.S. Treasury's bigger than expected buybacks. And if you've been watching or listening to CNBC in the last couple of days, you know that our friend Rick Santelli has been fired up. He joins us now. Rick, you've been very, I will say, passionate about what's going on in the bond market. You've pushed back about what some people in the market have been saying. What exactly right now are you so worked up about that you think maybe others are getting wrong in the market?
Well, I don't know who's getting anything right or wrong. I didn't get that memo. All I know is that I'm a lot more fired up than the Treasury market is. The Treasury market isn't fired up. Can you see the net change right now, Brian, on crude oil? October. Do you see October, the new lead contract? How much of a percent is it up today? Do you see?
I'm not looking at, there we go. It's up 2.03%, Rick.
Wouldn't you suspect that that might push yields up a bit?
Yes, so you think oil is leading the bond market rather than the other way around, obviously?
Oh, absolutely. And I think that to try to push this on a memo that's going to potentially raise the buybacks, and the Treasury Secretary said it much better than I could this morning. It's August, and those are thinly traded. And when he talks thinly traded, there's only three maturities he's earmarking, 10s, 20s, and 30s. He certainly isn't talking about 10s. He's talking about 20s and 30s, and it's hard to disagree with that. He is, after all, the Treasury Secretary. This is in his purview, and I don't mind a more proactive Treasury Secretary compared to the status position of many of his predecessors.
But I know that there's some smart people out there like our friend David Zervos of Jefferies and others who would say, well, he's really the only, quote, bond vigilante. I know you don't love that term, but he's the only bond vigilante that really matters right now. But I think what's catching the market's ears and eyes, Rick, is that this buying announcement by the Treasury came just 2 weeks after a refunding. And I think the timing of it is what's capturing some people's imagination, for lack of a better term.
Yeah, no, once again, it's hard for me to weigh in on a topic where I just don't see that the market's bearing any of this out. Now, to think that you couldn't find Fed officials or you couldn't find traders at trading desks that don't like this or don't like the Fed, absolutely, I'm sure there's boatloads. It doesn't mean their interpretation is the correct one. And let's draw attention to maybe something nobody's pointing out, but it's always a big deal. I've been doing this for a long time. Midterms are coming up. It's silly season.
Rick, we will see you in a moment with a special guest, no less. Let's get a variety of perspectives here on these stories today. Let's bring in two voices to weigh in on this debate over how Treasury, what its moves mean here. Stephanie Guild is the CIO of Robinhood Markets, and Joe Lavorgna is SMBC America's chief economist. Welcome to both of you. Joe, let me start with you, okay? What is your take on this whole thing?
Kelly, thank you. Most of the sell-off or rise in yields occurred from last October up to May. And that reflects the fact the economy is very healthy. U.S. economy is booming, especially relative to the other industrialized countries. In the last couple of months, we moved up from 450 on 10s to 470. But these are kind of more normal levels, Kelly, and the equity market has performed very well.
I don't disagree, but Joe, here's my point. This is exactly what Neil Hennessy said an hour ago as well. There's no panic except by Treasury.
No, I don't think there's a panic. I think that the Treasury market, there's been a desire for some time for private market participants to increase liquidity purchases. So that's not to be
Who's in this car with me to the bank? Who is in this car with me to the bank?
Especially from the tariffs and the fact that the expensing related to the One Big Beautiful Bill has cost money technically, but these are investments in the future. I wouldn't get worried about yields at these levels, Kelly. I'd be worried about it if the economy was weak, but the economy is healthy.
I'm not worried about yields at these levels. Again, the stock market's at all-time highs. It's notable that they're at these levels. It's notable that on Wednesday we hit a 2-decade high on the 30-year. The next day they come out with this announcement. Usually these announcements are made during a refunding. We just had that 2 weeks ago.
No, they are, but I think, yes, but here's the thing. The market has sold off to reflect a much better economic outlook. And I think that is really the key point that one has to look at. And, we've been at these yields before. Yes, you say they're the highest in 20 years, but again, we had a period of zero rates and forward guidance for the better part of a decade and a half. So we're going back to a more normal regime, a regime that is much healthier for the U.S. economy, where you get some wage growth tied to productivity. Those are all positive. So I think that we have to put it in the context of where rates were for the better part of the last decade and a half. We're going back to more normal levels. That's a healthy thing. That's a good thing.
I don't know how issuing more bills is taking us back to more normal levels.
But if you're looking at the bills, Kelly, we've historically issued between 20 and 25% of net marketable issuance has been in bills.
Yes.
That's where the Treasury is going to go back to. Now, if it turns out the deficit is much worse, then yes, the Treasury will have to increase more supply on the coupon side. But we're going back to bill issuance levels that are normal, in line with historical average.
To your point, Joe, listen, the 10-year, and let's focus on 10 because there's no new 30s. They're kind of their own thing. The 10-year has been the most stable really it's been in a range for 20 years. I mean, the last time that we saw a 4-year period where yields were less than 1% of a swing was, I think, the mid-2000s. Now, maybe that's a bad reference given what happened at the end of the 2000s, but you get my point. But let me ask you this more directly, Joe. Do you think Treasury is stepping in and doing what they're doing? Don't call it QE. It's sort of a twisted version. They're doing it because they're afraid 10-year yields will hit 5%. And if yields hit 5%, that will hit and hurt the stock market.
No, I don't believe that. No, I don't believe that, Brian. I believe the Secretary is very forthright and honest with what he's saying. And when you look at the sell-off in yields, it happened, or I should say, this sell-off from last October, we hit our low during the
Wilson is called with me to the bank.
And it's been a very orderly rise.
Beautiful trading being done right now.
Then,
Beautiful
and again,
execution.
That largely reflects much better growth prospects because as Secretary mentioned today, you look at real yields. That's what's been driving most of this sell-off.
Beautiful control selling
the rise in rates. And tips, break-even inflation expectations have been stable. So it's been almost a monotonic rise over the past 7-8 months. And therefore, I don't think there's any panic or worry on Treasury's behalf.
Yeah.
They're trying to make sure the market liquidity conditions are healthy. August typically is a very quiet month. This August may be more quiet than normal. I don't see anything incongruous here.
Joe Livornis, while we have you on, though, we're trying to clear up exactly what's going on. There's a lot of headlines out there. But, Joe, we help you.
A lot of headlines, and I think, Brian, people are getting a little bit too worked up over things they probably shouldn't get worked up over.
Fair enough, but Rick was worked up on the show yesterday, kind of yelled at Kelly this morning on Squawk Box.
Rick gets worked up over a lot of things.
There we go. It's mid-August. It's hot. It's going to rain again. I'm going to get worked up. Joe Livornis, thank you very much. All right, we've got Stephanie Guild, CIO of Robinhood. And we're not going to ask you the machinations of the Treasury market, Stephanie. Don't worry. I know you can.
It's part of the market.
It is. And let me ask you this, because I know you've also got like the cool list of what your clients are buying. But let me ask you as the CIO, do you see the Robinhood clientele worrying about bond yields right now? And if so, how would you measure that? What would you look at as a CIO to know how the bond market may be impacting the stock market?
I think a couple things. One is I think the bond market is now like the stock market in that in the short term it's a voting machine, in the long term it's a weighing machine. And what that means to me is that you can't necessarily control, like when you see the five-year inflation measures not really moving, but the 10-year going up, that means real yields are rising, and it's really hard to control. Yes, we are in a seasonally kind of quiet period. Everyone's on vacation. But I do think that the signaling from the Treasury is that they aren't comfortable with higher yields, and they can't be when you have $40 trillion of debt. I
I
also
would
think
say
you're
doing
seeing
what
time-
I will editorialize and say that what the Treasury Secretary is doing, and I don't want to put words certainly in his mouth, but I asked Joe, is he worried? Do you think he's worried? And Joe's a former White House insider, that yields will hit 5%. Joe said no. I think Treasury Secretary would probably say no as well. But are you? Because there have been people on the show that have said 5% might be sort of the breaking point for that weighing
Any
machine.
continued rise is going to be a negative on the fact that you have bond issuance rising. You have double the amount of corporate bond issuance this year than you had last year. Most of it is coming for the AI build out. And the fact that you have the AI build out, which is fueling the growth, the strong growth that we have, you have to make sure that things are going to keep moving that way. Otherwise, you're going to lose the growth too. And that's not a good idea. But in terms of our customer base, you do see them being a little bit more careful about the longer duration stocks, the things that don't necessarily show debt today, right? And they step into things that go down a lot. So Broadcom was down a lot because of the semi-analysis piece. They were stepping into that. They were buying SpaceX when it was down a lot. Those are the longer duration names that when they sell off enough, they use that as an opportunity.
Where else would you be looking? I think it feels like we're already moving on to get ready for Anthropic. Could be in a month. We're still digesting SpaceX, and it's going to be Anthropic. I mean, this is where I think a lot of the Robinhood users are. Although we were talking to Steve Quirk the other day, who said they're kind of in Google and Apple, like you said, Broadcom, and things that almost have a little bit more of a value bent to them. They were selling stocks over the summer. It's kind of unusual.
Yeah, they were, especially in July when things were just feeling like a little bit more nervous making for everyone, I think. I think the most important thing is when you look at when you look at kind of options market, skew being very low, I think VIX being really low, these are all signs to kind of be a little bit more cautious. And while buying is back in our customer base, you're not seeing it as strongly as you were maybe earlier in the summer. And they are today, Walmart's down, not earnings that were a little bit more
Down 9%. That's a big move for Walmart.
They're
rolling back prices.
It's the kind of opportunity that our customer base actually looks for.
So tomorrow, you might see action in Walmart on Robinhood.
You might.
Are you winking? What's happening right now?
I'm just saying these are we see big sell-offs. That's when they make their moves on the buying side. And then when things are up a lot, they take profits.
All right.
Stephanie Guild of Robinhood, really appreciate your insight. Thank you.
Appreciate it.
All right, now let's get back out to
All right,
Rick
guys, I'm
Santelli.
finna take a cruise.
He's got more action in
And
the
then
bond
to
market.
watch.
He's also got a
And then the
special
market
guest.
do
I
its
don't know if you
thing.
heard anything that we just talked about. You
We
might
got
want to
in
jump
at
in on that as well, Rick.
265.5. She's
Absolutely. Thank you, Sully. This is Jerome
Right
Schneider,
now she's
Managing
at
Director of PIMCO. By the way, every Monday,
Alhamdulillah.
Tuesday, and Wednesday when we see all those humongous sized T-bill auctions, who the biggest player is? Right here. This is him right here. All right, Jerome. Sullivan and the world want to know what you think about the buyback announcement yesterday. That memo, not really an intervention. No actual bonds were bought yesterday. But what do you think?
It's a signaling effect, simply that the Treasury is paying attention to what the bond market is doing. It's their job. It's also their job to issue debt. So we should be focused on the macro, what's going on in the economy, number one. And number two, what's really creating this upward momentum in rates? It's a fulcrum of several different things. Number one, lingering inflationary concerns that are participating into the economy for the war. Number two, we have a competition for capital that's evolving not only from the private side, which we know from the AI demands on the equity and debt side, but globally on the fiscally public side. Not just the United States, but globally there's a demand for this. And so when we think about these two things together, the term premium, which is the third element, is really pointing and pushing rates higher.
Look at the
across
30s
yield
to
curve.
10 spread. These spreads are all widening.
It is widening, but in context, again, Rick, is very important. Rates have only increased across the curve 10 to 12 basis points over the past 3 months. So having a calm and methodical approach to all the signals and discussions that's going on at the Fed, in the marketplace with traders, it's a rational
Now,
discussion.
that's a good place to start our second tour of question here. What do you think of the Warsh Fed? Near term versus medium to long term?
Well, near term, everybody's expecting more volatility because of the lack of discovery, et cetera. The longer term is probably a lower volatility environment. Well, why is that? You're going to have a methodology that tackles the two main points, Fed and inflation and growth, and at the same time, you're going to have a more flexible Fed that probably has some opaque optionality to it, but ultimately leads to an environment where they can react quicker if they do need to react.
Okay, now bills, as I pointed out, you make the bid to cover in these auctions. You create where the when issued market is ultimately traded. what do you think this massive issue of T-bills in the big picture means in terms of how the Fed and the Treasury look at the yield curve?
So I think ultimately it's a fiscal issue where they have to think about an even issuance across the yield curve, and they've done that with the free funding announcements. They're also, it has the incremental needs and financing, which clearly come in the T-bill issuance. We've had over $450 billion of incremental T-bills within the past 3 months, and another $200 billion over the next few months. What's more important, though, as an investor, is recognize investors want optionality. They want to make money on their cash. They can do that in bonds and fixed income in not only notional returns, but real inflation-adjusted returns. And so while all this uncertainty is happening in the marketplace, it's very easy to earn on your cash 5 to 6% in short duration type of strategies, and more importantly, broadly derive income in a real inflation-adjusted returns across fixed income. That's a more rational approach to take and not necessarily react to the next Fed meeting, the next announcement that comes, or even trader discussions that happen on a day-to-day.
Okay, we're out of time, so I'm going to ask you one question, short answer. Do you think the Fed's going to raise rates at SEP meeting?
Well, unlikely. We think they're on hold for the remainder of the year, but it's obviously data dependent.
That's it. Stop. Remain on hold for the rest of the year. Gee, I've heard that somewhere before, like at home, 20 times a day coming out of my mouth. Back to you guys.
Who are you telling that to at home? Like, Rick, who are you talking to who's asking you?
My kids, the generation that's getting, not getting treated well with the generational theft going on. They're the ones I talk to.
He almost said something else. He said they're the ones getting worked over, I think would be the polite way to say it.
Yeah, you did, almost. Almost, but the lawyer in my brain worked.
I saw it. I know. I could see it even from here, even though you're in Chicago.
Rick and Jerome, thanks. Appreciate it. We have a lot more planned this hour. Crude oil prices are creeping back up again. How high are they headed? We almost touched 90 today on WTI. And the big question of the moment, can the market handle more mega cap tech IPOs? We have a banker and a tech insider here to weigh in. And some discount shopping. Our trader has some bargain picks for you. But first, crypto prices are surging again. Is it time to buy back in? That's next. Here's something we haven't said in a while. Crypto is rallying again. Bitcoin is back above $72,000 after the Treasury Department's surprise announcement yesterday. Boosted risk assets, you could say debasement assets. Anyway, that isn't the only catalyst for crypto. Coinbase CEO Brian Armstrong joined CNBC this morning, sounding confident about next month's Clarity Act vote.
I'm pretty optimistic it'll get over 60 votes, and I think both sides got 90% or so of what they want, which, in any deal I've been a part of, that you say yes to that deal.
Well, prediction markets aren't sharing his optimism. Kalshi is pricing in just a 23% chance that Clarity becomes law by year end. Joining us now is Van Eck Fund's head of digital assets research, Matthew Siegel. Matthew, good to see you. What odds would you give it? You've been prescient. I noted when Bitcoin started rallying again, I remembered you telling us to maybe look for a little bit of that upside. But what would you say about Clarity at this point?
I don't think this move is about Clarity at all. I think this is all about what the Treasury has done, and it is reigniting these fears of fiscal dominance. I heard your last guest say that T-bills as a percentage of the marketable debt is normal range. I disagree with that. The Treasury's own advisory committee recommends T-bills around 15 to 20% of marketable debt. We're at 23% and going higher. So as the Treasury finances more of that debt on the short end, it hits the fiscal balance immediately. It makes keeping rates high increasingly expensive. Something has to absorb that pressure. The market's telling you it's the dollar. And over the last 15 years, the only persistent correlation that Bitcoin has shown is a -1 with the dollar. So, we think this ultimately means lower real rates, a structurally weaker dollar, and Bitcoin is one of the best hedges you can find on that dynamic. So I don't think the market's looking at Clarity right now.
I think you just said it perfectly. I think you just perfectly encapsulated why we've seen the move the last day and a half that we have from the Treasury's announcement. Everybody else says that people like me are overreacting. I don't think so. I think it's a big deal what they're doing. Now, we might disagree about whether that's expressed in Bitcoin or in gold or what have you. We should show the dollar as well, the DXY maybe. And this is why you look at Japan and what happens. They're capping what can happen with rates, and so people are shorting the currency. They're pushing it lower. I don't want the same thing to happen here, but you're positioning for it. I mean, you know what I mean. We sort of feel like that's the path that we're on. Is that right?
Yeah, I think it's easy for policymakers to handle a slightly weaker dollar and a little bit higher inflation than it is an exploding budget deficit. So, yeah, I think it caps rates, and that's where Bitcoin shines. And the interesting thing about it is, for Bitcoin, is that it came at a time when, given the 4-year cycle, Bitcoin was already looking very late in its correction. The average bear market is about 12 months. We're 10 months in. We look at a lot of metrics around the average cost basis and what the derivatives market is saying. So we've got these 12 capitulation indicators. They've all fired a positive for Bitcoin in the last 3 months. 8 out of the 12 are positive right now. Volatility was at an all-time low, so it was a coiled spring, and I think it goes higher.
So where does it go quickly? And running short on time, but that's what most people care about is 100K now, later, in the future. I mean, could it go high? But in all seriousness, what do you see as likely to be the next move? How high? When?
Well, so far the move is all short covering. There's been $3 billion of short liquidations in the last 24 hours. It's an all-time record. So, feels like if we get the real money stepping in, maybe we go higher. Nothing is in a straight line. I told you guys 100K would be next year. Still believe that. And then, long-term, 2029, say we can hit 500K if the cycle plays out as usual.
Well, I think you got our attention. Matthew, thanks so much. Really good to see you. Matthew Siegel with Van Eck Funds, head of digital assets research.
All right, crude oil is on the rise again. Is oil heading back to $100 a barrel, or will the mystery crude coming out of the Middle East save the day? We'll get into it with Josh Young of Bison Interest next. An economic D-Day. That is how President Trump describing the pressure he is preparing to put on Iran. And on those comments, as well as continued concern about oil flows from the Middle East and more risk around the Russia and Ukraine region, oil prices are rising again. And as we just said, it's not just about Iran. Today, Romania scrambling 2 F-16 fighter jets to destroy an explosive-laden marine drone near a major gas platform in the Black Sea. The video you're seeing right now shows the moment it happened. Romania's defense minister said the drone threatened the lives of hundreds of people working on the deep water platform. The Romanian government says it was told the drone was not Ukrainian, but it has not said whether or not it was launched by Russia. This just another example and key risk in the oil and energy markets right now, as Iran has been rather quietly shifting its people in power to more hardliners who might be willing to extend or even expand the fight with the United States. Talk about it all, what it might mean for crude oil. Joining us, Josh Young. He is CIO at Bison Interest. Josh, glad you're coming on. I want to talk about Russia and Ukraine in just a second, but there's this huge push-pull in the market right now. The U.S. government, they've told us for a while, there's some new stories out, whatever, that they're able to get more oil out of Hormuz than maybe is being picked up by some of the firms that track this stuff because of transponders being off, et cetera. What do you believe is the true state of oil flows in that region right now?
It's a great question. Thanks for having me on. So I think it's pretty clear we saw a similar story in May, and immediately after hearing repeat assurances that oil was transiting through the Strait of Hormuz, we saw this MOU and ceasefire signed, which seemed like capitulation by the U.S. And so it seems hard to believe that this time is different. And I think that the tanker trackers, for example, and literally that name, as well as various other firms that track these things, I think they're great at it. And I think the number is probably closer to 5 than 10 million barrels a day coming out of the Strait of Hormuz. And I think we see that in the inventory data too, in addition to just seeing it in these reports from these analytics firms.
Because it's very easy to make the case for $100 or over $100 a barrel oil if you just say, not you, but the market says collectively, all right, well, the flows are closer to 5 million than 10 million. You have to admit, I mean, it has been confusing when you actually just kind of look at the available supply-demand numbers. I thought oil would be higher than it is right now. Kelly, I think my co-host did it. We made a sort of a friendly wager with our friend Rick Santelli about this, and we were wrong. The market, even though we're up today, Josh, is a little vexing. Why oil's at 86 and not 106?
Yeah, it's a great question. I think it starts to go down. You have to try to avoid the tinfoil hat on this one because there's not a lot of great explanations. I wouldn't call it vexing. I mean, we're doing extremely well this year. Energy stocks are up a lot. So it's been very profitable to be long this trade generally. And we have seen historically, we were looking back at different historical instances of mispricings like what you're describing, and they do happen sometimes in line with public statements of the sort like we've been hearing about more oil coming through the Strait of Hormuz. You could go back 20 years to 2007 where you saw similar sorts of mispricings, and when you see oil go a lot below where it should be on a fundamental basis, historically it's then risen a lot higher than maybe it should be on a fundamental basis.
In the commercial break, Kelly and I were talking about energy stocks. So the energy sector today is at a record high. So Kelly, your point is what? That the market is pricing in more gains.
That the wallet share is, so we all think, well, oil's off the highs, so therefore the financial pain is off of consumers. No, it's not. The energy sector at all-time highs tells you why, because the refiners, look at the spreads there, look at what people are paying on diesel, gasoline, those prices are still high, even if the dollars per barrel is down from where it was. I'm just curious, Josh, if you have a thought on that how do we get a sense of the total impact this is having, not just by looking at the price of WTI?
Yeah, it's a great question, and it's a great point. That's the other big factor, I think, for oil is that the price at the pump, and then especially the price for diesel, for trucks and so on, is quite high, and in some places is actually at or near record highs. And so as we see these sort of excess profits on the diesel and gasoline side, a lot because of the disruptions in Russia for Russian oil refineries, as well as Chinese oil exports. We are seeing unusual high refining margins. I think over the next couple of months, as we go into shoulder season, where refineries in the US used to run at, let's say, 85% utilization, as they go towards 95% utilization, likely because of these high margins, I think you'll see higher oil prices, potentially coinciding actually with lower prices at the pump. And so I think there's an extra, let's say, $20 to $30 a barrel potential, higher for oil and lower for refined products.
Yeah, you mentioned Russia. We obviously showed the Romania stuff. It's really heating up around the Russia side, maybe a story that's not getting the attention it should be. One thing, though, Josh, I want to leave it with this, is that, you know, I know it's a couple years out, but we've talked extensively. I wrote about it 2 weeks ago. All the different money and pipelines that are being built. You've got UAE, a second pipeline. Saudis running full steam across the east-west. You've got talk of new pipelines in Iraq going through Turkey and Syria. I know that's a ways out. How do you factor in this potential? Because a lot of this stuff is either not built or needs to be rebuilt or reconstructed or whatever. Do you factor in any of this into your longer-term thinking about the risk profile around oil?
Yeah, I think it's a great question. I think, unfortunately, these pipelines out of the region are a red herring. And unfortunately, even if there were those pipelines, there would still be a lot of risk to these energy production and processing facilities, water purification, which is necessary for sustaining oil production in Saudi Arabia, for example, and Kuwait. And so, unfortunately, that may be a good story, but I don't think it really addresses the root of the problem, which is Iran, the IRGC, and their affiliates attacking energy infrastructure and transportation. So I don't know that that really would fully solve the problem, unfortunately. And I think that energy security is at risk, like Secretary Bessent said earlier today, as long as the IRGC regime is in control.
And it's actually gotten worse because a lot of the names have quietly shifted, as we said at the top, Josh, to more hardline IRGC people from even the people that existed 2 or 3 weeks ago. Josh Young, Bison Interest. Really appreciate it, Josh. Thank you. Just one comment to you, Kelly, very quickly, is that I want our viewers and listeners to note that if you start to see, you know how we've been arguing for a couple months now that there's really no Iran, there's like a bunch of different collective. If you look now, some of the names are consolidating. There's some new names. Some of these are even more aggressive, shall we say, warlord types than the it seems like Iran is consolidating more to the hardliners than the moderates. Just something to be mindful of.
Well, I'm glad, you know, look, any little insight we can get might help explain why the negotiations are or aren't going the way they are and the price of oil concordantly.
One of the guys who's been elevated is wanted for war crimes by Interpol for, I think, a 1994, 2004 bombing in Argentina.
Yeah, I've heard about him.
Like, these are bad people that are now being elevated by whoever is purporting to run Iran.
Yeah. Stocks are at session lows across the board as well. Take a quick look. Dow's down about 629 points. Russell 2000's down 1.4%. And coming up, when will Anthropic and OpenAI go public? And can the market handle it when they do? We've got a panel to discuss that from all angles next. Welcome back. We have already had several big IPOs this year, the likes of SpaceX, which is down 5% today, and Cerebras. Couple more massive ones look to be coming soon, Anthropic and maybe OpenAI. Both of those companies have valuations in the nearly $1 trillion range. Can the market handle them? We have a banker here with us who worked on both the SpaceX and Cerebras IPOs. Barclays Head of Technology and Communications Equity Capital Markets, Jamie Tortorici. Such a fun name to say, Jamie. Welcome. And someone with a direct line to the tech C-suite, Daniel Newman, the CEO of the Futurum Group. It's great to have you both here on set. Jamie, do you want to just give us, here's what we think we're hearing, and you can kind of, wink or nod or whatever you feel comfortable saying. That Anthropic's coming soon. I mean, we're talking about maybe end of September, early October. OpenAI, I don't know. Feel free to chime in however you'd like.
Well, what I will tell you is, regardless of the timing of either of those specifically, there's a lot of anticipation about both of those companies coming to market. There's a lot of excitement. They're growing at levels and scale that we really haven't seen in the past.
Here's an interesting thing I'm just going to throw into this mix. Up until about yesterday, this all looked like a wonderful story. Now all of a sudden you're getting into this time of year, seasonally very difficult. We always know that. Look at today, look at the bond yields, all the anxiety. If the markets whip up in the next 2, 3, 4 weeks, is that going to delay Anthropic's offering?
Look, I think our pipeline is very strong as it relates to companies coming public. That includes the AI ecosystem. However, look, there's always a little bit market dependency, right? Right now, we have the VIX is at 16. We're not that far off of the lows for the year. 75% of IPOs the last 25 years have happened when the VIX is below 20. We're still in a pretty constructive market. We're seeing a lot of rotation in the market. So look, fast forward a bit to the extent that things are relatively stable in the market, those companies can really come public whenever they choose.
Dan, and I know, don't worry, Jamie, we're not going to ask you about the price of SpaceX because your firm worked on it. So I'm going to go to Daniel on this one. We're looking at SpaceX, $132. Stock was a lot higher. It's basically back sort of at the IPO price. But a lot of people have still gotten very rich. Do you view SpaceX as a successful IPO?
SpaceX did exactly.
Oh, a sweet mustache, by the way.
Thank you. I'm so glad you called that out, Brian. We sat down on SpaceX IPO day. We talked about this, and I actually told you.
Not a random question.
I told you what was going to happen. I said it will absolutely shoot up immediately, and then you have the unlocks. You have
it'll land like a rocket.
The reality, the gravity, and it's come back. But meanwhile, it's been executing. So SpaceX, as I said to you that day, and I'm going to continue and maintain my belief, it's been a good IPO. It's a company that if you're a long-term minded investor, you look at what they're doing in AI, more than even the space and the communications, you look at what they're doing in AI, impressive, $40 million per megawatt, best in class.
Is it performing well enough? Sorry to jump in.
No, it's good.
Is it performing well enough to keep the pipeline Jamie just talked about open and strong?
I think so. I think SpaceX continues to be a bellwether for what the market can handle, for the enthusiasm for AI, and of course, for the enthusiasm for companies that are breaking into uncharted territories. It's a very exciting company, and I think there is unfettered demand for Anthropic. And I think OpenAI is actually getting a bit of an unfair look right now. I think people have written it off too soon. They didn't even think about Anthropic until they did. OpenAI was going to win without question. Now all of a sudden Anthropic has done very well, but guess what? OpenAI's actually seeing its growth accelerate past Anthropic this quarter. So it's going to be great, it's going to be exciting, and the demand will be there when they go public.
That's what I was going to ask you, Jamie, is about, should we think about Anthropic and OpenAI is just they're kind of lumped together, or do we need to start thinking about them differently? Because to Daniel's point, it's maybe we lump them together, but OpenAI seems like it wants to wait a little bit. It has different maybe internal dynamics.
Look, I think there is so much excitement about this space in general, right? The LLMs are one part of the category of the AI ecosystem. I think you look at that spans multiple areas, power, right? Compute, there's a lot to come to market in compute. Obviously the LLMs, data center, infrastructure, and even the application layer is now there's lots of opportunities that are emerging as a result of AI. And so these companies, I think, are a subset, albeit very large, right? But a subset of the AI ecosystem that we're going to see come to market.
Who else would be, can you give us some examples? Because it is a little weird. Like here we have this incredible new technology, and most of the companies we're betting on or can invest in already are worth $1 trillion. Are there newer, smaller, more nimble players that you think are coming or no?
There absolutely are. I mean, if you look at a lot of the workloads are moving to inference, right? You have cloud inference companies that are private that are growing, multiples of themselves year on year that are opportunities. You have actually application software type companies that have very sound, large customer bases that are actually using AI to basically solidify that competitive moat that they have, that are using newer technology even in the SaaS space. And so there's lots of opportunities the next couple of years I think about. And if I think about how much high growth is there in the public markets, there's literally 19 tech companies that have grown 30% in the last year, that are going to grow at least 25% this year. Out of 6,175 publicly traded companies, right? So there's a real scarcity of high growth in the market. And the next couple of years, we're tracking 250 tech companies that we think.
It's 250 tech companies. Yeah. And I'm going to say something, Dan, that I want to assure the audience I've not been drinking, which is, are we understating the amount of money going to the AI build? And I bring this up because we always throw around the 700 billion, 800 billion a year number. The Journal just had a piece a couple of days ago about maybe 3 trillion off balance sheet type mechanisms. And maybe the numbers, as gigantic as they are actually bigger than we're even making them to be on television.
Well, let me give you
And people always come out the media like, oh, you're overstating everything, right? Maybe we're not.
I think we like hyperbole. It makes for a great story, but I also think there's a lot of truth behind it. We have a cumulative CapEx forecast at Futurum of a bull case for 2030 of 14 trillion now.
Over how much time?
Cumulatively between now and 2030.
What
14 plus
so
trillion.
In the next,
so in the next
3 years,
4.5 years. 26 to 30.
Got it.
So that would get to about 2.5 to 3 billion a year, effectively. Trillion. Yeah, not billion.
Yeah.
Sorry.
So when you talk
the math
about,
was right.
when you talk about the mechanisms that are being used, of course, the way these companies are going to be creative and how they think about doing financing. When, that newest OpenAI deal that got a lot of skepticism with NVIDIA, where NVIDIA is going to pull out and only do 5 gigawatts. Actually, that deal could end up being 350 billion, not 250, but the headline, of course, said, oh, they cut it in half. The truth is there's going to be more infrastructure bought. And of course, NVIDIA, with their credit default swaps and how that's being looked at in the marketplace, they don't want to take on and backstop as many guarantees as they have to, so they're getting creative. Their recent $500 billion partnership with KKR and Blackstone, that's all very creative in terms of how they can make sure the build-out continues, because the demand is there. And the thing is these are smart companies with great leaders that understand that underinvestment is a bigger risk than overinvestment. It's existential that they invest enough, but they have to do it the right way, because this isn't
fascinating to watch this all play out, because we don't know how it's going to. Maybe it ends great, but maybe it. But I watch everybody going, yeah, we have to be in the race. Do you have a quick final comment on that, Jamie? Like, do these companies
how does it end?
Have to go public, get this capital? Is it going to be all
or does it end?
The public market investor to hopefully not be left? I'm not trying to say holding the bag. I believe in these companies, but in this case, it's a lot of CapEx for a product that is in some danger of being commoditized.
It's a lot of CapEx, but they're building for demand that's already here, right? It's so different from the dot-com days where we were building out dark fiber and then hoping the demand shows up, right?
And it did, but it took decades.
It took a long time, right?
And companies went bust, as you know, Global Crossing, right? The companies that laid that fiber that we now rely on today went bust doing it.
But the quality of the companies backstopping this revolution, the balance sheets of these companies, the hyperscalers, and then, of course, the picks and shovels, the NVIDIAs, their balance sheets look completely different than 2001.
All right, gentlemen, thanks. Really appreciate it. Jamie Turner-Ricci and Daniel Newman.
All right, let's get on out of Contessa Brewer with a CNBC News update.
Brian, the Justice Department is now asking a judge not to schedule an emergency hearing on Disney's lawsuit over ABC's license renewal, according to a new filing. On Tuesday, Disney-owned ABC filed a First Amendment lawsuit against the agency, calling its investigation into the company a retaliatory campaign over the nature of its news coverage. The FCC says it began an early broadcast license renewal in April over Disney's diversity, equity, and inclusion practices. The Democratic National Committee has narrowed down potential host cities for its 2028 convention: Boston, Denver, and Philadelphia. The finalists now vying to host that event. A final decision on where the convention will be is expected later this year. And Hawaii is bracing for the potential of a new tropical storm to hit the island. Look, these folks just cannot catch a break. A few days ago, you had destructive flooding and wind from Hurricane Lala ravaging the island. Now officials are warning people about the possibility of life-threatening flash floods, but also, of course, landslides. All of that water destabilizes the hillsides. Brian, that's the news. We'll continue to follow that.
Scary stuff, Contessa. Thank you very much. All right, we're going to take a short break. Right back after this.
Time now for our Market Navigator segment, and boy, do we need it today. Our next guest says options can offer some downside protection in a market like this. The financials and utilities in particular come to mind. John Borrello is Senior Portfolio Manager for Global Strategies at Invesco. John, what are you thinking?
Well, look, the winds are swirling right now. There's a lot of uncertainty in the markets, both the bond market and equities. We've got the AI trade crowded and getting choppier. And I think there's a real opportunity for investors that are overexposed to this trade to hedge their downside risk, but not necessarily with the broad markets like the S&P 500 or the NASDAQ. I think it makes sense to break the market into pieces and look at the sectors as opportunities to hedge broad market risk. So, as you pointed out, I think financials are a good way to go with XLF to buy put options, maybe 6 months out, roughly 5 to 10% out of the money. Also utilities. Utilities used to be kind of a safe haven trade, but they're much more linked to AI with data centers, et cetera. So that's a good place to look to reduce downside risk as well. With consumer discretionary, you get exposure to both Amazon and Tesla, big bellwethers that have been driving the market higher for, recent past. And then you also have communications, which, that sector is dominated by Google and Meta. So you get a lot of the big names that have been driving higher that seem to be, a bit crowded and susceptible to downside risk. So really what we're screening for is sectors that are both relatively cheap in terms of the protection of their options, but also vulnerable to a pullback. And if you create a basket of hedges with those 4 sectors, you end up with the ability to have better bang for your buck. It's a cheaper way to hedge and could end up paying off really well if we get a broad-based sell-off, especially if correlations start to go to 1.
Financials, utilities, even consumer discretionary community, just the whole thing. No, I don't see energy in there. John, thanks. We'll check back in. Appreciate your time today. John Borrello,
thank you, Kelly.
There from Invesco.
All right, coming up, we're going to head down Wall Street's discount aisle. Jeff Kilberg is here to tell you which beaten up stocks you may want to buy or may not. All right, let's wrap it up by digging a little bit inside the discount bin because some big name stocks are now way below their average analyst target price. Here are the 5 S&P 500 stocks trading the most below their targets. Oracle, 76% below. You've got AppLovin, NRG, Micron, and Vistra, all more than 60% from where analysts say they should be. Let's bring in Jeff Kilberg, founder, CEO, and CIO of KKM Financial, also a CNBC contributor. Listen, analysts do often cut their targets. So the targets we referenced, Jeff, may get cut. But right now, those are huge gaps in big names, any of them catching your eye.
Well, Sully, you're absolutely right to see those targets. It is a little despairing to see, but even Oracle is a name, and we actually have that in our Essential 40 portfolio. We still believe it's an essential name, Sully, despite the fact it's down 67% from targets. It's only down 27% year to date after a pretty significant bounce recently. But think about Oracle. It is essentially the database and ERP system's central nervous system for all the Fortune 500 companies, major banks, airlines, and even the U.S. government to a certain extent. So we look at Oracle as an opportunity, call it value and growth, But what's happened when you've seen this haircut in Oracle, which we own, by the way, equal weighted, so it was 2.5%, now it's 1.5%, as it has been kneecapped. But what we are seeing, Sully, in Oracle is the fact of the matter, they have $638 billion. And this is RPOs. We're not talking football. You know I'm all fired up for football. It's not run pass option. This is remaining performance obligations. And that's $638 billion. It's a race for them. And I know since June, when it was trading about $250, we've seen a $100 drop, more than a $100 drop. And that's kind of on the open AI fears or jitters. But where I want to tell folks is that if we don't see open AI commit and execute on those contracts, there are people lining up to buy compute. Think about the open checkbooks at XAI with Elon Musk or over at Meta.
I like good argument on Oracle. Sort of an argument that we have not heard a lot about, and a stock that just continues to go down. But Jeff Koberg may be making a little bit of the optimistic case. Jeff, always appreciate your time. Jeff, thank you very much.
And thanks for watching Power Lunch, everyone. Dow still right near session lows, down 655 today. Closing Bell picks up our coverage right now.
All right, guys, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with stocks around their worst levels of this day. Higher yields, higher oil, certainly having an impact, especially as the reversal in rates does come just a day after the Treasury tried to soothe the markets. We'll have a lot more on that coming up, but there's the 10-year, there's the majors. You got two of the three majors down by at least 1% as we take a look at that scorecard with 60 to go in regulation. Most sectors are in the red as well. Most of the mega caps are as well. A little weaker today. That space looking ahead, though, as you might expect, to NVIDIA's earnings next week. Momentum names like Micron, they are higher today. Walmart having one of its worst days in a long time following its earnings. You don't often see the stock down 10%. It is today. Coinbase is ripping, though, on Bitcoin's bounce back, and Moderna is giving a little bit back as well after yesterday's historic move in that name. But again, take that into perspective here. Down 22%. It was up like 140% yesterday. So that's where we start our talk of the tape. Where do stocks go from here as rates remain in focus, the war carries on, and seasonal weakness looms? Let's ask our panel. CIBC's Chris Harvey, JP Morgan's Gabriela Santos, Invesco's Brian Levitt. Good to have one and all here as we try and figure out what's up with this market. Is this a hang-up on rates?
I think it's a hang-up on rates. I think it's more of a credit issue. What you're trying to do is you're trying to shove, I'd say, 10 pounds of IG issuance in a 5-pound bag, and it's not working. You're late in the season. What's happening is demand. There's too much demand for the paper that's out there, and you're having a little bit of pushback.
It's not going to stop.
It's not going to stop, but we do have earnings on, I think it's Wednesday, Tuesday.
Next week, Wednesday. NVIDIA, you're talking about,
NVIDIA, right? So it's a little bit of choppiness until then. And I think we just have to deal with it for now. Stocks do trade. We had a heck of a run, and now we're digesting some of the macro, and we're digesting a lot of the issues that's come to the marketplace.
So do we think then, Gabby, that it's going to be both stock and rate volatility for a little bit?
I think for stocks, in my opinion, primarily around the AI story. I think we've had a bit of a lull here, so rates getting a bit more attention. But I think for the stocks discussion, it's going to be after July's sell-off in semiconductors and momentum. Where are we now? Are we more appropriately priced for picks and shovels, hyperscalers, and software? I think importantly next week there'll be a little bit more information. Of course, we have NVIDIA's earnings reports, but there's also this anticipatory buzz around when exactly will we get the S1 filings for Anthropic and or OpenAI.
Oh, good point.
So really important insight there into the annualized revenue for these model labs, and hence the actual sustainability of a lot of this spending.
There's some talk in the marketplace, I read that on FactSet this morning, that some of the negativity around the momentum trade is actually around what Gabrielle is talking about maybe a little bit of softness relative to expectations in the ARR, the revenues from the run rates of these companies, OpenAI and Anthropic. How do you see the markets here, given sort of everything, there's a lot of cross currents, right?
There are. I think on this rate question, we should probably put this a little bit in perspective. Everybody's focusing on steady no that earnings have been robust, revenues have been robust. There will be some slowdown as we move forward, but I think we're still very much in a structural bull market.
You think we're making too much of that screen right there?
What was the screen? I missed it.
Right. Oh, it was the yield curve.
The yield curve. Well, look, I mean, whether you're talking about short term or long term, I think are two different things. We're seeing rates grind up and the market's digested it. If they move quickly from here, then yeah, you'll have some volatility, you'll have some valuation adjustment. But is that the end of the business cycle? I don't think so. We're still very much of the mind that we're in a longer term structural bull here.
You've never been shy about, stepping further out than some are willing to go. What is your target for stocks for this year?
Target for stocks is 80-20. We still think there's upside. That's not a ton of upside from what we're seeing. But the thing is, everyone's making money in this market. Small cap managers, S&P equal weight, tech managers. And when you see that, people are going to put on more risk. They look at things more optimistically. We're going to have some chop in the short term because of credit, because of rates, because we're into the macro at this point in time. We're going to have Jackson Hole. But longer term or intermediate term, you're going to have equities go higher. The fundamentals are still really good.
Are you tempted to bump that target up? I mean, because now you almost have everybody at least 8,000. You know, Yardeni's like at 884.
Yeah.
Some have said, hey, you could do 9,000 in the next, whatever period of time, just because, as Brian was talking about, the earnings story is so dramatically good.
It's really good. I don't know if I want to do this on air, but let's just say that.
But let's. we were about to do it. I was feeling that.
But things are good, right? And you do have to take with the good with the bad. Sometimes things are good, rates are moving higher. At the end of the day, it's real rates, which is making things more attractive for the bond investors. Sooner or later, you would expect them to step in. And if we ever get something relatively positive in the Middle East, you can see stocks take another leg higher.
Hey, that's what Rick Rieder was talking about yesterday, the attractiveness of real rates.
Yeah, it's really attractive. You're getting paid. You're getting paid more than you have in a long, long time. But people are just, investors, PMs are just a little bit tentative. And once they get off and they feel a little bit more comfortable, things can change very, very quickly.
All right, I'll come back to you guys in a second, because speaking of yields, the Treasury Secretary was on this very network earlier today and said yesterday's intervention might not be the last.
We routinely do buybacks, and we're going to increase the size of the buyback. We're trying to signal that we think that this is a thinly traded area of the market, that we're in August, and there's been a lot of corporate issuance that's influenced the market.
Our senior economics reporter, Steve Liesman, as you see, has joined us at Post 9 with more. I thought that was interesting. So this may not be the last, but also using the word signal, because when I was talking with Rick Rieder yesterday, he also intimated that this was more about the signal than the move itself, to which I'm thinking, like, now we have a Treasury put too?
Yeah, it may be the question of, don't fight the Fed is now don't fight the Treasury.
Well, does that work just the same?
Let's be clear about what they announced. What they said yesterday was at least $4 billion per operation from now through November. So that was $16 billion. $16 billion is a pimple on an elephant. However, symbolically, and I was just studying the chart, and they just put up the chart, not even my asking, they put up the chart. That is amazing. It looks like
they're good.
It looks like the market is acting as perhaps there's a line it's not quite willing to cross, that may be at 470 here on the 10-year. I don't know that yet. These are early days yet. They did give back something. The Treasuries gave back something of what they got yesterday in terms of the rally from the action by the Treasury. But what was really interesting, and this is why it helped that I was an English major and not an MBA, was when Bessent steps to the podium here with Sarah this morning, and he is not prompted, and he says, it could be more than $4 billion. Those were literally the first words out of his mouth. That told me a couple things. The first thing it told me was he was not satisfied with the market reaction and wanted to make sure the market understood what they were saying. It wasn't up to $4 billion. It was at least $4 billion on these buybacks.
So he also said, which I thought was interesting, this notion that rates are not trading on fundamentals. He made that case, and that he has, quote, asymmetric information that the markets don't. He just doesn't think that the market's rates are where they should be. And he's clearly intent on trying to get them there by one way or the other.
Yeah, I would kind of say good luck with that, Scott, because what you're talking about is saying I know better than the market, which was okay when he was a hedge fund manager. Whether or not that's okay when you're the Treasury Secretary is a little unclear, because at the end of the day, and this is where it gets squirrely here, Scott, and really very interesting, the Treasury's arsenal in this regard is very small. Unless they're going to violate their own kind of rules and start using the Treasury General Account to effectively things, it doesn't have a lot of money to play with. You know who does have a lot of money to play with?
So the Fed?
The Fed. Now, you were sitting this close to Reader yesterday. And
Closer.
Reader, closer. And I understand why you keep your distance from me and not Rick, that's fine. But here's the deal. Reader is the one, boy, I wish I had this quote right in front of me. I didn't know I was going to quite go here.
Okay.
Reader's the one who mentions the Fed.
Well, I'm going to play that for you.
Oh, you're going to play
don't
that?
front run this.
Mind meld.
Because I'm thinking about the Fed. Well, I'm thinking about the Fed and then how the move in rates and the Treasury's intervention is going to play inside the Fed when Chair Walsh gives the speech, Chair Warsh gives the speech next week in Jackson Hole. Some are also wondering whether he needs to give the markets more information on how it plans to get inflation down. St. Louis Fed President Alberto Musalem, he was on this set as well today and said the Fed can still get rid of forward guidance and communicate better with the markets. Listen.
I think forward guidance is useful when interest rates are at zero. We're not at zero right now. We're in a normal state of affairs where the federal funds rate is our primary tool. So I'm open-minded and okay with putting forward guidance aside. That said, there's a big difference between what forward guidance is, which is a commitment to a policy path, and actually communicating your framework.
Right, he did that with you guys. He didn't tell you what he was going to do or what he foresaw in terms of his moves on rates, but he gave you the mechanism in which he's thinking how you can get from here to there, what they should be looking at to get from here to there, and an idea of how maybe they can execute it with the tools that they have in their box. You don't need to turn the whole box off.
Right.
You can do both. You can achieve what Warsh wants to and still get to that place, can't you?
So my lead for tomorrow's story, Scott, is the family fight is going on vacation in the mountains. Okay? And what that means is I don't hear that almost anybody on the FOMC is glomming on to Kevin Warsh's idea about holding back on their reaction function. I believe there's almost universal disagreement that they should follow that path. Warsh has his own ideas, and I believe Warsh is going to end up in Jackson Hole closer to where other members of the FOMC are. I think it's likely that Kevin Warsh ends up giving us more of his views. I think he's trying to figure out how to affect his ideal with the reality of running the largest economy and being the most powerful person. And I think that means he has to meet them a little bit more halfway. And I also think that Kevin Warsh is going to decide that there's some things he can say and won't say after press conferences, but when he's giving an individual speech, he may have more latitude to give us more information on what he thinks.
I mean, I think even some of the largest market participants think that some changes need to be made,
right,
and that Chair Warsh can achieve what he wants while at the same time expressing a little more information.
Right.
Listen to BlackRock's Rick Reader. Here's what he told me about that yesterday.
There is one thing that I think the chair needs to do over the coming weeks, and maybe Jackson Hole, maybe at the next FOMC meeting. What are the metrics you're looking at? What is your reaction function going to be? If you saw this sort of data, and by the way, it doesn't have to just be core PCE.
So I thought that was interesting hearing from somebody like Rick Reader, right?
Yeah.
The world's largest asset manager, and that's where the segue is perfect for all of you guys. Like, you want more? Are you content with less? What do you think?
I'm content with less. Tell us what the task force have. Give us the framework that you're going to look at, and let's move forward. And I agree with a lot of what he's saying. We want to move to the back page. We don't want to be the front story. We want to react to the markets, not the markets react to us. That is the right thing.
We play the ball, not the referee. But I go back to what I said to Reader yesterday. Players on the field at least want to know what the rules of the road are from the refs. How are you going to call this game? And then I'll play it. I don't need to rely on you to play my game at my best, but I at least need to know what the rule book looks like.
Yeah, you don't need the answers to the test. You need to understand how the test is going to be put together, how you can study and respond to it. And I think that's what a lot of market participants are talking about. It's inappropriate and has been for some time to have such precise time-dependent forward guidance. But we still want to understand how the incoming data would affect the Fed's reaction function. That's what, rate-sensitive markets do. And this is where I think it's interesting. This year we've had, since February, a move higher in yields. From February to late June, it was just resetting inflation and rate expectations. But then since late June, it has not been about that. It's been about the term premium. So the extra little juice that investors want for a given macroeconomic outlook. And that's where I think it is about some of this confusion around, well, which exactly inflation metric is it? And is it interest rates or the balance sheet? And that's where I think ultimately it's just probably some typical first press conference kind of misspeaking that can be and hopefully is corrected at Jackson Hole.
These concepts are not mutually exclusive. You can achieve all of the things that he wants to achieve while giving the markets and its participants just a little more clarity on getting from point A to point B. What do you think?
What precisely are we watching? But the reality is, I think I'm largely okay with this, Scott. I mean, like, what am I watching on a daily basis? I'm watching inflation break even. I'm watching leading indicators of the job market. So for the most part, I don't view this substantially as rocket science. I'm sitting here right now with contained inflation expectations, a job market that's relatively weak. I could surmise from that it's unlikely that we're raising interest rates significantly here, if at all. And if we do, are we raising them beyond what the market is already expecting? So I'm generally comfortable with it, and I'll continue to watch indicators in the market.
I understand why a senior economics reporter would want more. More is more for what we try and do. But what do you make of hearing from these market participants suggest that they're okay with less? And then maybe in this instance, less is more. But in the context, too, of what Reader's talking about.
I've given my take on that, which is that I don't know if they're saying this, but if you're going to give me less, I'm going to say pay me for less. And pay me for less is I'm going to exact more in terms of uncertainty. So you can run the railroad any way you like. What I think is important here is to think about who Rick Reader is. Rick Reader is not one of those whiners that the Journal's op-ed page has complained about. Rick Reader is not a radical or a complainer in any way, shape, or form. Rick Reader, I think you said, is the world's largest asset manager.
Well, BlackRock is, and he's the CIO of Global Fixed Income.
Guess what?
And the head of their entire allocation
team. Rick Reader is one of Scott Bessent's biggest customers. Rick Reader is an aorta through which the Federal Reserve affects monetary policy and helps to run this economy. If Rick asks for a little bit more, it's a perfectly reasonable and very important request that you could expect both Scott Bessent and Kevin Warsh to acquiesce to.
That's why I thought it was meaningful when he said it yesterday.
Yeah, but let me give you one more thing, which is the other thing that he said, which is another horizon to discuss. Rick said, I think there's more firepower at Treasury for these buybacks. And we heard that today. This was yesterday, Reader's argument. Yeah. But here's the other part. I quite frankly think there's more firepower in terms of how you manage the yield curve sitting at the Federal Reserve. Now, remember, Kevin Warsh said, and my colleague Matt Peterson is writing a piece on this now. It'll be on .com, I believe, this afternoon. Get to work, Matt. But here's the thing. Kevin Warsh said he wants to give the Treasury the responsibility for things that are the Treasury's. And the question becomes the extent to which the FOMC is willing to play ball in terms of what the Fed is, what the Treasury Secretary is trying to do here. And we talk about symbols earlier in this conversation. You got to wonder, is the Fed going to be working with the Treasury on this YCC, this yield curve control, or will the FOMC balk at that concept? That's something I believe that's not quite in the back of the mind of big bond managers right now, but maybe it's definitely on their mind right now.
It ups the ante, if
It
nothing
really
else,
seriously ups the ante.
for next week and then beyond at the meeting. So we'll see, guys. Yeah, go ahead.
I would just say, and for November, when we get the next Treasury refunding announcement, this asymmetric information that Treasury Secretary
What does that mean,
Desmond
Gabrielle?
was alluding to, is he going to signal
What does that mean?
a big change in the issuance calendar?
In other words, I know what I'm going to do and you don't know what I'm going to do.
I'm going to
Thank
issue
you.
a lot more on the short end than on the long end.
But that's the opposite of what his Treasury Advisory Committee has advised him, and where he's going into higher percentages of short-term debt as a percent of the total outstanding debt. And what that does is put pressures on Warsh. If he moves interest rates, he creates a bigger cost for the Treasury and the financing
Sure,
of the
but
deficit.
let's not also forget, and I think it's worthwhile just thinking about this too, and then we're gonna bounce. The midterms are soon. Some say this is as much political as it is sort of mechanical in the markets to try and get yields down. So I think it's all in the soup pot, and we'll see how the markets end up tasting it, what they think. Guys, that was awesome. Thanks so much for everybody being with us. Let's talk Walmart today. It's one of the day's biggest drags, certainly on the Dow, despite that revenue beat. Pippa Stevens tells us why.
Hey, Scott, worst day in more than 4 years after Walmart's same-store sales came up short, missing estimates for the first time in more than 4 years. Now, the company did beat revenue estimates for the quarter and raised its full-year EPS guide, but that is likely largely due to the $2.9 billion in tariff refunds the company was eligible for, the vast majority of which was received in the just completed quarter. For the comp sales miss, that was almost 1 full percentage point below estimates. Walmart pointed to changes in pricing regulations for GLP-1 drugs. The company also said customers are feeling pressure and looking for value, specifically calling out the rise in gas prices, with CFO John David Rainey saying on the call that looking at sales month by month in the latest quarter, it was clear when pump prices increased and got above $4, noting the trade-offs in June were the most obvious, leading the retailer to lean heavily into lower prices. Still, Walmart did say that sales performance in its core business continues to be very consistent. Those shares down 10%. Scott?
All right, Pippa, thank you very much for that. That's Pippa Stevens. We're watching SpaceX, too. Under pressure today, yet another post-IPO lockup expiration happening today. Stock down more than 5%. Seema Modi tells us more. Hi.
Hey, Scott, about 319 million SpaceX shares have become eligible for sale. This is SpaceX's second lockup as part of the company's staggered approach to unlocking shares for early employees and investors over the course of 1 year versus all at one time. Bankers often recommend this strategy to limit volatility. Investors can choose to hold their shares, so the actual impact on the stock really depends on how much they sell. SpaceX shares did rebound following its first lockup in early August and are still up about 22% since then, though the stock has pared some of those gains. Driving today's price action, Chinese startup Landspace launching and recovering the bottom part of its rocket. Till now, SpaceX and Blue Origin were the only companies capable of reusable rocket technology. So it's seen as yet another sign of China attempting to narrow the gap with the U.S. in space. At this hour, watching SpaceX shares down about 5%, on pace for its third negative session in a row, Scott.
All right, Seema, thank you. Seema Modi. We're just getting started here. Up next, our analyst Dan Ives. He's back at Post 9. How he sees the move in rates impacting tech stocks. Plus, we get his reaction to what Micron's CEO said exclusively on this network today about the memory chip crunch. It was pretty significant. We'll discuss next. Welcome back. Micron shares, there they are, 3% bouncing a bit today. The company's CEO, Sanjay Mehrotra, was on CNBC today, said this about the ongoing need for memory.
Memory is no longer a component in a system. Memory is the strategic infrastructure for AI. It's no longer a commodity, it is a high value. This is enabling value for our customers. Without memory, you cannot make AI smarter. You cannot make AI faster. You cannot scale up AI. You know, AI is advancing. A lot of context is getting generated. All of that context has to be stored, has to be processed through memory.
For more, let's welcome in Dan Ives of Yorkville Ives and Company. Good to see you.
Yeah, great to see you.
He's making the case that don't judge us as chip makers the way you've traditionally judged us, because this time's different. Is that the message?
And I agree. I mean, as someone like myself who's been to Korea so many times, you see the changes, because the reality is you count on one hand the amount of memory players. And when it comes to the AI revolution, everything that we're seeing, right now, demand to supply, 15 to 1 when it comes to what we see from a memory perspective. And that's why, obviously, Apple is a good example, need to pay more in memory. And there's just no way around it. This is not cyclical. This continues to be really foundational.
What if it's still cyclical? The duration of that cyclicality has just been elongated. Is that fair, or have we literally entered into a more secular time for chips because of the level of demand and how it's not going to dissipate anytime soon?
Yeah, it's a great point. That's definitely like a hot sort of debate, in my opinion.
Because it matters for valuations,
no
doesn't
doubt.
it?
Of course. And to me, I think it's changed. It's no longer, the cyclicality at one point will come back, but I don't think you have true equilibrium till late 2028, early 2029. Based on the trajectory of what we're seeing today. And I think that's why we're going to continue to have these ebbs and flows, no different than we saw with the Kospi and Korea and some of these sort of white knuckle moments. But the reality, and I think it's further instituted what we've seen from the hyperscalers in terms of demand, what you see in terms of enterprise use cases, memory players, it's right now, it's their world and everyone else is paying rent.
So if the valuation of Micron, for example, on a forward basis is like 6.5, 6.6, something like that. Is that where it should be? Is that cheap? I mean, how do you assess that, given if you're a true believer in what the CEO just said as an investor, then if I agree with you, what do I do? 6.7 times.
Yeah, I think right now, I mean, investors are valuing these companies, this cyclicality, and they're basically giving no credit to what ultimately I believe is going to be the demand over the coming years. Scott, I think it's no different than what we saw like with NVIDIA. You know, if we just think over the last few months, as these companies prove it, the valuation will ultimately then start to, I think, manifest and actually generate what should be less cyclicality and really more of a multi-year cycle that's going to continue to play. There's no way around it, because even when some say, okay, there could be Chinese memory players, or there's an alternative, Korea holds the cards when it comes to memory. And I think that there's no changes that I see in the future.
And there's no implication at all for excess ordering or double or triple ordering because you can't get what you need. And eventually it's going to catch up, and then that's when the problem happens because people have ordered too much, even if there's robust demand.
Yeah, and that's been a worry. But right now you got to get online to get those chips. And I think part of what we're seeing in terms of everything from a use case, from hyperscalers, from a demand perspective, it's just accelerating. So I don't think that we are near any sort of point of sort of over-ordering or worries about inventory and then they cut back. And I think that's something where it's further validated from the hyperscalers, obviously companies like Palantir, software companies, chip makers. It's a Jenga puzzle when you put it all together. And I think more and more it's really starting to play out from a bull case scenario.
All right, so you get more from the CEO tonight with Jim on Mad Money because he was the one doing the interview and the soundbite that you saw, so you don't want to miss that. I'm not going to let you go, though, without asking you about NVIDIA. Where are your own expectations ahead of an earnings print that's going to happen in now less than a week?
I mean, it's our view, investors continue to underestimate the scale and scope of what NVIDIA is doing.
How? How's that possible? How can they be underestimating it?
The reason they're underestimating is that I think they are not recognizing what we see in Asia and what we see across from the hyperscalers. If you put it all together, NVIDIA right now, you're almost giving them a minimal credit for physical AI and what's really going to be the sort of next evolution of AI. And that, when it comes to physical AI and their next chips and everything that they're sort of building out, investors continue to be skeptical. And I think as they prove it out, no one has a better perch than Jensen. And I think that's why so much of this tech trade next week is just so important, because that really will be, I think, a huge sort of planting of the flag moment to show that we're not in the 7th inning. I thought we were in the 3rd inning, and you could argue we're maybe bottom of the 2nd.
Wow. Well, how good does it have to be? How good does it have to be? They have to like crush expectations?
I think
there's got to be whisper numbers.
I mean, there's whisper numbers, but I think it really comes down to it's them giving expectations that numbers would be underestimated by 15 to 20% for the next 12 to 18 months.
Huh.
And I think that is really where some of the bogeys are here. But betting against Jensen, it would be like, those that bet against, Tom Brady, those that bet against Mahomes and others.
I mean, Brady didn't win every Super Bowl he played.
It's a good point.
All right.
But he won a lot of them.
He did. He got a lot of rings. Dan Ives, thank you. All right, another big money deal in the world of sports. This time, the NFL, our own Mike Ozanian, he broke the story, and he joins us next. And a big couple of weeks for sports deals, and today, word of yet another. CNBC senior sports reporter Mike Ozanian, breaking news today, joins us with his scoop. What'd you learn?
Hey, Scott. Private equity firm Arctos is in a deal to buy 10% of the Atlanta Falcons over 18 months in a transaction that will value the Falcons at $10.6 billion. This deal still has to be approved by the NFL. If it goes through, this will be the fourth team that Arctos has invested in. They have a piece of the Bills, the Browns, and also the LA Chargers.
So $10.6 billion is the valuation for the Falcons. Where did they rank on your most recent list?
The Falcons, I think we had at $8 billion. But again, that's a control stake valuation, Scott. So in fairness, there's even a bigger difference between the $8 billion and this 10.6, because the 10.6 is probably a slight discount to what a control stake would be. This is on the heels, of course, of what we expect will be approved later this month, the $9.61 billion sale of the Seahawks. That set a new valuation benchmark for the NFL. Even looking at what Arctos has done, their first foray about a year ago into the Bills was at a $5.8 billion valuation.
Wow.
Now they've gone up to 10.6.
I didn't mean to step on your toes there. I'm just so fascinated by the fact that you have such a growing number of investors who just want in. They don't even care if they have any control over anything. They just want a piece of what is still a robust and fast-growing pie, and I don't care what of the major sports you're even talking about at this point.
No, that's a great point, Scott. And I think even though it totally holds true for the NBA, I would put the NFL a little ahead of the NBA there, because the profitability in the NFL is like no other sport. Because somebody said to me, one of the sports bankers, I'm a little surprised at an 11.6 buy-in for non-control stake of the Falcons when a control stake of the Seahawks was 9.6. You know, and I said, listen, the Falcons are bigger in terms of revenue and far more profitable. The Falcons are one of the best teams in the NFL in all of sports in terms of being run like a business.
Not a surprise. I mean, Arthur Blank is so well thought of. Their stadium is amazing in Mercedes-Benz. The way that they price their concessions to be more exclusive for their fan base. I could go on and on and on. But we'll certainly talk more in the weeks ahead. Mike, thanks. Great scoop.
Thank you, Scott.
Yep, appreciate you. Up next, the big market call from one top technician that you got to hear. Fundstrat's Mark Newton's next. Welcome back. Our next guest thinks the Treasury's intervention on interest rates could send stocks to new highs as soon as next week. Mark Newton is FundStrat's head of technical strategy. He's here at Post 9. It's good to have you back.
Thanks, man.
So this was that significant that you think the S&P, the Qs, equal weight leading into Jackson Hole? Like we've got a little bit of room here?
I do think it's a game changer.
Really?
I think we need to see the extent of what they're going to start to buy in terms of securities and how much. And a lot of that has to do with probably the Treasury put, which is now at about 475 for 10-year, potentially 530 for 30. So, in general, it's a hugely reflationary trade that does address liquidity concerns. We saw gold, we saw Bitcoin surge. Near term, the 1-2 combo of rates pushing back up along with crude is temporarily something that stocks don't like. But I think in general, the amount of breadth improvement that we've seen in recent months, along with this ongoing skepticism, is definitely a positive with regards to stocks.
The messaging alone from Treasury is enough to get us to where you think we can go? I mean, combined obviously with the robustness of earnings. Right? I mean, that's the story.
The one big problem was that the velocity of rates had really gotten out of hand on the long end. We saw breakouts on the 30-year, we saw breakouts on the 10-year, and it wasn't the level, it was the velocity of that move.
Yeah,
and I think the administration as well as the Treasury noticed.
Yeah.
So my thinking is that they're stepping in now at a time when TLT puts Q was very elevated to say, look, we have to do something to help liquidity. Emerging market currencies are falling. The U.S., of course, has a huge balance. They have a ton of overseas securities and emerging market currencies. Meanwhile, their liabilities are in dollars. It would certainly help them to have the dollar go meaningfully lower at a time when growth remains still pretty decent. And that could actually decrease the debt to GDP that everybody's concerned about that now become a big hot button.
Forgive me for interrupting you. It was Rick Reeder who used the word untethered to your point at the long end. It was starting to look that way in his mind. What do you like best in the market right now? What sector, what area?
Honestly, I like three sectors. I like healthcare, I like energy, and I like materials. I think those three are likely going to benefit and be a good source of alpha for investors over the next few months.
Why so?
Well, healthcare per se, it broke out of nearly a 3-year downtrend. We used to have concerns about drug pricing, about the ACA subsidies. Now that has turned. Biotech is surging. We're seeing deals happen. Not only is it biotech, but pharma, but HMOs. Healthcare looks still very, very good to me. Obviously, the GLP-1 helps some of these other pharma stocks, but energy, my thinking is crude is going to revisit $100, which is going to make ending the war probably tricky in the near term.
Wait a minute, isn't that a problem then for stocks?
It could be a problem in September, October, yes. So I think it's going to prove short term only, but we have one big final push up to right around 100, 110, and then crude should end the year down near the lows. So I think there is going to be an eventual solution better than what we're seeing now. But we know that they're using pipelines to take oil right now through the Red Sea, through the Gulf of Oman. We don't necessarily need to have the strait as much as we did. Already some traffic is starting to be circumvented. But energy right now is very much a short-term long, along with materials. Commodities surged yesterday. I think that's going to be an ongoing theme, just given what we've seen with real rates hopefully starting to pull back, which will be a source of gains for most metals, precious and base.
All right, we'll leave it there. It's good to see you again. Mark Newton of FundStrat, the head of technical strategy. Up next, we're going to track the biggest movers as we head into the close today. Markets are weakening as we speak. 10 to the bell. Back to Christina now for the stock she's watching. What do you see?
Well, let's start with Moderna shares because you talked about it earlier in the show, but they're pulling back following a historic 177% rally just yesterday after the company reported positive results specifically for its experimental cancer vaccine developed with Merck. Likely today we're just seeing some profit taking. That's why shares are down roughly almost 26%. It's worst day on record, but yesterday's surge was the biggest one-day gain by an S&P 500 stock in 25 years, this according to Dow Jones. Switching gears, Advanced Auto Parts also in the red today after posting weaker than expected same-store sales in its most recent quarter. The company's CEO saying tighter household budgets hit sales with more customers just opting to make repairs themselves. Shares are down 26%. Last but not least, CrowdStrike is sliding. On an Axios report, the company's CTO is leaving to start an AI-focused cyber venture fund. The new firm called Cognition is targeting a roughly $170 million fund. This according to Axios, and that's why you're seeing shares down almost 6%. Scott?
All right, good stuff. Christina, thank you. Christina Partsinevelos. Coming up next, I'll tell you what has shares of Deere rallying today. That and much more in the zone, which is next. All right, we're now in the closing bell market zone. Northwestern Mutual Wealth Management's Matt Stuckey here to break down these crucial moments of the trading day, plus Oliver Rennick standing by live from the Cboe Global Markets in Chicago. Contessa Brewer following travel stocks under pressure, and Seema Modi on Deere's big rally. Oliver, at the Cboe, what do you see?
Yeah, Bitcoin, kind of the story day two here, Scott. Despite stocks selling off, it's up, and so is hyperliquid proxy Pearl holding strong. Perhaps the most telling thing about this crypto comeback is that it's happening while stocks and bonds are struggling on the back of the Treasury's big bond buyback. In theory, this is what Bitcoiners say it was made for, and it's arguably presenting a novel upside to Bitcoin after its worst performance versus stocks in 7 years last year. Bitcoin is up, while VIX is too today. It used to be the opposite. When equity vol was up, Bitcoin was down. Right now, it looks like options traders think it can last. They bought twice as many calls as puts in everything from iBit to Coinbase, Strategy, Circle, and of course, Pearl, up 190% this year, Scott.
All right, Oliver, thanks for that. Appreciate you. Oliver Rennick, Contessa, tell us what's up with travel.
Ooh, some rough seas for some of the big travel names today, Scott, and oil prices are rocking the boat for cruise stocks. Let's take a look here. Royal Caribbean, Carnival, Norwegian, all sinking between 4 and 5%, continuing their downward slide this week. Viking just reported strong earnings and forward bookings, but look at their stock down 1% today. Its stock suffering along with the group. Investors really are hitting the brakes as well on Camping World, with sentiment souring around demand for RVs when fuel prices are this high. Its stock declined by 4.5% now. Winnebago's also down 2%. There's just skepticism around consumer discretionary spending now, and that is hitting timeshare company Marriott Vacations. That's down 5%, and TripAdvisor down almost 4%. Just travel names on the whole, Scott, settling into the red for the close.
All right, Contessa, thank you. Contessa Brewer, how about Deere? Seema?
So Deere are surprising the street by beating expectations on the top and bottom line, and also pegging data centers as a source of demand. Executives sharing on the call that large-scale infrastructure projects, data center construction continue to support robust customer demand. Deere's order book for earth-moving equipment now full for 2026. Now, Melius Research, analysts there, tying the company's sort of advanced layer technology as one of the reasons Deere continues to outperform and is positive on the stock, initiating or reiterating, I should say, its buy rating, saying the ability to layer on advanced technology to add tens to hundreds of billions in value to farmers really changes its earnings profile. You'll see the stock is up about 8% at this hour, Scott. So one to watch here, especially as more industrials lean into AI.
All right, Seema, thanks very much. That's Seema Modi. All right, Matt Stuckey, tell me about this market today. What do you see?
Look, I mean, I think we're just giving back a little bit of that surge that we saw from yesterday with that move in rates kind of round tripping. And so increasingly as rates have moved up towards 475 or so, that's starting to compress the forward multiple on the market. And that's kind of maybe like a technical level we should all keep in mind going forward here. You know, despite really strong earnings as Q2 is coming to a close, multiple compression is the other side of that with rates continuing to be elevated.
Do you expect more rate volatility and thus stock volatility?
I mean, I think so. A lot of this is going to depend on kind of what happens with oil prices from here. And then from there, what type of data we get between now and September in terms of inflation and employment. So really, there's a lot of kind of balls in the air in terms of kind of where these kind of big factors are going to drive rates. But ultimately, the main driver of the market, just in terms of the fundamentals, continues to be solid, just with earnings growth now on Q2 year on year, north of 30%. That's quite strong.
Speaking of earnings, NVIDIA looming large. We're going to be in a bit of a holding pattern ahead of that, and quickly, if you could.
Yeah, I think so. For NVIDIA, we get sequential growth that doesn't really surprise too much, but, commentaries look to 2027, and I think that's where most investors are going to focus.
All right, we'll talk to you soon. Thanks for being with us. That's Matt Stuckey. Again, you can hear the clapping. It's going to be red across the board today. Russell's the biggest loser. Again, rates ticking a little higher. Markets don't like it. Crude's elevated. Dow's down 1.25%. That'll do it for us. We'll see you tomorrow, and I'll send it into overtime.
The bells bring an end
to the trading day at the NYSE. M&T Bank ringing the closing bell, and at the Nasdaq, Fortunex acquisition doing the honors. Welcome to Closing Bell Overtime, live from Studio B at the Nasdaq market site. I'm Melissa Lee. Mike Santoli's off today. Stocks sliding as Treasury yields rebound. The Dow down about 700 points. S&P 500 down a little less than 1%. The Nasdaq down a little more. Bond yields are reversing course following yesterday's losses after Treasury's efforts to try to ease rates. Much more on this, including comments from Treasury Secretary Scott Bessent. A jump in oil prices may also be contributing to that move, that backup in yields. Oil higher by nearly 3% on the latest threats against Iran. And Bitcoin above 70,000 for the first time since June 1st, tracking for its best week in nearly 2 years. Let's get more on the stocks making big moves today. Christina Partsinevelos joins us now with that. Christina.
Well, Melissa, defensive stocks just couldn't catch a bid as bond yields, like you said, drifted higher. Real estate, energy were the only sectors up. Staples, healthcare, and industrials all fell more than 1%. Earnings did a lot of the steering today. Starting with Advanced Auto Parts, it slumped on a sales miss, with management saying tighter household budgets really constrained spending more than anticipated. AutoZone, O'Reilly also fell in sympathy. You had Deere went the other way, raising its 2026 net income forecast after its first quarterly profit rise in 3 years. The company pointed, of course, to strong demand from large-scale infrastructure, data centers, and energy projects. CrowdStrike dropped about 6% today, specifically after an Axios report that said its CTO's chief technology officer is leaving to launch his own AI-focused cyber venture fund. Then you mentioned crypto. The names extended their rally to alongside Bitcoin and Ether after the president pushed Congress to pass crypto-friendly legislation. Coinbase, Circle, Strategy, all up at least 5%. SpaceX, though, fell roughly 5% after its second post-IPO share unlock hit the tape today. And then